welcome to the 2026 Blueprint. I want to go through a couple things before we get started so we get real clear about what this course is going to give you and also what this course is not going to give you. But I know a lot of you guys expect such fast results, but this course is not built on fluff and motivation. It's built on real data and reality. So understand, if you follow everything I'm showing you and follow the exact order that I'm teaching you, you can become a profitable trader. But if you're just coming here to think that you're going to get rich in a couple days, shit is probably going to be a rough ride for you. So I just want to get that out of the way right away. Secondly, please understand a lot of this course throughout it, I have scripted to make sure that I don't miss anything that I've missed in the past, as this is now my third course I've given to you guys. I want to make sure that all of the things I've left out beforehand, just from getting in flow state and just teaching trading itself, none of that was mistaken in this course by not getting into it. So there is a lot of shit here, just things that I don't think about just because I've been trading for so long and kind of bringing my mindset back from being an advanced trader all the way back to a beginner trader. There's just some things get lost in translation that I don't even think about until way later on when you guys are speaking about it. But now, this is now my 10th year in the markets. This is my 5th year being profitable, and this is my 4th year teaching you guys live every single day in the markets. There is a lot of little things and nuances that I've learned from you guys that it was tough for you guys to understand until I actually got feedback from you to put in this course. So everything is documented in the exact order that it should be. Make sure you guys are not missing any videos, as it is all meticulously scripted to make sure I run through everything in the right order. And without further ado, let's make this money, bro. I'm very excited for you guys to get this information for free. We're going to talk about why I'm giving this information for free. And I want you guys to understand the skill doesn't simply just come from watching videos. It comes from consistently applying everything that I'm teaching you in the live markets and acquiring your own data. While you run through the course in order, I'm going live every single day with you guys right here on this channel. So make sure you're turning on notifications and tuning in every day that you possibly can so you can put actual implementation behind the knowledge that you're learning here. Let's get right into it. From this course, you're going to learn exactly how the foreign exchange market works. You're going to understand how to enter trades, how to exit trades. I'm going to give you a full mechanical system that has pushed me into profitability for the last 4 years. And I'm also going to introduce discretionary trading to you, which is something that you can't master until you have intuition in the markets. And obviously, you can't have intuition in the markets until you have data over the course of time doing the same exact thing. Once you understand the system, I'm going to show you exactly how you can start executing your live capital, whether that's opening up an account, choosing between a broker or prop firm, and literally everything else in between. You guys are also going to get a full psychology breakdown so you understand the importance of why you cannot emotionally trade, regardless of how good you feel about something. You have to keep that mechanical edge. Now, what this course is not going to give you is some type of get rich quick scheme. Trading is simply very hard. And although it is easy to learn how to trade, at least with this system, it is not the easiest to apply it because a lot of the time emotional decision making takes over just simply because you don't have enough experience and data with the system. But uncovering that truth, showing you exactly what that looks like and making sure you don't go down the avenue, this is potentially the quickest way you're going to be able to expedite that learning curve to become a profitable trader. But again, this is no fantasy expectations. It does take true hard work to get to that point. Now, you might be asking if this information is truly valuable and why I'm giving it away for free. So let's talk about it. I want beginner traders to learn real education and not get scammed. Now, I don't think every educator out there is a scam. I even think that a lot of educators, when they're teaching you, believe they're giving you real information, although they haven't had the data to back it up for themselves. They simply just found maybe a minor edge, haven't acquired profits from it, and started teaching others so they can get compensated in other ways. Not saying that is 100% wrong, as I understand they probably believe they understand how to trade. But until you have multiple years under your belt where trading is actually paying for your lifestyle and paying for your bills, I think it is a bit misleading to teach others how to do so for themselves, especially when you're looking for a monetary gain out after that, instead of just trying to give people real education. I'm a firm believer that your bank account is a direct result of how much value you bring to others. And this is a major way of me to give you guys even more value. So just want to make sure you understand trading is hard. And although I'm going to give you a mechanical system, that does not mean you're going to become profitable from it, especially in a short couple weeks. But with hard work and you applying that edge over the course of time and acquiring that data with that same exact system, you too can get to this point of being a profitable trader. Number two, I also will get compensated. There's partnerships within this course from a broker and a prop firm that once you understand how to risk safely, if you would like to use those same platforms, I can get compensated from that as well. And number three, I'm already trading live every single day. And so there's no reason for me not to show you guys the actual knowledge behind why I'm executing these trades. One, when I do that, you're going to expedite that learning curve as quick as you possibly can because you're seeing these moves happen in real time. Every last tactic that you get from this course, you're going to watch it applied in real time. And most importantly, you're going to be able to ask questions. So if there's any issues or something you're struggling with, you can hop on, watch me trade it live and ask questions so you can get them answered and start to progress forward. And that is going to build the confidence as quick as it possibly can so you can get from learning to actually extracting money from the markets. Now, before we get into how to use this course, I want you to understand this course is a progression and every lesson builds on to the next. And that is the main reason why I chose to release a video every single day so nothing is skipped in the concept are grasped in full. Instead of just giving you guys an entire video of everything, it is just way too much information to consume. So making sure you're watching every lesson day by day and taking notes of all these tactics so you can retain it a bit quicker than just watching it and hoping it sticks to you. Number three is going to be make sure you watch every last live stream. Acquiring the information and then watching it applied live over and over and over again is going to expedite that learning curve, like I said, as much as you possibly can. Applying the system the right way and the way you know you're applying it correctly is by watching me do it, the one who created it, every single day. And then lastly is journaling every last one of your trades. This is where you're going to acquire confidence. Yes, getting the knowledge. Yes, watching me trade it live, but also acquiring the data for yourself so you can answer the golden question is, more often than not, what does this system do over the course of time? So for a quick recap, you guys should now understand exactly what you're going to learn, what is not promised in this course, the reason why I did this entire course for free, exactly how you can use these live streams to expedite your learning curve, and why that works in the first place. Before you open up a trade, before you even open up an account, this is something we need to talk about and something that most educators always try to move past. It is a fact that most traders do lose in the market. And it's not due to not having a proper system, which most people do cheat. There is a million ways to make $1 million in the market. It's because a lot of people have such high expectations during such a short period of time. People simply expect that you can get profitable within a short couple weeks, you're going to get rich within a short couple months, and you're probably going to be leaving your job within half a year, and it's just simply not realistic. Although this is a very easy way to make money once you understand your edge and you can execute your edge without emotions, it takes a very long time to get to that point because you're dealing with something that most people always have frustrations over, which is obviously money. Trading is a skill, but that skill is not going to be acquired by watching YouTube videos solely. You have to apply that knowledge in the live markets, acquire your own data so you have the confidence to not trade emotionally and trade your plan. Remember, it's like going to the gym and putting 20 reps in a bicep curls and then thinking that you're going to be a bodybuilder the next week. It just simply takes time to get that consistency and obviously takes time to get those results. You only get good and you only get stronger when you show up, you learn the craft, you understand your mistakes, you're building data and discipline over the course of time. That's where confidence and true execution comes from. So let's get right into it. Most traders don't fail because the market is that hard. They fail because they approach it like a casino. They jump in without a system, they're risking money without any type of plan, they trade just because they're bored, and they take setups that aren't even setups, just trying to be involved in the game. It's like walking onto a football field without knowing the rules, the plays, any of the positions, and expecting to win against professionals. Obviously, the outcome is going to be pretty embarrassing for them. And that's what new traders do. They show up completely unprepared and they get upset when they lose for some reason. And here's the real killer. Trading exposes your emotions faster than literally anything else. Fear, greed, revenge, impatience, and overconfidence. Trading doesn't create those emotions, it reveals them. And you don't realize how impulsive you are until your money is on the line. You don't realize how greedy you are until you're up 3 times your investment and refuse to take any type of profit. You don't realize how undisciplined you are until you break your own rules again and again. So here's the truth that nobody wants to hear. If you treat trading like a professional skill, the market will reward you over time. It's not like you can go to school to become a doctor and get your license in a year. It's not like you can go to your job and become a wizard at it in a month And I promise you, you will not be achieving consistent, profitable trading in the markets during a short period of time either. It's not gambling. We're not guessing. We're not trying to win every trade. This is a craft with repetition that is data-driven decision making. Now, if you understand that and more importantly, accept all of that, you're already way ahead of 90% of traders. Now, this is exactly why I built this blueprint. I'm going to be giving you structure. I'm going to be giving you psychology. I'm giving you a mechanical system, and I'm giving you risk management. And I'm showing you how all of that works live every single day. So make sure you guys remember why traders fail. It's from them expecting fast profits, to having no rules at all, not executing any discipline. They have no emotional control, and they quit before they even get good. But you're not going to do that because you're doing this the right way. Before we go any deeper, I want to answer the question that a lot of you guys are wondering. If this entire course is free, does it actually give good, credible knowledge? And 100% it does. I want to run through why I'm making this course for free and how it benefits you the most, but again, how it also benefits me. So let's go ahead and dive into it. Most paid trading courses fail their students badly. It's because they hide basic information behind paywalls. They upsell the moment you buy something. They never show real trading, real fills, or real execution. And even worse, most courses teach information, but not any type of skill. So you walk away knowing a bunch of terms, but no idea how to actually trade them. So here's the truth. I don't need to sell you a trading course. I'm a trader first, and my income comes from trading live every day, not teaching or taking your guys' money. But I also get compensated through broker partnerships and prop firm relationships. So teaching this for free actually helps both of us. And honestly, I wish someone would have done this for me when I was learning. No paywall, no upsell, just a real breakdown from someone who actually trades live every single day. So I can't stress this enough. You guys are getting the biggest advantage here. You don't spend thousands trying to learn how to trade. You're not pressured into upsells or mentorship programs. You get a complete system, psychology foundation, risk management, and live examples, all without spending a single dollar. And you're not doing this alone. The community, the Discord, the live streams, you literally have everything you need to grow. Real quick, let's get real transparent so you know exactly how this works. I get paid from trading, first and foremost. You see that live every single day. I also get compensated when people use the broker I recommend or take a prop firm challenge through my link. YouTube pays me for these videos, and as the community grows, companies want to partner, which benefits everybody. So I don't need to charge for this course, and helping you actually helps the entire ecosystem. And that's why the setup is a win-win for you guys. The more you learn, the better your trading gets. The better your trading gets, the stronger this community becomes, because you're probably going to refer people here. And the stronger this community gets, the more opportunities open for everyone, myself and you as well. No paywall, there's no gimmicks, it's a clean exchange. I teach, you learn, and we both grow together. So now you understand why this course is free, you understand why most paid courses fail, and how this blueprint gives you everything without asking for anything in return. Now remember, every last video was meticulously placed to make sure that you guys are running through the process the way that it was designed, so do not skip the process. Before we jump into section 2, which is all about Forex Foundation, so you understand why the market exists in the first place and how you can invest into it, I want to make sure you guys understand how to go through this entire course properly, because most traders don't fail because they lack knowledge. Most traders fail because they lack structure. So as always, while you're running through this course, make sure you subscribe to this channel. I'm trading live with you guys every single day while you're going through this course day by day. Most traders fail because they treat education like entertainment. They binge watch a couple videos, skip around, look for shortcuts, and then wonder why nothing makes sense. Learning trading is not about cramming information. It's about building a foundation brick by brick. And that's why this course was intentionally structured. Every video builds on the one before, so you actually progress step by step. And skipping ahead is like trying to build the roof of a house before pouring the foundation. It's just guaranteed to collapse. So trading works the same way. The structure matters. So if you want to truly master trading, you guys need to respect the order that this entire program was crafted in. Trading is an active skill. So if you just watch and walk away on your own, you're probably going to forget like 80% of what I teach you. So you guys need to take notes, write down setups, psychology triggers, risk rules, literally everything, because you're building your own personal Zenlab playbook to go off of. And the biggest advantage you guys are ever going to have over any other course is you get to watch me trade the system live every single day at zero cost. This is going to be huge for many reasons, but one big reason is you're not going to feel any pressure to rush the process due to heavily monthly subscriptions or upfront costs. You can simply go at your own pace. You're not learning theory, you're watching execution. You're going to see how everything behaves in real time. And if you want to accelerate your growth, just simply show up to the streams. And let me be blunt with you guys. If you're watching 10 different strategies from 10 different creators, you will never succeed. You need to pick one system, which is going to be this one, and you need to commit to it. And later, once you've mastered the mechanical foundation, you can add discretionary layers. But right now, consistency and a mechanical system is going to be everything because confidence comes from repetition, not just randomness. I want you guys to think of trading like a ladder. Like every time you start a new system, you begin at level one. The more you execute the same system, the higher up the ladder you climb. You start noticing patterns, nuances, tendencies, and confidence grows. But here's the problem. Most traders keep switching systems, so they keep restarting at level one. They never get higher on the ladder and they stay stuck for years, something I unfortunately did for myself the first couple years of trading. You need to master one ladder and climb it all the way up to the top. And you guys have to journal all of your trades. This is literally the difference between running in circles and experiencing real calculated growth. Journaling is how you build confidence from data and not emotion. And when you record your trades, you start to see the patterns and you start to see probabilities that your brain would never catch on its own without documenting it every day. Almost every question you'll have about your system gets answered over time through a methodical journal. And it is the only way to strengthen your edge and adapt as the market changes. Markets evolve, participants change, and algorithms shift. And your journal is going to show you exactly what makes you money and also what doesn't make you money. And just so you guys know, later in this course, I'm going to give you a journaling template designed specifically for the ZenLab method. So make sure you watch out for that. So quick recap of today's lessons on how to use this system. You need to follow the order in which every video is created, take notes on everything, follow one system, show up to every live stream so you can see it applied live, and get ready for the journaling template when we hit the system section. This structure alone puts you so far ahead of most traders. I wish you guys understood, which you will soon. All right, that is the end of section one. Section two is Forex Foundation, so you guys understand why the market exists and how you can invest into it. So do not miss this next section and do not miss any video, skip any video, as they were all put in line for a certain reason. We're starting section two, which is all the foundations of the foreign exchange market. I'm not giving any complicated terms, nothing complex, and I'm going to, as simple as possible, give you the exact direction of why this market exists and how you can invest into it yourself. So let's get right into it. Forex is simply the global marketplace where currencies are exchanged. Nothing scary, nothing complex, just bank trades here, governments trade here, huge institutions trade here, and yes, you trade here too. Forex exists because the world runs on different currencies. Like if someone in the US buys something from Europe, a currency must be exchanged. If someone invests overseas, currency must be exchanged because Forex is the engine behind global money movement. And Forex is massive. Over $6 trillion are traded every single day, which is more volume than the stock market, the crypto market, and futures markets combined. Because of this insane amount of volume, Forex is extremely liquid, which just means that orders get filled quickly, price moves smoothly, and you don't get the wild gaps and random spikes you see in lower volume markets. And with that much participation, no single trader, group, or institution can manipulate the market long term. Short-term movements can be influenced, yeah, but the overall market structure is driven by global banks, governments, and massive institutions. And that's why Forex is so clean, predictable in behavior, and favorable for day traders. Price moves in Forex for the same basic reason anything moves, which is supply and demand. When more people buy a currency, it goes up, and when more people sell a currency, it goes down. And later in this series, we'll dive way deeper in liquidity, which is the real engine behind movement. In Forex, you're not trading individual currencies, you're trading currency pairs. And I'm going to break this all the way down into simplistic terms. But every pair is made up of two parts. You have the base currency and you have the quote currency. The base currency is the first one in the pair. You can think of it as the product you're actually buying or selling when you click the button. And the quote currency is the second one. It represents the price of that product. For example, in your USD, Euro is the base and United States dollar is the quote. So if your USD is priced at $1.10, that simply means it costs $1.10 to buy 1 euro. So when you buy a pair, you're betting against the base currency strengthening against the quote currency over time. And when you sell a pair, you're betting that the base currency weakens against the quote currency over time. You can think of the base currency like a burger. You're buying at a store, and the quote currency like a price tag. When you buy the burger, you're betting the item increases in value over the course of time. And when you sell the pair, which is the burger, you're betting the item decreases in value over the course of time. And that's really all Forex is. It's comparing the value of one currency against another. So Forex is a day trader's playground because it's so liquid. It moves cleanly due to so much participation and it being open 24 hours a day, 5 days a week. It respects price action levels very well. And the sessions create predictable volatility, which are the times that we trade. And plus, you don't need a huge account to get started because of leverage trading, which we'll talk about in heavy detail later on. Now let's talk about how you fit in this market. You are never moving the market ever. Retail traders combined make up less than 5% of the entire Forex volume traded on a day-to-day basis. But that's good. We use that to our advantage. It means our job isn't to move price, it's to understand where the big players are moving price, and that's where our system comes in a lot later. So for a quick recap, Forex is the world's currency market. It moves because of supply, demand, and liquidity. We trade currency pairs, not individual currencies. They're betting against each other. And it's one of the cleanest markets for day traders when you understand how it works. We're going to break down a topic that is widely misunderstood, especially by beginner traders, which is brokers. Exactly what they are, how they operate, and how you can choose a correct broker to remove so much headache and unnecessary losses just from being uneducated and falling into traps of fees and such that you don't understand. So let's talk about what a broker actually is. A broker is simply your access point to the Forex market. Retail traders can't trade directly with banks or liquidity providers, which we will speak more on later in this section. So the broker acts as the bridge. They give you quotes, execution, leverage, and a platform to trade on. But the big money in Forex moves on the interbank market. Banks, institutions, and huge players trading millions to billions of dollars at a time. And retail traders like us are just way too small to access that directly. So the broker steps in and they give you access. You can't send $5,000 trades directly to a bank that normally deals in millions. And so your broker bundles your order with other orders and sends a combined volume to the bigger market. Now, there are two types of main brokers. An A-book broker sends your orders directly to liquidity providers. The broker makes money from spreads or commissions. And then a B-book broker internalizes the trade, meaning if you lose, they profit. And neither are bad by default. They're just two different business models. And the problem is transparency, which is what we're going to get into right now. So let's talk about how brokers make money because they are obviously a business. The first way they make money is through spread. Brokers quote two prices, which is the bid and the ask. The bid is what you can sell at, and the ask is what you can buy at. The difference between the two is called the spread, which is one of the ways brokers make money. And it's usually just a couple pips or less, but with thousands of traders placing trades, that adds up pretty quickly. And don't worry, I'll explain exactly what a pip is later on in this course. So the spread is also why you are in profit the second you enter a trade. You have to cover the spread first, that's the broker's fee, before your position goes positive. Now, some brokers also charge a small commission every time you open and close a trade. This is usually on account types when the spreads are extremely tight. In those cases, the broker usually charges a flat fee based upon your position sizing. Let me put this a bit simpler. Your position goes into profit quicker and you just pay a set fee as you enter called a commission. It's transparent, it's very predictable, the number doesn't really change, and it's often preferred by active day traders. And another way brokers make money is through swaps. Swap is holding a trade past a certain time, which is usually 5 p.m. Eastern Standard Time, and you pay a small fee for the broker to carry your position on to the next trading day. Now, if you're a day trader, which we are, who closes positions the same session, swaps are not going to affect you. But if you swing trade or hold positions overnight, it's something to be aware of. And I'm going to explain the different types of traders later on, but with the system you will learn here, you're not really going to be dealing with swap fees. Now, there are a ton of bad brokers out there. If a broker slips your position heavy, which means that if you have a risk parameter set and it removes your position well beyond those parameters for a higher loss, or widens spreads during normal hours, maybe they refuse withdrawals, they constantly blame server issues or hide the regulation, probably should run away. That's major red flags. There is a reason why review websites like Trustpilot exist, so you can do your due diligence and see what others have to say about the broker before you invest. So make sure you use them. Let's talk about regulation levels. US regulated brokers offer more protection, but much lower leverage and usually higher spreads. And offshore brokers offer higher leverage and faster onboarding, but require you to choose very carefully. As someone who scalps and does not trade $1 million accounts like myself, high leverage is favorable to grow smaller accounts. And this is why so many people choose to trade offshore, but you must be more cautious because less regulation for shady businesses can turn into disaster for the investor. But both have pros and cons, but what matters the most is obviously transparency and execution. I want to talk briefly about the broker I personally trade with and why. They're fully FSCA regulated. They offer both raw spread and zero commission accounts. The fees are extremely competitive at $7 per lot, and you get access of leverage up to 1 to 1,000 if you choose it. And just so you know, US regulation only allows 1 to 50, which is 20 times less what they're offering with this broker. I'm going to speak way deep about leverage and how to use it in depth, but for now, just understand high leverage pretty much equals a ability to risk more with your capital. Now, withdrawals are usually same day, execution is immediate, and you can trade Forex, cryptos, indices, metals, and energies all from the same platform. And for me, one of the biggest factors is obviously 24/7 support. If you need any type of help, you're not waiting days for reply, which could obviously be very stressful if you have to do so. So this combination of regulation, low fees, flexibility, and execution speed is exactly why I use them. And because you're going through this course, they're offering something I've literally never seen them give publicly. 150% deposit bonus exclusive to this program only. This is not available on their website and it won't be given to the general public. It's reserved strictly for traders who complete the education and understand how to use leverage responsibly. Now, you will gain access to that later on, but we must get through the foundation first. Let's go through a couple misconceptions. When inexperienced traders continue to lose their trades, they try to claim the broker is hunting their stop losses, but you must understand your broker does not care about tiny accounts. Market structure and liquidity cause stop hunts. B-Book business models doesn't scream red flag. It's just another business model, but B-Book brokers who do not have the power to A-Book your trades if you are profitable is a major red flag. This is because if you're a profitable trader, there's no way for them to win long term as they mainly only profit off of you losing, which is obviously an issue. B-Book brokers need to have A-Book capabilities. And another misconception people has is that if a broker only offers crypto deposits, they must be sketchy. And that's simply just not true at all. A lot of reputable offshore brokers use crypto because it's faster, it's cheaper, it's global, and it avoids the constant issues with card processors blocking trading related transactions. It has nothing to do with being a bad broker. It's just the most reliable way to move money worldwide without having delays. And a lot of people hear the word offshore and they instantly assume the broker is unsafe. It's just simply not true. Offshore regulation simply means the broker operates in a jurisdiction with different rules, usually higher leverage, faster onboarding, and fewer restrictions. It doesn't mean the broker is bad. It just means you have to choose carefully, look at reputation, execution, withdrawals, and transparency instead of judging only by location. Quick recap, the broker is your gateway to the market, and understanding how they operate removes a huge amount of confusion and prevents many of the issues new traders run into. This video should have cleared up 100% of that for you. We're going to be talking about prop firms, which is an avenue that wasn't even around when I first started trading. Prop firms allow you to get meaningful capital without putting a lot of personal capital up front, but there is so much confusing around this topic as far as which one to pick, what they're actually doing, different business models, and so I'm going to break all of that down so there's no confusion moving forward when you decide if you want to trade with a broker or a prop firm. A prop firm is a company that allows traders to trade larger amounts of capital. You trade their account, you keep the majority of the profits, and they keep a percentage. It's a simple model that gives traders a path to scale. Prop firms exist because there are far more traders who want access to capital than traders who actually have it. So when traders perform well, the firm benefits too. If they perform bad, the firm can still benefit, which we will talk about later on in this section. Their model works best when they find disciplined, consistent traders. There are two common prop firm models. Some firms route or hedge funded trades in the real market, and others use an evaluation-based model where trades aren't routed live, but payouts come from the firm's internal business structure. Most firms today operate on the evaluation model, and some will even transition profitable traders into live or hedged capital once they see a longer track record. Similar to how a broker may move a trader from B book to A book once they show some consistency. Both models are definitely legitimate. There's simply different ways to run a funding company. And what matters the most is transparency and consistency. So let's talk about how prop firms make money. They mainly make money from evaluations, which is the fee that a trader pays to attempt a challenge to get capital. Then, once the traders are funded, the firm earns a percentage of the profits if they have that type of business model. Some people argue prop firms can be unfair as they make money when traders fail, but the reason most people fail is lack of discipline, not because the model is unfair. And we'll speak more on this later on in this video. So here's how prop firms work. You take a challenge, which can be up to 3 phases before gaining funded capital. Once you hit targets in each phase without breaking rules, you show the firm you are consistent and ready to trade funded capital. Then once you're funded, you trade the firm's capital and withdraw actual profits, and you rinse and repeat. Now, taking a challenge is the traditional way that prop firms first started with. As prop firms have operated for over a decade now, they've gathered enough data to understand the profitability and risk behind funded traders. And because of this, many firms now offer instant funded accounts, meaning you can start trading funded capital immediately without ever taking a challenge. These accounts usually come with slightly stricter rules, but the trade-off is speed. No evaluation, there's no multi-phase challenge. You begin funded on day one. You trade the firm's capital, follow the rules, and withdraw real profits. Rinse and repeat. It has literally never been easier for disciplined traders to scale their capital. Now, this is why traders use prop firms. Prop firms allow traders to grow faster because you can trade meaningful capital without needing a huge personal account. You keep most of the profits, and the structured rules help build discipline long term. But there are a lot of misconceptions about prop firms, so let's clear a few of them up here. No, prop firms do not want you to fail. Evaluation fees alone don't sustain a company long term. If nobody's ever getting paid out, nobody would continue taking evaluations. And firms need successful traders. They're great for marketing, and if the firm transitions profitable traders into live or hedge capital, profitable traders are another source of income for the business. And no, the rules aren't designed to trap traders. Every prop firm has risk parameters, and they exist for the same reason brokers, hedge funds, and banks use them to protect capital from reckless behavior. Daily drawdown, max drawdown, consistency rules, and lot size guidelines aren't obstacles, they're filters. They help the firm identify traders who can manage risk, stay disciplined, and treat trading like a profession instead of like a casino. And another misconception is that prop firms manipulate the market feed. They don't do that. You're trading in a simulated environment that mirrors live pricing, spreads, and volatility from their liquidity providers. And no, evaluation-based funding doesn't mean the capital is fake. Your payouts are very real. It's simply a different business structure where the firm manages risk internally instead of routing every trade to the live market. Now, as part of this course, the prop firm I partner with is giving every single student who completes the training a free 25K challenge. I push for this because the biggest problem prop firms face is uneducated, undisciplined traders rushing into challenges without understanding risk or structure. By bringing them traders who complete this blueprint, they know they're getting people who understand the rules, respect risk, and trade with the system. So in return, they agreed to offer a 25K challenge to every student who finishes the course, which is huge because it removes a financial barrier to get started. You get a safe way to apply everything you've learned with the real payouts, and the firm gets traders who actually know what they're doing. It's a win-win, and I have never seen it in any other trading course, so I'm very excited we were able to secure it for you. At the end of this course, I'll show you exactly how to claim it. It's very simple. So quick recap. Today you learned exactly what prop firms are, how they operate, how funding works, and why disciplined traders benefit the most from this model. We've also cleared up the biggest misconceptions and showed how this course sets you up to take full advantage of prop firm funding. This is video 8, and we're going to be talking all about liquidity. Once you understand liquidity, you understand why breakouts happen, you understand why market reversals happen, and you understand why price moves the way that it does. This lesson is a foundation for everything that comes next in this course, so make sure you guys lock in, and I'm going to break down liquidity in its simplest form so there's no confusion around it. Liquidity is simply the amount of buy and sell orders in the market. Even simpler, liquidity is every order placed by market participants. If you buy, that's liquidity. If you sell, that's liquidity. The more orders sitting in the market, the more liquid the market becomes. A more liquid market means price can move easily and smoothly because there are plenty of buyers to pair with sellers on both sides. Price needs liquidity to move, and if no one is buying and no one is selling, the market simply does not move. Price doesn't move because of indicators. It doesn't move because of lines on your chart. Price moves because orders are being filled, and liquidity is the fuel that makes that happen. Indicators and patterns don't move the market by themselves, but they influence people to place trades. Those trades create orders, and those orders are what actually move price. Think of it like a traffic light. The light doesn't move the cars, the drivers do. The light just tells people when to go, and in trading, indicators are the traffic lights. Orders are the cars, and if there's no cars, there's simply no movement. Liquidity is provided by banks, institutions, market makers, and large financial entities. These are the players placing those large orders that actually move the market. And if you remember from our brokers section, we talked about how brokers connect retail traders like yourself to liquidity providers. Without brokers, retail traders wouldn't be able to participate because banks and institutions don't deal with small orders. The interbank market trades in massive size, millions at a time. So your broker combines thousands of small retail orders into larger ones and routes them to liquidity providers. That's what makes retail trading possible. So retail traders react to price while institutions create price movement. Because institutions trade such large size, they need liquidity to enter and exit positions. They can't just buy or sell whenever they want like we do because they need orders to be on the other side of their buy. They need sellers on the other side of buys, they need buyers on the other side of their sells. So liquidity tends to build in predictable places, above highs, below lows, and around obvious levels. And why? Because that's where most traders place their orders. Above highs is where buy stops and breakout buys sit, and below lows is where sell stops and breakdown sells sit. So around obvious levels is where traders place entries, stop losses, and take profits. When a lot of orders are sitting in the same area, liquidity builds up right there. And price is naturally drawn to these areas because that's where orders are. When price moves fast, it's usually because liquidity is thin. Or in other words, there's not much orders close to where price is currently at. So once a pool of orders gets cleared, price can move aggressively until it finds the next area of liquidity or the next area of orders. Think of it like this. When a room is crowded, it's hard to move fast. But once you get into an empty hallway, you can walk freely. Liquidity is the crowd. When price clears a crowded area of orders, it enters open space and moves very quickly until it reaches the next group of orders. Markets tend to reverse when liquidity gets filled. So once the available orders are absorbed, price has no reason to keep moving in that direction, so it looks for the next pool of liquidity. You can think of the market's job as constantly searching for orders to fill. If there are more orders waiting in the same direction after liquidity is taken, price will continue moving and expand towards that next level of liquidity. But if there are more orders waiting in the opposite direction, price is going to reverse and move quickly towards that next pool instead. This is why timing matters so much. Liquidity shows up differently depending on the session, but London and New York sessions bring the most global participation, which is why we see the largest and most consistent moves there. It doesn't mean the price doesn't move during Asia. Asian session pairs and indices like JPY pairs or Japan 225 indice can definitely move with strength during that session. The difference is that London and New York bring broader institutional participation across more markets, which creates deeper liquidity and cleaner expansions. So now you should understand liquidity is not manipulation like many people think. There's no such thing as getting faked out. Stops are just orders, limits are just orders, stop losses are just orders, and target levels are just orders. If you don't know what those are, don't worry. Those terms will be fully covered later on in the course. But price is not hunting your specific orders. It's simply seeking a high pool of orders. Once you understand this, trading becomes a lot less emotional. Liquidity is simply what allows price to move. Institutions need it to trade, price seeks it, and understanding this explains breakouts, reversals, and timing. Price can move at any time, but the quality of movement depends on who's active. Today, you're going to be learning about when that liquidity shows up and when price moves. Because you can have the best setup in the world, but if you're taking it during the wrong time period, it has a way lower probability of playing out. This lesson alone is going to eliminate a ton of bad trades because we're going to break down the trading day and when volume and liquidity actually enter the market the most. Forex trades 24 hours a day, but that does not mean every hour offers the same opportunity. Liquidity definitely comes in waves. It's not really even. The trading day is split into three main sessions, which is Asian session, London session, and New York session. And each session has different participants, different volume, and different behavior. Asian session opens at 7 p.m. and closes at 4 a.m. Eastern Standard Time, and it usually has lower overall liquidity compared to London and New York because it ranges and consolidates during that time period, especially non-Asian pairs. But that doesn't mean you can't trade Asian session. And if you use Asian instruments like JPY pairs or Japan 225, which is the indices for that time period, it can move very well during that session, which we'll talk about indices in another video. London session opens up at 3 a.m. and closes at 12 p.m. Eastern Standard Time, and this is where liquidity really starts to enter the market. European banks and institutions come online and volume increases really fast compared to Asian. And this is why we often see breakouts and strong directional moves start here and work very well during that time period. And New York session opens at 8 a.m. Eastern Standard Time and closes at 5 p.m. Eastern Standard Time. And it by far has the peak liquidity versus all other sessions. US institutions enter, and this is where we often see the biggest moves of the day, either continuation or very sharp reversals. And again, this is where the most participants are in the market at once. I want to clear something up to you guys because people mix this up literally all of the time. New York session opens at 8 a.m. Eastern Standard Time. That's when US banks and institutions and liquidity providers come online. But New York Stock Exchange open happens at 9:30 a.m. Eastern Standard Time. That's when the US stock market officially opens up. They're definitely not the same thing. The NYC Open simply just adds more participation, more orders, and more volatility. And I'm sure some of you guys noticed from the times of the other sessions that sessions do overlap, especially London, New York. Liquidity is at some of the highest levels during that time period. It's when institutions are the most active, so you'll get very clean moves during that time period as well. Now, many traders lose not because their strategy is bad, which obviously can be the case too, but because they trade during low volume hours. Low liquidity leads to chop, it leads to fake outs and leads to frustration because think about it, there's less participation. As you guys know, volume and participation are just simply more orders. But there's less orders, there's less decision as to where the market's going to go. And so that leads to consolidating sideways movement, which is why breakouts don't work nearly as good during that time period. Now, as you guys know, our system does focus on high volume periods because we're breakout traders. So we need liquidity to expand. So trading when institutions are most active is going to give your setup a lot better likelihood of playing out. So for a quick recap, Forex does trade all day, but liquidity comes in sessions. Understanding when volume enters the market instantly improves trade quality and consistency for yourself. Markets can move in any session. The difference is the quality of the movement, and that depends on how much volatility is in the market. So far, we've talked about liquidity, sessions, and timing, but now we need to talk about what you'll actually be trading, which is currency pairs. Picking the right pair can make trading a lot easier, but picking the wrong pair can make trading a lot harder than it has to be. So let's go ahead and break down currency pairs in the simplest way possible. In Forex, you never trade a single currency. You're always trading one currency against another currency. When one currency strengthens, the other one weakens. We spoke about this heavy in video 5, which is what is Forex, so we'll briefly retouch base here. The first currency in the pair is the base. The second currency is the quote. The price simply tells you how much of the quote currency it takes to buy 1 unit of the base currency. When you buy a currency pair, you're betting that the base currency strengthens over time. And when you sell a currency pair, you're betting that the base currency weakens over time. That's literally it. There's nothing more complicated than that. Currency pairs are grouped into majors, minors, and exotics. And the difference comes down to 3 things: how many people trade them, how expensive they are to trade, and how stable they move. Major pairs usually have the most volume, they have the tightest spreads and the cleanest price action. Minor pairs usually has less volume and slightly wider spreads. And then exotic pairs have very low volume, very wide spreads, and unpredictable movement. So that's why beginners choose to usually trade major pairs. Currency pairs tend to move best when their home markets are active. Think of it like a store. Like when the store is open and busy, there's movement everywhere, but when it's closed, obviously nothing happens. Currencies behave the same exact way. They move the most when their markets are open and active. Therefore, matching the pair to the session improves liquidity and trade quality. So for USD pairs, you should be trading New York. For GBP pairs, you should be trading London. And obviously for Asian pairs, you should be trading Asian session. Now, regardless of what currency pairs you choose to trade, now you understand the ones that have a higher likelihood of profitability just due to having more volatility. And you understand which times to trade them if you have to merge that to your schedule. But in this course, we want to keep things simple and very effective. So fewer pairs means better familiarity, obviously better data, and a lot more consistency. It's like training for a sport. You're not going to master every position at once. You need to specialize. And trading fewer pairs lets you specialize, build pattern recognition, and execute with confidence. So to recap, currency pairs compare two currencies. Buying means strength and selling means weakness, and major pairs offer the cleanest liquidity, especially when matched with the right session. So far, we've talked about Forex, sessions, liquidity, and timing. And today we're going to be talking about indices, not because they're better than Forex, but because they simply move a bit differently. Understanding these differences could help you choose what best fits your trading style. And even though indices are in a different market, the core concepts of the system are still the exact same. Prices move from liquidity, sessions, and volume, and that does not change within indices. All that changes is what you're actually trading. This lesson is going to explain a lot for you guys, especially if you trade New York Stock Exchange Open with me. So let's go ahead and break down indices in its simplest form. So first things first, an index is simply a basket of stocks grouped together. Instead of trading one company, you're trading the overall performance of a market or a sector of companies. These are some of the most commonly traded indices, and each represents a different group of companies, but they all move based upon broad market participation. So US 30 is the top 30 US traded companies. NAS 100 is the top 100 US traded companies. SPX 500 is the top 500 US companies. GER 40 is the top 40 German companies, and then UK, as you can probably guess, is the top 100 UK companies. The indices are heavily driven by institutions, but they respond strongly to economic data, sentiment, and session opens. Now, Forex measures the value of one currency against another. Indices measures the performance of an entire market. Neither is better. Both follow momentum and price action well because the foundation that drives all markets is the exact same, which is liquidity. They're simply different markets with different reasons for moving. Now, I personally added indices because they align better with my timing when I trade in the market. Around the New York Stock Exchange Open, volume enters really quick and price reacts cleanly. Nothing magically changed. Results are the same as Forex. It simply matched how I trade because things develop a lot quicker. My trades began reaching outcomes 2 to 3 times faster, which for an experienced trader means way less time on the charts. Now, that speed can be a benefit, but it's important to understand it also comes with intensity. And for beginners, fast movement can be psychologically challenging, which is why structure and risk management matter even more trading indices. When New York Stock Exchange opens, stock market volume hits the system. There's literally no period of higher volume than New York Stock Exchange Open, especially when you're trading US indices. And that added participation often leads to strong breakouts or clean reversals at a rapid rate. Just to say the obvious here, Forex obviously and absolutely still works. And I still trade Forex, especially outside of New York Stock Exchange Open. It's not the indices are better, they're simply just different. In fact, many beginners struggle with indices because price can move so much faster than Forex when using this system, which is why I recommend starting with major Forex pairs, but the goal isn't to push one market over another. It's to understand multiple markets so you can trade what fits you best. Let's talk about access. Traders access indices either through futures markets or through prop firms or offshore brokers. It's simply a difference in product structure and regulation. The broker partner with this course offers access to indices as well. So once you do complete the course and receive the deposit bonus, you'll have the flexibility to trade whichever market fits you best based upon what data you discover for yourself. For a quick recap, indices represent entire markets, moves with institutional participation, and react strongly around New York Stock Exchange Open when you're trading US indices. They're different from Forex, but we trade them using this system the exact same way. Speed of trade outcomes and the time you are able to trade the market with your schedule will be the factors that decide which market fits you best. We're going to be talking about spreads, commission, and slippage, and how they directly affect our style of trading, especially using breakouts and volume. As soon as you do understand these terms and how they are applied to our trading, your execution is going to immediately be improved. This video is not about definitions, it's about how these costs affect our real trades. So your first execution cost is spreads. Spreads is the cost you pay the moment you enter a trade. In breakout trading, tighter spreads matter because they reduce friction at entry. High liquidity usually means tighter spreads, so that's another reason why we always want to trade during high volume liquidity periods. Commissions are fixed costs. They don't change volatility, but they do add up when you trade larger lot size or trade frequency. This is why proper position sizing and focusing on quality setups matters way more than overtrading, because every trade carries risk, and repeatedly entering and exiting without meaningful changes in your idea can cause commissions to quietly eat away at your account. Now, slippage, which is the new term, happens when price moves faster than your order can be filled. So let's say you click buy or sell, but price moves before that order is completed, so you get filled at a different price than you initially wanted to get filled at. That means you got slipped out of your position. This is most common during low liquidity or sudden spikes like news events, when there aren't enough orders available at your exact price, so it gets closed at a different price than you wanted it to. Now, trading during high volume sessions reduces slippage a lot because there are more buyers and sellers available to fill your order quickly at the price that you want it. That is why our system focuses on high volume periods, because liquidity proves execution, because there's tighter spreads, less slippage, and cleaner fills. So good timing protects your edge. Many traders blame their strategy when the real issue is just simply execution. Trading breakouts during low liquidity hours leads to worse fills and unnecessary costs. So please make sure you guys are only trading during high volume, which is during session times. So to recap, spread, commission, and slippage directly affect your execution. You should understand exactly how. And if you're trading during high liquidity periods, high volume periods, that is simply going to reduce costs and protect your edge trading this system. We're going to be breaking down volatility in the markets. It's a big reason why a lot of days feel effortless while other days feel damn near impossible to trade. This is a lesson where a lot of traders realize that the market wasn't against them. They're just not adjusting based upon what volume is being injected in the market during that time. And this can all be calculated. It's not something we have to guess, and we have a tool to be able to do so. Volatility simply describes how fast price is moving and how far it has moved. So some days price barely moves, and other days price moves extremely aggressively. The market environment changes every single day, even when your setup stays the same. This is why if you have the same stop or target, it can work perfectly one day and then fail the next couple of days. There's not really anything wrong with your rules. The environment has just changed. And most traders don't account for this, and that's where frustration starts. As scalp/day traders, you have to change with the ever-changing volatility in the markets. The good news is volatility is not random. It can be measured. And later in this course, I'll show you how we use the average true range, which is just the ATR, when we get to charting to adjust stops, targets, and expectations based off of current market conditions. That's how you're going to remain consistent regardless of what volatility is in the market. A quick recap, volatility changes how price moves. It affects stops and targets and explains why trades feel different day to day. It's because there's different volatility on a day-to-day basis. And later on in this course, we're going to use the average true range indicator to adapt on a day-to-day basis instead of guessing. And I'm going to give you guys that indicator for free, which is paired with a couple of other things that will help you follow this system even cleaner than you're already going to be able to do so, because you're going through every video in order. Volatility changes how price moves, and it definitely affects our stops and targets and explains why trading's a bit different day to day. As you guys know later in the course, we're going to be able to measure it using the ATR tool, which we'll talk about later on. A quick question for you. Have you ever followed somebody else's system and thought, why does this work for them, but it doesn't work for me? That's usually not a strategy issue, it's a fit issue. Trading is just not a one-size-fits-all. Different styles require different psychological strengths, and ignoring that is where a lot of traders struggle. Today we're breaking down the different types of traders and how your psychology plays a role into what best fits you. So let me ask you this, if you're holding a trade overnight, does that make you nervous? Like, are you checking your phone or thinking about gaps or news or what price might do while you're asleep? Because if that does stress you out, longer term trading styles may not be a good for you. And second question, If you take a few losses in a row, does that completely mess with your confidence? Or are you able to stay calm and trust the process? Because some trading styles naturally come with more frequent losses, and not everyone handles that so smooth. So let's talk about the three main types of traders. Scalping is the first type of trading, and it focuses on very short-term moves. Traders are in and out quickly, often taking multiple trades within a single session, and that style requires focus, fast decision making, and comfort with frequent wins and losses. Day trading also looks for moves that develop within a trading session, but they're not as frequent. Trades are open and closed on the same day, avoiding overnight risk, and that style balances structure with opportunity and is well suited for session-based strategies. And then swing trading focuses on larger moves over longer periods of time. Trader holds positions through pullbacks and overnight risk, sometimes multiple days, even a full week. And this style requires patience and emotional comfort with holding trades longer. And like we spoke about earlier, even holding trades when you're sleeping. So neither is better, they just test you a lot differently. For me personally, I don't like holding trades overnight. It kind of makes me uneasy. I find myself checking trades during the night or thinking about them instead of resting, which can lead to premature decisions. And at the same time, I'm comfortable taking multiple trades within a session, even if not all of them win. I actually prefer being engaged during active market periods rather than waiting days between opportunities for my trades to unfold or waiting for the next opportunity. And when I tried swing trading, I just found myself forcing trades during slow periods because lack of participation didn't fit my personality. And so that's why my breakout style day trading during session open fits me personally so well. Most traders struggle because they copy someone else's style without considering their own psychology. When the fit is wrong, even a good strategy feels impossible to execute consistently. The goal is to trade an edge, not your emotions. And ignoring your own psychology makes emotional trading far more likely, which is why understanding what fits your personality is just so important in this game. So to recap, the right trading style depends on how you handle time, losses, and stress. When your style fits your personality, consistency becomes much easier. Up to this point, you guys have learned a lot about how price moves, why price moves, and the different types of traders. Now comes the most important decision, which is seeing how you fit inside of this market. This video sets the foundation for everything that's going to come next. Before psychology, before building the system, you simply just need clarity. Not every market to trade, not every style to trade. You just need a lane to start with so you can start progressing. Everything we covered in this section was completely intentional, not to overwhelm you, but to give you context. Most traders jump straight into strategies without ever understanding how markets work or when they move or how their own psychology fits into this equation. That's why they stay confused, inconsistent, and constantly searching for the next answer. This section was designed to slow that process down a little bit, to give you enough understanding to make an informed decision, not based on hype, not based on what someone else is trading, but based on what actually fits you. When you understand the environment you're trading in, your decisions become clear and everything that comes next becomes easier to execute. Now, no need to fear, this doesn't have to be a permanent decision. It's simply a starting point. You're not locking yourself into one style forever. You're choosing a direction so you can actually start to build momentum. And right now, the goal isn't to trade everything or master every approach. The goal is to choose a style you can execute consistently today and start gaining progress. Consistency comes from repetition, and repetition only happens when your trading style fits your schedule, your psychology, and your ability to stay focused. Once that foundation is built, adapting and expanding becomes a lot easier. A lot of traders fail because they stay flexible for too long. Flexibility feels safe, but it actually delays progress even though it feels like you're progressing. Commitment builds confidence. Sticking to one market during one session and executing one system without merging others is the fastest and most efficient way to develop a real edge. I promise you guys from true experience, you do not need to trade everything. You need to trade what fits your time, your psychology, and your ability to stay focused. That's how consistency starts. So I challenge you guys before the next session, choose your trading identity, commit to it, and if your goal is to day trade or scalp during active sessions, you are in the perfect place to begin building a real edge with this system. Before we close out this section and get into the actual psychology behind the market, we're going to be speaking the same language as price and talking about candlestick charts. Every breakout, every reaction within the system is built off of a candlestick chart. I'm going to break that down as simple as I possibly can so you guys understand how to use them. Candlesticks are simply a visual record of price over a specific period of time. It shows where price has opened, where it closed, and how far it has traveled in between. Nothing more than that. So let's dive into the anatomy of a candlestick. First, we're going to talk about a bullish candle, and it is made up of a candlestick body, and it is made up of top and a bottom wick. What this is indicating to you is where price has opened up, which is going to be at the bottom of that candle. It's showing that at some point it created an ultimate low, which is that bottom wick. And at some point it created a ultimate high, which is that top wick. And then it closed at the top part of that candle. The reason why it is a bullish candle or it created buying momentum during that time period is because it closed higher than the candle had initially opened up. Now, the same thing goes for a bearish candle. It's still made up of a candlestick body. It has a top wick and a bottom wick, but what makes it a bearish candle, which just simply means there was higher selling momentum during this period of time, is price opens up at the top of that body. At some point, it creates an ultimate high at the top of the wick. At some point, it creates an ultimate low at the bottom of the wick, and then it closed lower than that open. That's how you know during that set period of time, there was more selling momentum than buying pressure. So to simplify this, the body of the candle tells you who controlled that period. If price closed higher than it opened, buyers had control. And if price closed lower than it opened, then sellers has control. This is simply pressure, it's not prediction. And then wicks show where price has tried to go and it failed. They represent rejection, hesitation, and absorption of orders. And this becomes very important later on when we talk about support, resistance, and breakouts. Each candle represents price movement during a set period of time. And later on in this course, we will dive deep into what time frames used for the system. But for now, I want to keep it basic. The anatomy of a candlestick remains the same on all time frames. They just represent different spans of time. I also want you to understand no single candle means much by itself. Candles really gain meaning when they interact with levels, timing, and momentum. So as you see here, a 5-minute candle just simply represents 5 minutes of price action. A 15-minute candle simply represents 15 minutes of price action, or 3 5-minute candles. And a 1-hour candlestick just simply represents obviously 1 hour of price action. We don't use candlestick patterns in the system, so we're not going to dive deep into patterns that some traders use with candlesticks alone. We use candles to understand participation, rejection, and momentum, not to guess the future. And everything you'll see moving forward, whether it's breakouts or rejections, confirmations, is all going to be expressed through a candlestick chart, which is just simply a chart made up of a whole bunch of candlesticks, because this is a language that price uses. So to recap, candlesticks do not predict price. They're simply the market's history. And we use that market's history to predict what's going to happen next, because as you know, history does tend to repeat itself. Up to this point, we've spoken all about the foundations of Forex. You know exactly why the market exists in the first place and how you can invest yourself. Now we need to talk about the part that actually decides if you're going to succeed or fail once you start risking real capital, which is psychology. And this is not something to fix later down the road. It's something we're going to get under control now. So when you start risking real capital and these things do pop up, you understand exactly what to do with it. So let's go ahead and get started. Most people think trading psychology is about staying calm or confident during your trades, but in reality, it goes way deeper than that. Trading psychology is about how you behave under uncertainty. And throughout this entire section, we're going to break down what psychology in trading actually consists of and how to keep it in check as you continue to strengthen your edge. Psychology shows up in such small behaviors like hesitating, adjusting your stops, exiting early, or forcing trades. And these moments may feel small, but they compound heavy over the course of time. At its core, psychology comes down to one thing, which is uncertainty. The market doesn't owe you guys anything. There's no trade that's guaranteed. There's no setup that has a fixed outcome, and no amount of analysis removes uncertainty entirely. And honestly, most traders don't struggle because they lack knowledge or a system. They struggle because they want certainty in an environment that does not offer it. Learning to operate without needing certainty is what separates consistent traders from emotional ones. You really can have a solid strategy and still lose money. Not because the strategy failed, but because execution broke down the moment pressure built up. That breakdown is psychological, not technical. And most losses come from psychology leaking in decision making, not from actual bad rules or a bad system. Now, this section is not about eliminating those emotions. It's about building rules and habits that prevent emotions from controlling your decisions. So quick recap, trading psychology is not about eliminating feelings. It's about controlling behavior. Fear, excitement, frustration, those are all normal, but what matters is how you react once they show up. Most traders don't build their account because of lack of knowledge. They build their account because they quietly let three emotions take over all of their decisions, which are fear, greed, and revenge. Now, don't get me wrong, having a solid system definitely matters, but no one's staying profitable if they don't have their psychology in check first. So that's why this section exists. We're going to be talking about these three emotions and how they show up in your trading, but also how to not allow them to sabotage your edge. So the first one we're going to talk about is fear. Fear doesn't always feel like panic, and most of the time it disguises itself as being careful or disciplined. It shows up as hesitating on entries. Like even when the setup is there, you wait for one more confirmation, then another, and before you know it, the move is already gone. It also shows up as taking profits too early, not because the plan says to, but because you're afraid the market will take it back. And it shows up as skipping setups you know you should take simply because the last trade didn't work out. Fear convinces you that avoiding discomfort is the same thing as managing risk, but they are not the same. And over time, fear is not going to protect your account, it's going to slowly destroy your edge. Greed shows up when one win just isn't enough. It's the feeling that you need more, like more trades, more size, more profit, even when the plan has already worked. It pushes you to take extra trades after a win, not because the setup is there, but because you're chasing the feeling of being right. And it shows up when you hold past your target, ignoring your plan because you want to squeeze a little bit more out of the move. And it shows up when you increase size without justification, not because risk allows it, but because confidence turns into overconfidence. Greed convinces you that momentum will last forever, but when you trade for more instead of trading your plan, you're no longer executing an edge, you're gambling on emotion. Revenge just comes from urgency. It's the need to make back a loss quickly, not because the setup is there, but because the loss feels personal, or it shows up as jumping back into the market immediately after losing trades. Rules get loosened, your risk gets increased, and patience disappears. Because revenge convinces you that speed will fix the damage, when in reality, it usually just multiplies it. This is one of the most dangerous emotional states in trading because it removes pause and replaces it with impulse. So once urgency takes over, you're no longer trading the market, you're reacting to your last outcome, which is emotional trading. Now, these emotions don't hurt you just because they exist. They hurt you because they change how you behave. They push you into emotional decisions instead of data-driven ones. And the moment your decisions stop coming from rules and data, that is when your edge disappears. So the first step to fixing this is not control, it's just awareness. Once you can spot these emotions showing up, you regain your choice back. Now, this probably sounds obvious, but most traders don't recognize fear, greed, and revenge until after the damage is already done, when they're already in a bad trade or breaking rules. And many traders even mistake that late realization for progress, telling themselves to do better the next time. That cycle is exactly why the psychology section comes before the system itself. Awareness creates a pause, and that pause is where discipline lives. If you can recognize an emotional state before you act on it, you give yourself the chance to respond instead of react. So to recap, fear, greed, and revenge are never going to disappear. They're just going to change form. You need to learn how to identify them early, and that is going to heavily change your execution. We're going to talk about how to contain them, not with willpower or motivation, but with rules using discipline. A lot of traders misunderstand discipline because they think it's about being strong or calm or emotionally controlled. But it's not that at all. Discipline is not about how you feel. It's about what you do despite those feelings, because structure beats willpower. Discipline is not about fighting emotions. You're going to feel fear, greed, and frustration literally no matter what. Discipline is about having rules that function even when emotions show up. Rules are going to remove decision making in the moment. They define your actions before emotion ever gets a chance to get involved. Now, when fear, greed, and frustration show up, you don't need to think, you already know what to do. That's how rules are going to protect you from your edge. They don't make trading easier, they make it consistent. And consistency is what keeps your edge intact over time. Rules are like guardrails on a highway. They don't stop you from moving forward, they stop you from driving off a cliff when things get fast. Rules feel restrictive at first, but freedom in trading usually leads to emotional decision. Structure creates consistency, consistency creates usable data, data builds confidence, confidence reinforces execution, and over time, execution is what creates a profitable trader. Now, real discipline doesn't show up in big amounts. It shows up in small ones. It's waiting for your session instead of forcing trades out of boredom. It's passing on setups that almost fit. And it's stopping for the day when your rules say stop, even when you want to keep going. These actions don't feel exciting. They don't give instant gratification, but they are what protects your capital, your confidence, and your edge over time. So now you should understand discipline is not willpower, it's structure and rules that protect your edge when your emotions want control. Most traders think risk to reward is about making more money, but it's not at all. Risk to reward is about emotional stability, it's about removing pressure, it's about accepting losses before they even happen, and removing the need to always be right. Once you truly understand risk to reward, losses become a lot less personal and trading gets a lot calmer, objective, and more consistent. And that's what this video is all about. Risk to reward is not a strategy itself, it's the framework to allow your strategy to work out over the course of time. Risk to reward simply compares how much you're willing to lose versus how much you're aiming to make, and is defined before you even enter a trade. Most traders think that good trading means winning most of the time, but that's not how profitability-based systems work. With proper risk to reward, you can be more incorrect than you are correct and still be profitable. That is extremely important to understand, so I'm going to say it again. With proper risk to reward, you can still be profitable by being incorrect more than you are correct. And that is why risk to reward literally changes everything. Risking one to make one, you at least need to be correct 50% of the time in order for you to survive. But at a 1 to 2, you only need to be right about 1/3 of the time. At a 1 to 3, you can lose 3 trades for every winner and still be profitable. And at 1 to 4, that drops to 20%, meaning you only need to be correct 20% of the time to be profitable. And at a 1 to 5, risking 1 to make 5, you only need to be right around 17% of the time. So out of 10 trades, if you win 2 of them, you are in profit through that period of trading. So that's why good traders are not obsessing over win rate, they focus on higher risk to reward. When risk to reward is correct, you stop needing every trade to work. It's like running a production line. You don't expect every unit to be perfect. You price and plan knowing that some will fail. As long as successful output outweighs the waste, the business works. Losses are not mistakes, they're built into the process and they're also unavoidable regardless of what system you trade. One thing to understand is when your risk is undefined, anxiety controls the trade. But when risk management is clearly defined before entry, most of that anxiety disappears because you're no longer guessing, you already accepted the possible outcome. Most traders understand RR logically, but break it emotionally. And that's why discipline and rules had to come first before this video. Now, once you accept risk and stop focusing on individual outcomes, something really important changes. Trading is no longer about any single trade. It's about a series of trades where profitability plays out over time. This is where journaling becomes non-negotiable because data is the single most important factor in building a long-term edge. It's because data tells you what works more often than not. It tells you when to press the button, when to pull back, and what to stop doing entirely. And without data, you're trading off emotion, memory, and isolated outcomes. But with data, you're trading off of real evidence. So that's why later in this course, I'm giving you guys a full journaling template designed specifically for this system so you can track what actually matters and build confidence from proof instead of hope. Risk to reward isn't about being right, and it's not about making more money. It's about staying emotionally stable long enough for probability to work. That is where data changes everything, because when you journal properly and collect data, executing risk to reward becomes a lot easier because you're no longer guessing or hoping. You've seen how your system performs over the course of time. Data removes doubt, and doubt is what causes most traders to break the rules and trade emotionally. We're closing this section out by talking about how traders stay stuck and how they're constantly switching systems, and why real progress only comes from committing to one approach long enough to allow for data and probability to compound. Most traders don't fail because their system doesn't work. Most traders fail because they don't stick to one system long enough to find out if it actually works or not. It's like going to the gym and changing your workout every single week. Obviously, you're not going to get any results or real progression. This video is about ending that cycle. Constantly trading strategies does sometimes feel productive because you're learning, but in trading, flexibility without data is just resetting your progress over and over and over again. Every time you switch systems, you erase your data, and without data, confidence cannot form. Because confidence in trading does not come from belief, it comes from real evidence. And when confidence is missing, execution obviously starts to break down, which means you hesitate, you're second guessing, you're overriding your rules, you're simply just trading emotionally. And like we talked about earlier, you start adding more to a system instead of defining what you already have. Not really because you're undisciplined, but because you don't trust what you're doing yet. And that trust can only come from applying the same system repeatedly and seeing how it performs over time. I will speak about how this was my biggest hindrance later on in this video. Now, edges are not built overnight. They're built through repetition, consistency, and data over time. And that only happens when you commit to one approach long enough to understanding it deeply. It's like shooting free throws. You don't get better by changing your form every day. You repeat the same motion until it becomes automatic. And once that foundation is mastered, then you can begin refining and adding discretion, which we're going to break down in the next section. And this isn't a lifetime decision, it's a starting point. You commit long enough to gather data, build confidence, and gain control, then you adapt from a position of strength instead of just being all over the place. So this course is structured this way on purpose. We started with psychology, because if your mindset isn't right, no system will survive. Then we build discipline and rules so emotions don't leak into execution. And then we introduce risk to reward, so probability replaces pressure. And finally, we're going to reinforce everything with data because proof builds confidence. And now once those foundations are in place, it makes sense to talk about execution and system rules, but this order is not random. I think one of the biggest mistakes I made in my personal career is strategy hopping. I spent years jumping around between system to system instead of becoming profitable by strengthening one of them. That's exactly why the system is structured the way it is, because first we figure out what your personality is, because no system's gonna work if it doesn't fit you. Then we broke down trading psychology so emotions don't sabotage your execution. Then we covered discipline, risk to reward, and data because that's how you execute one system consistently and then refine it over time. None of this is random, and this is going to be your fastest path to building real confidence and gaining an edge in the market. Over the last decade in this industry and the last 4 years of teaching, I've figured out exactly what works for myself, also what works for students, and what doesn't work when it comes to learning, executing, and becoming profitable. And everything in this course, the order, the structure, the pacing, was all made with that in mind. And so by the time you trade live capital, you're going to be as prepared as you possibly can, intellectually and psychologically. And you're not doing this alone. You can literally watch me trade all of these same concepts every single day while you're gathering data of your own. So now without further ado, this section is now completed. In the next section, we're going to stop talking about why trading works and start getting into the actual execution by you learning the Zen Lab system on the charts. We begin with the mechanical foundation, so you're going to have very clear rules in structure and execution. Then later on, once the foundation is built, I'm going to add discretion into the puzzle too. This is where everything comes together because you're going to learn how to trade the system in the charts. And if this section clicked for you, make sure you guys are commenting down below. I read every last comment that comes to this channel, and it helps me know what to go deeper on with things you guys potentially will be struggling with. Make sure you guys subscribe and turn on notifications so you're not missing any live sessions. Welcome to the introduction of section 4, which is video 21 of the blueprint. By the end of this section, you guys will understand exactly how to trade the Zen Lab blueprint system. So from that point in the next section, I'm going to show you how to actually open up an account and how to calculate risk and such. And from that point, it's just acquiring data and over the course of time becoming a profitable trader. Now, before we get started in the system, I just want to say so many traders think the answer to getting better at trading is more, whether it's more indicators, more confirmations, or more rules, and that is simply not the truth. So in this video, I just want to talk about what happens when you make a system a lot more complex than it has to be, because once you start risking real capital is when things start getting a bit interesting. We are action takers. Right away, we have to make a decision between a couple of seconds as to what we are going to do and we're not going to do. And the further complex we make a system when trying to make that decision, the harder things are. So let's get into this video on simplicity is key. Now, simplicity does not mean weak. It just means repeatable. The easier the system is to execute, the more consistent you guys are going to execute it. And as you know now from previous videos, consistency is what actually creates the edge. Because I promise you, when real money is on the line, all of that complexity starts to fall apart. Because you're not rising to your strategy, you're going to start falling into your habits. And under stress, your mind is not going to execute ideas, it's going to execute patterns. So if a system has way too many rules, like too many confirmations or too many exceptions, you're probably going to hesitate, you're probably going to second guess, and you're probably going to miss that trade. Simple systems are going to survive pressure because they reduce thinking at execution time. And the decision was already made, so you're simply just following the process. The system starts mechanical on purpose, not because discretion is bad, but because discretion without structure is gambling. And intuitive trading is definitely real, but intuition doesn't come from opinions, it comes from a lot of experience. And you can't be intuitive in something you've never done correctly, repeatedly, or under a whole bunch of pressure. So once the foundation is solid, then discretion becomes a tool and not a crutch. You definitely wouldn't trust your gut running a business you've never operated before. You're going to follow systems and processes first until experience earns flexibility. And trading is not any different. So to recap, simplicity gives you guys clarity, and clarity gives you confidence. And then confidence allows for probability to work without outside influences like emotions. But simplicity isn't about doing less or having a weaker edge. It's just about doing the right things consistently over time. Most traders don't fail because their strategy is bad. They fail because they try to add discretionary trading before they've ever even earned it. Now, mechanical trading and discretionary trading are not opposites, but getting them in the wrong order is probably going to destroy your momentum before it ever gets started. You simply cannot learn how to run before you learn how to walk. Trading is no different because you can't trade discretion before you ever even learn the mechanical system that creates it in the first place. This video is not a debate about if discretion works. It definitely does. Problem is most traders try to trade discretion without having a foundation, and we're going to make sure you guys don't make those same mistakes. So let's get right into it. Mechanical rules don't exist to remove decision making and execution time, and they don't make you smarter. They just make you consistent. Consistency is what produces data, and then data is what eventually earns that discretionary trading. Discretion is not guessing, it's just pattern recognition built from experience. And real discretion is not going to change or override our rules. It just decides how you can apply them beneficially based off of market conditions. Now, when you use discretion without structure, that's when emotional trading starts filling in the gap. Fear somehow sounds like intuition and greed feels like confidence, but without any rules before adding discretion, there's nothing to anchor those decisions. So every trade starts to feel different and results become really inconsistent. So this is the order that works. Rules are what create execution. Execution creates data. Data creates experience. And it's no different than learning any real skill. Like obviously you follow instructions first, you repeat them enough times to see results, and then experience tells you when to adjust. Only then can you guys add discretion that actually becomes reliable. Now, the ZenLab system starts mechanical by design. Like discretion exists and we definitely talk about it, but it's definitely earned later on. You're not going to improvise a system when you're first starting out. You're going to refine it after mastery. Discretion is definitely no shortcut. It's just a reward for consistency. And optimizing your edge comes way later on. And it comes from experience, from seeing the same situation repeat themselves and recognizing small details over the course of time. So a beginner does not need optimization, they need execution. And the mechanical system is already optimized for you to become profitable. And your job is just to follow it, not to modify it yet. Time is going to be our first filter. And today we're going to talk about why it is so important, especially for the system, to only trade during times where volume is usually very heavy. You guys have to understand price is not moving randomly. It's moving because there are enough buyers and sellers participating. So no participation means there's no opportunity. So do not overcomplicate this. Volume is just another word for participation, and more participants equals more volume. Fewer participants equals less volume. So to give you guys one of my solid analogies, let's talk about a fire. Like one spark doesn't do much to start a fire, but when there's enough fuel and oxygen present, the fire is going to take off. Well, trading sessions are when that fuel actually enters the market. That's when institutions, banks, and large players are active, and that's why price actually moves during that time period. Now, understand most hours of the day are low volume, and that's where all chop and consolidation and fake moves all live at. And this is where many day traders begin to overtrade and assume their system is broken, but in reality, it's just the market simply lacking participation. And without enough orders, price has no reason to move a direction, and so it just consolidates until more participants and institutional pressure enter the market. But high volume windows are when institutions are active, and that's when real orders hit the market and price moves with intention. And that is why we only trade during session opens and multiple session overlap, because this is where volume is, and this is when the system works the best by far, is just during periods of high volume. It is the first rule in the system because timing literally controls everything. If the timing's not right, the setup probably doesn't matter because levels are not going to hold the same way. Breakouts are probably not going to follow through, and confluences simply lose their power. Good ideas fail in bad time windows. So that's why time is non-negotiable, because it protects you from forcing trades when the market just is not ready yet. Less trading is definitely not a weakness. It's how you protect your capital and your psychology. And with this system specifically, trading during high volume times gives you way higher quality setups more often than not. So to recap, we simply trade high volume because that's when price actually respects structure and moves the most. Now that you understand what Forex is and the psychology behind it, now it is time to actually start building the system of how we trade it. So our very first confluence is going to be session highs and lows, and once we're done with this video, you're going to see price differently because these levels are where true participation usually always happens. Later on in this course, I'm giving you guys a tool so it automatically locates session highs and lows so you can just continue on with other confluences instead of taking time marking out these levels. So first things first, price doesn't move because buyers or sellers exist. Both always exist. Price moves because one side is more aggressive aggressive than the other side. Like at a high, buyers were more aggressive until they weren't, or at a low that's created, sellers were more aggressive until they weren't. So that's why these levels matter so much for reactions, breakouts, and continuations. So then the question is, well, how do these levels matter? Well, earlier in this course, we talked about how institutions and banks are the only players large enough to actually move price. But because their orders are so big, they can't enter everything at once. They have to split orders and use liquidity. And liquidity naturally builds around highs and lows. Since institutions primarily participate during session opens, the highs and lows formed during those times often represent very meaningful activity. And as day traders, our job is not to predict, it's to recognize these footprints and then react once price revisits those areas. And we don't track the entire session of all highs and lows. Most participation is within the first few hours of session. So we locate the first 3 hours or so of each major session to identify the high and low of the period of the most participation, because that's where clean structure forms. That's going to be where the strongest footprints are made, and that's where we get the cleanest reactions once those areas are revisited. So let's take this to the chart and show you a few examples. All right, so this is the very first look at a candlestick chart. Fucking finally. I know that a lot of these individual terms in these videos, as I said, I scripted them to make sure I don't fucking miss anything, is a bit boring, but as far as the learning process goes with Forex, yes, the tactics are a bit fucking boring. Simplicity is key to consistency and actually getting profitable. But once we get into the charts and I can put everything together in one lump sum, shit's gonna move pretty fast. So just understand, I know the energy's a little bit tight trying to go through all these videos. It is a lot of education, but once we get to the point of tying everything together, it is all going to make sense. So make sure you guys continue on here. Here we have session highs and lows are already indicated out using the indicator that you guys are going to get at the end of this course. And what it's doing, as you know now, is defining a range for us. So we're going to go each individual day. We just went back about a week and just show what the next couple of sessions does more often than not when you're tapping into these session highs and lows. As you guys know now, is periods of a lot of participation. So I'm going to mark them out with a horizontal line. We got this session's low right here. We got this session high sitting up here. And this is what more often than not's going to happen. Even when you get a big push coming up to these levels, more often than not, you're going to get some type of stall because, as you guys know, liquidity is sitting at highs and lows. And so once those orders get filled, it's a fight from that point to see which direction is going to win. So usually you get a little bit of consolidating movement, or if there's a lot of heavy selling pressure up there, you'll get a strong reversal, or if buyers are heavily in control, you're going to get a big push. But the key here is there's going to be a ton of orders sitting at these areas. And so what type of reaction we get to these points is a huge indication where price is probably going to go. And that's why this is my favorite place to take trades during a session. So first above highs, we didn't get much of a reaction here. Prices continue on for bread and butter setup, which that we're going to be talking about in a bonus video. That is our most profitable setup, but not for this video. We're going to keep it very simple. But as you see, as soon as we came down to lows, look at this aggressive move we had coming all the way down. And what ended up stopping price in its tracks, as we told you, sitting at a higher low, that's where you guys are going to understand where breakouts and reversals play out the most. So as soon as we broke below those lows, there was heavy buying pressure and price shot right the fuck back up, all the way back up to a different area. So these are more often than not areas that when we come down to this level, if we don't get that abrupt rejection and we get a continuation, it's probably going to come with a lot of volume. So that's where we want to participate at. Moving on to this next session, which again, we don't have to mark out because we have an indicator for that. We have lows sitting down here. We have highs sitting all the way up here. While we're sitting within this range, it just is a good indication, as you understand from this video, that price has not picked direction for the day. That's why it's squeezing sideways. Buyers or sellers are in control, so it's just chopping around. But at whatever point that we do end up breaking below lows, well, two things are going to happen. We're either going to get a heavy rejection the opposite way, which we did here. We got a strong push to the downside. And then as soon as we broke lows, we started to push back up. But once price revisits that area, if we don't just continue on from this massive reversal, once price revisits this area, more often than not, that is it picking the direction for the day. And it's going to jump out of that range with a lot of fucking volume and continue on within that direction. Those are the type of trades that we like to take. This is another bread and butter setup happening here, which again, we'll have to talk about later on. Okay, moving on to the next session. We got lows sitting down here. We got highs sitting all the way up here. So what happened? We never ended up getting up to highs during this day either. But as soon as you break below lows, which is the same exact thing that happened the previous day, even though we had this major bearish momentum that it looks like it's just going to continue on, as soon as we paired all of those buyers with seller, we got an immediate reaction to continue back up. And then again, once it re-breaks these levels, it's just a good indication that price is not going to sit within that session range. It's going to continue on in that one direction. More often than not, everything is about it more often than not. Moving on to the next day, we got highs sitting up here. So this is a very good one to talk about. You guys need to understand when we're talking about where liquidity sits, sitting at highs and lows. Okay, we're not talking about when you get this indicator. This indicator is the first 3 hours of session because that's when the most liquidity is formed. But there's not a ton of orders simply just sitting at session high. It's sitting at the actual high, sitting up here, not just at a random bearish candle in the middle of nowhere. Same thing with down here. Let's say that the first 3 hours of session ended right at this low. That doesn't mean liquidity is sitting there. Liquidity is sitting at the actual low that was formed. This is the entire range. So you got to be very careful with that. So the actual high and low is sitting up here. The low is sitting down here. And what ends up happening first? Either two things are going to happen. One, you're going to get an abrupt and heavy opposite end reaction because there's always a ton of orders sitting down there. Or two, it's going to be a massive breakout. You're going to either way, you're getting a ton of volume whether it's a heavy reversal or a breakout here. Sellers were heavily in control and price sent it pretty fucking aggressively. And then as far as highs go, look what happens once we come all the way back up to these highs. There's a ton of orders sitting up here. There's a ton of liquidity sitting up here. A lot of buyers got paired with sellers. And almost immediately, we got a nasty rejection from that point and continuation lower. And just like we were talking about, once these reactions do happen, we're not trading here yet. We didn't trade this breakout, even though it's clean. We're waiting for that reaction. And then once price revisits this area, that's when we're looking to get into a trade because more often than not, it's letting us know that price is going to continue on in that direction. Liquidity has already been filled, and we continue on to that point. So price is probably going to continue up until the next level of liquidity, which, as you guys know, is sitting at high. So potentially somewhere sitting up here or somewhere sitting up here. I hope this is starting to make sense to you. And then for last example, let's go ahead and do one more. We got highs sitting all the way up here. We got lows sitting all the way down here, and same exact thing here. As soon as we come below lows and pair a ton of buyers with sellers, you get a heavy opposite end reaction. When we continue on from that point, we can look at some interior structure to potentially take price back up. But if price continues back beyond this heavy level of participation, it's just a good indication that it's probably going to continue on. And this is where we'd be looking for a trade. Now, these levels are not for prediction. They're just giving us context. It's helping us understand like where price has already made decisions. And so when we revisit these areas, depending on the reaction that happens once price gets there, they are extremely good areas to execute trades. So good that our strongest setup is a direct result of what happens at these levels. And that deserves its own video, which will be presented later on in this course after you guys understand price action entirely. These levels are also giving us a defined range. So if we fail to break out of that range, that indicates indecision as far as direction goes in the markets. Buyers nor sellers seem to be in control. Also, more often than not, pushing above that range is going to indicate higher buying pressure, and pushing below that range indicates heavier selling pressure. So as traders who simply follow what price is telling us and react, this is a huge indication on which way we should be trading. And this is also a big reason why we wait for a breakout before getting into a trade. So to recap, session highs and lows work because they're built during high participation, not because of lines on the chart. They define a range and give us an idea where price may go next based upon institutional participation. So next, we're going to be expanding on support and resistance. We're going to be talking about how to draw them. We're going to be talking about what time frames matter the most and how they directly correlate with session highs and lows. And now these areas are the only areas we take trades on, so it's extremely important to understand them in depth. Once you understand how to identify them correctly and use them with intention, you're going to have a lot better time making sure that your breakouts are fulfilled. As volume breakout traders, we're not interested in predicting reactions. We want to observe what happens when price reaches these decision areas and react only after price confirms. So That's how we avoid liquidity grabs and false breaks and ensure price is actually ready to continue after a breakout. For execution, we're only using 5 and 15-minute time frame support resistance areas. These are our primary areas of rejection for entries. And then higher time frames are going to help us understand where price may go long term, but the 5 and 15-minute levels ultimately decide when we're actually going to get in. Because we trade with momentum, there's going to be a ton of times when we sell, even when the higher time frame shows buying pressure, and buy even when it's showing selling pressure. So as long as we have multiple confluences, directional bias becomes secondary to momentum. Now, as far as 1 hour and 4 hour support and resistance zones go, these are higher time frame areas, so they are respected a lot more over longer periods of time. So we use them to define kind of boundaries and expectations for price. This is really the foundation of confluence trading, stacking multiple reasons to justify a trade instead of just relying on one single idea. Now let's take this to charts and walk through exactly how we draw and use support resistance in real time. All right, so now we're on the charts. I'm going to break down support resistance as smooth and simple as I possibly can. First, we're going to start with 4 hour, 1 hour time frame, and then we're going to go down to 1 hour time frame. So first of all, 4 hour time frame. We don't want to go too far to the left, okay? Higher time frames definitely run where market's going to go long term, but we really just want to see where price is currently at, where those actual swings are, where the closest swings are to that time period, where price has reacted multiple times. When we go down to 5 and 15-minute time frame, you'll see we really were stuck to where price is at within the last 2 hours. It doesn't have to be multiple reactions, but when it's coming to higher time frame confluence, we really only mark out these levels when you have multiple reactions coming up to this point. Okay, so resistance, which you guys know is now our ceiling. Last time price came up to this area, reacted away from it 3 additional times. Okay, support resistance on higher time frames acts as magnets. And so more often than not, let's say we were to push up to this point, it's probably going to come down to this area. Once we come down to this area, probably going to come up to this area all the way until it doesn't. Let's say we have a high sitting up here. Let me scratch this down, and then we have a low sitting down here. This is all it's doing is pretty much playing ping pong all day, okay? Once price finally breaks through this level, whether it's volume or having multiple confluences, whatever, then from this point, more often than not, it's just like magnets again. Either one or two things are going to happen. Look, there's more liquidity sitting up here at the next resistance, or there's more liquidity sitting down here at support. So it just bounces in between because as you guys know, the market's job is to chase liquidity. Liquidity is sitting at highs and lows and heavy levels of rejection. So once we come to that heavy level of rejection, it's going to go where the most liquidity is at again, which is either going to be sitting at the next high or sitting at the next low or the next level of support resistance. Over and over and over again, that's all it's doing. And then in between these areas, which is where we're going to mark out 15 and 5 minute time frame support resistance. In between is where we can build confluence based off of volume, trend lines, moving averages, lower time frame support resistance, and breakouts to potentially take a trade, anticipating where price is going to go next. Okay, so just understand when you're drawing higher time frame support resistance, you want to go to where price is currently at. Not go too far back. You're just looking for the last time that price reacted multiple times, which here is pretty much here. And you just understand that more often than not, if price is currently reacting off of support, which it is, and it's already pushing away from it instead of breaking through, more often than not, what it's telling you is it's pushing up to this next high. And then from that point, we have to wait and see what it does once we get that reaction. Is it going to continue on and then more often than not go to that next resistance, or is it going to abruptly reverse? And then, more often than not, it's going to come down to the next low because it literally operates like magnets, okay? That is 4 hour and 1 hour time frame. It's just acquiring a bias of where price is potentially going to go. Very, very simple. But again, watching me trade live every single day is what's really going to solidify this. Now, going down to 15 and 5 minute, which is our actual entry time frame. Okay, this is where we're actually going to be entering charts based off of. This is kind of the middle of nowhere, so let me give you a cleaner area to play with. This is where we're actually going to be entering based off of these areas that we draw. Okay, so please pay attention when it comes to this. When we're marking out support resistance, we don't really want to go further back than a couple hours. Okay, if session open is happening right now, we don't care what's going on all the way over here. We don't care what's going all the way down here, all the way back here. We're taking a reaction to a level where price is currently at, and that is as close to price can be. So our ceiling, our resistance, this is the closest high. where price came up for some reason or another, it couldn't continue past that level. It pushed the opposite way. So there's something sitting right there that's not allowing for price to continue. That's a valid level of rejection. That is resistance. Price is sitting right here. Now, what happened from that point? Price continued lower. We had some rejections. We continued the opposite way. There's something sitting right here that's not allowing for price to continue higher. This is a valid level of support. So that is all we need marked out. We don't care about what's going on all the way up here. We don't care about what's going on all the way down here, even though these are abrupt levels where we rejected away from. That's completely irrelevant to our scalping system. We want to stay where price is currently at. And for the people who spend time marking up 20, 30 levels on their charts, I've just seen so much hesitation and analysis paralysis because I have so many different levels marked up. We only want 3 max levels during our trading session, which is where price is currently at. If there's a, if we're sitting right at a support resistance, the high during that period, which we have here, resistance, and then the low of that period, which is support. Now, if you want to bring this on to the left, which like here, you see there's a pretty strong level of support. Every single time we come here, we push away, come here, push away, come here, push away. That's just giving us a stronger level of rejection from this point. Just understanding the price at. And kind of same thing with these highs sitting up here. You push this to the left, we can kind of see price every time we come up to this point, price is rejecting away from that level. So what is this telling us? It's telling us that there's no decision in the market yet. This is a ranging sideways market. But once price does come down to this level during the time that we trade, which as you guys know is when the most participation is, the highest volume is because it's during session open, well then the likelihood of it breaking past this level is way higher than trading during off periods, which is this time right here. Okay? And so once price comes down to this point, that's when we're going to make that decision, which we're going to talk about in later videos based upon other confluences, the reaction we get to this level. Is it going to continue lower and then we'll hop in? Or is it going to reject away and we'll simply just wait till we come up to that next level of rejection before thinking about getting into a trade? Please do not overcomplicate this. And again, you're going to solidify these turns by watching me trade live every single day on this channel, but that is all we're doing every single day. We have guidelines from 4-hour, 1-hour time frame support and resistance where price is probably going to go. We're going down to lower time frames. We're marking out the most recent rejection levels of a higher low, and then we're waiting for price to get to that point during volume. And based upon that reaction, we're simply going to we're going to take the trade over and over and over again. Adding any additional values to that or trying to trade in the middle of the range before we get a decision because you want to jump the gun early, or you think that price is going to continue higher because we're creating higher highs and higher lows, which we're going to talk about trend in the next video. Most people have so much paralysis when it comes to where they think price is going to go based upon trend. It's going to get you chopped up. The only reason why we take a trade is because of a breakout. The only way we can get to a breakout is by coming up to a level of rejection, which is support resistance. And then once you add in confluences to that, whether it's a trend line, whether it's a moving average, we're always going to have volume because we're trading during session open. That is making that idea stronger that it's probably going to play out. So that's going to be the end of support resistance here. One of the biggest mistakes traders make is drawing way too many support resistance lines on lower time frames. And understand, more lines are not going to create clarity for you guys. They're just going to create hesitation. So another combination is going too far back when marking 5 and 15-minute support resistance. For execution, we really only care about recent areas of rejection, not levels from days ago, which you guys are still just seeing once we actually took it to the charts. Now, another thing is just using way too many time frames. We always talk about simplicity is key, making sure we can remove as much hesitation as possible. And if you're constantly jumping from daily to 4-hour to hourly, then 30-minute, 5-minute throughout the entire course of the session, it's just going to lead to potential emotional decisions and hesitation because you're going to see something you don't like on one time, even though you like it on another. So when it comes to actual execution during session open, we're only sticking to the 5 and 15-minute time frame. And I know we spoke about this in the charts, but I want you guys to really drill this in your head. Support and resistance are not signals by itself. Like breaking above a resistance or breaking below support is not an entry signal by itself. They're just areas we wait for price to come up to, and we wait to see the reaction once we get to that area and then make a decision. It is a massive part of the system that if you don't understand that, you're going to be jumping the gun and getting in early and potentially becoming liquidity instead of actually getting in the continuation. Understand this is something that does come with time and experience. watching price get up to these areas of reaction, see what happens when we get to that point where we just grabbing liquidity to go to the opposite way, which you know now, only two things are going to happen. The market's job is to find liquidity, as much liquidity as it possibly can. So once it gets up to an area of liquidity, from that point, it's going to search for the next area of heavy liquidity. That's either going to be below price or it's going to be above price. And watching that reaction at that level of liquidity is going to give us a big indication of where it's going to go next. And that's why we like to enter off of these levels. Support resistance works best when they're simple. Lower time frames definitely run the show as far as support resistance goes, but higher time frame, just like a trend line or just like session highs and lows, are simply another confluence to add to the arsenal to strengthen our idea where price is going to go. But again, for our style of trading, lower time frame support resistance by far is what runs the show when it comes to actually entering the market. We're going to talk about trading in the Zen Lab way, which is just clean and simple and in a usable manner. All right, so I'm going to break this down to its most simplest form. So by the end of this video, there will be no questions as to not only what trend is, but how to identify it in the markets. Now that you understand the two different types of trend, you have to understand the market doesn't move in linear fashion, so it doesn't just go in one direction. It has two different phases to go from a starting point to an end point. So to go up to a low and a high, as you guys know, it needs to be more buying pressure during that time period. But within that, there's either an impulsive phase or a retracement phase. The impulsive phase is that stronger directional move of trend. But in order to get up to a high, we also have retracement phases, which are weaker counter trend moves, which are always going to be followed by an impulsive phase all the way until they're not. And same exact thing for a downtrend. It's the same two phases. You're going to have that impulsive phase, which is that stronger directional move, followed up by retracement phases, which are then followed up again by impulsive phase, all the way till we get that ending low. Okay? Now you understand phases, we have something called structure points. So while we're having an impulsive and a retracement phase, price is creating highs and lows in between an ultimate low and in between an ultimate high, and those are called structure points. So in an uptrend, first we're going to start with an impulse, and then once we start to retrace, we create a high that is called a higher high. And then once that retracement goes back into an impulsive phase, that's creating a low, which is called a higher low until we get up to an ultimate high. Now, in a downtrend, going from a high to a low, it's the same exact thing, but there's different names for it. They're the same structure points. We first start with impulsive phase, and then once we go from impulsive to retracement in a downtrend, that creates a low, which is called a lower low. And once we go from retracement back into an impulsive phase, that creates a high, and that is called a lower high. Now that you understand the two different types of trend, you understand the different phases in which trend moves, and you understand structure points that are created as trend is developing. Now you need to understand how trend changes, which is called a break of structure. So in the start of a downtrend, it's simply when we break below a higher low structure point, that signifies a downtrend. And in an uptrend, it's simply a break of a lower high that is going to signify the start of a new uptrend. Now let's put this all together so you understand how this looks with multiple phases and multiple different structure points. So first, we start at an ultimate low. We're looking to get all the way up to an ultimate high. That means that there's more buying pressure there, which is an uptrend. And the way we get there is by creating higher highs and higher lows. So first, we start with an impulsive phase. As soon as we go from an impulsive phase down to a retracement phase, that creates a high that is called a higher high. Now, once we go from retracement phase back to impulsive phase, that creates a low, which is called a higher low, and so on and so forth, all the way until we get up to an ultimate high. Well, we understand that an ultimate high is created once we get a break of structure because that signifies a change in trend. So in order to go to a downtrend, we're breaking past a higher low, and in order to transfer from a downtrend to an uptrend, we're breaking past a lower high. Okay, so let's start this all over again. We understand that an ultimate high was created and we're switching trend because we get a break of structure as soon as we break past a higher low, and we do the same exact thing over and over again. We start with an impulsive leg. Once that impulsive leg transitions to a retracement, we create a low that is called a lower low. And once we go from a retracement back into an impulsive phase, that creates a high that's called a lower high. Okay, that happens over and over again, all the way until we get a break of structure, which is breaking above a lower high point, Once that does happen, you can signify that trend has changed due to a break of structure and we're back into an uptrend. So let's start with very simple structure here. As you guys understand now, there's only two phases in a market, which is the impulsive phase, retracement phase. Impulsive phase, retracement phase for higher highs, and then the impulsive phase, retracement phase, impulsive trade, retracement phase for a downtrend as well. Lower low, lower high, lower low, lower high, lower low. Bullish, higher low, higher high, higher low, higher high. Okay? And so what we have here now, we're just going to run through this. Our current impulsive leg is this from here, this low all the way up to this high. But before we got to that point, I just want to go from one swing point beforehand, is that previous level structure. Some people get this confused, especially when you're very beginner to this. And again, all of this is going to be solidified by you guys watching me trade live. But until you get the knack of understanding structure points, I want you to put bumpers up using a horizontal line. And until price breaks beyond those levels, you simply just understand that price is still within that same range, whether that's an uptrend or a downtrend. Okay, so before we get up to that point, this is our current this is our current structure that we're going to stay with. We have a higher low here that we'll put a horizontal line in, and we have a higher high sitting up here. Okay, we understand more often than not prices go in the direction of trend. Obviously, trend is bullish here because we're creating a higher low and higher high. And so this could potentially be a confluence if we go to lower time frames and we're breaking above a lower time frame resistance here. Okay, let's say the session opens right here. We're breaking above that high. We have volume on our side. Price is confirming that trend is obviously also bullish. Probably a good time to get in that area. More often than not, the probabilities are going to play out in our favor. Okay? So it's kind of a good confluence there. But let's see what happens from this point. We'll just kind of fast forward. One thing to understand is until you get a strong break above this level, this could potentially be liquidity. So let's break this down real quick before we continue forward. Just a simple break above this high and then a wick back down into this area doesn't mean that is a new range of structure yet, okay? As you guys know, liquidity is sitting at highs and lows. And so when we come up to these major levels of liquidity, that is a decision level. From that point, price is going to decide if there's more liquidity sitting higher and it's going to continue higher, or if there's more liquidity sitting at an actual low and it's going to continue down to that next low. Okay, so just a simple push above a previous structure level does not indicate a change of structure. You got to get a nice strong break above that level before we decide, okay, this is a new price point. We can go ahead and move our bumpers on. But still, we're still bullish. Even if we were to break above these highs and create new structure, all we need to understand here is that we're still bullish and price more often than not is going to continue higher. Okay, so what ends up happening? We get a bit of a retracement here, but probabilities play out. More often than not, price continues higher, and we start to push up. Okay, so now we have a higher low formed. We can go ahead and move this bumper up. We can go ahead and take this bumper off. I'll put it up here for now, but we have no established higher high yet because price hasn't retraced yet. We just have that expansion leg, but we don't have the actual retracement yet. So we're in a bullish trend. We expect price is just going to continue higher all the way into the point it doesn't, and we start to break below this low. Okay, so continuing on, let's wait for some type of retracement. Price is just sending it right now, and boom, we're starting to get a retracement from high. There's something sitting right here that's not allowing for price to continue higher. So now we have a valid higher high sitting up here. Okay, and the same thing over and over again. We're going to lower time frames during momentum levels or during high volume momentum levels, which is during session open or around session open, to gain confluence to kind of match up our picture to go ahead and take bias here. But if we're starting to break below resistance, regardless of us being in a bullish market, we break below resistance, we're breaking below session lows, and we have a trend line that's potentially holding and it's during a period of volume, we will definitely sell here too. And that's why I just really can't press the point enough of taking these. All we're doing with trend is giving us an additional confluence to our bias that we're creating, or to our execution bias we're creating on lower time frames. Okay, that's all the trend is. Okay, so from this point, more often than not, price is just going to continue higher all the way until it doesn't. If it potentially break below this level, let's go ahead and skip forward here, see what happens. Retracement, retracement. Okay, and there we go. So price pushes below low. And as we spoke about, there's a ton of liquidity sitting at highs and lows. So once price comes down to that point, This is a decisionary, not a guarantee. Just because we broke below low, that's a break of structure, which so many people confuse that and end up destroying their accounts. From this point until we get a strong break and close below that low, this could pretend this is the market deciding. Is the next area of liquidity sitting down at that previous low, or is there more liquidity sitting all the way up here at these highs? Well, it's made that decision. We've grabbed liquidity here. It looks like there's more liquidity sitting up here. And so we're still in this bullish market. We never changed our bumpers, and price is simply continuing higher. Okay? So that's all that trend is over and over and over again. Now that we broke above that high, we can go ahead and move our points. Our next higher low is sitting right here, the next low that was created, and our higher high now that we're retracing is sitting all the way up here. And so until price breaks below this low, we're simply still in a bullish market. Okay? All the way into the point we're not. Let me kind of fast forward here because I do want to show you guys a bearish market too. Okay, we ended up breaking above highs again. We didn't come back up and push all the way below lows. We continued higher. So now we have new structure, higher low sitting up here, waiting for retracement. Now we have a higher high sitting up here, and we're still in a bullish market because more often than not, price goes in the direction of trend all the way until it doesn't. Hopefully we get a break here soon. Price pushes up yet again, higher low, higher high. And so when you get all of this chop in between of these ranges, you're not going to get caught up anymore because you're allowing for these bumpers to speak for themselves, onwards and upwards as your confluence until we end up actually breaking, which potentially is going to happen here. Okay, so now we finally get that break below lows. We didn't come below lows and then continue right back in the range. We got a very strong, unforgivable break below lows. We didn't just grab lows like here with liquidity and push up. So now finally, we can go ahead and put a bearish trend. Here's a lower high sitting up here, a lower low sitting down here. And then more often than not, price is going to push lower all the way until it doesn't, and we push back above this high. Okay, that is trend in a nutshell. Very, very simplified confluence of to add into the arsenal. Okay, and look what happens here. More often than not, price goes in the direction of the trend. We end up creating a lower high. We end up creating a lower low. And again, price just over and over again, you guys having these bumpers up here, that's a confluence. So make sure you guys understand momentum definitely comes before this trend bias. This trend bias is simply a confluence, but there will be many times where we sell when higher time frames is an uptrend, or buy when higher time frames are in a downtrend. And this is what I'm talking about. So many traders struggle with trend in this system because they try to force alignment instead of seeing trend as a confluence to build a stronger idea. Momentum plus breakouts are the main source of our entries, and trend is just a strong confluence to add to our trade idea. We cannot enter a trade unless we have multiple confluences, but momentum and breakout are mandatory. Trend is not a mandatory confluence to get into a trade. We're going to be talking about probably the first tool that you've learned how to use when trading, which is trend lines, and how it is the fastest way to ruin your charts. I mean, used as confluence, it can definitely give you a lot of clarity and confluence, but used incorrectly, it really gives hesitation, a lot of missed trades, and worst off, low probability trades because so many people base their entire idea off of a trend line. So let's dive into how to make sure you're using it the correct way. So you must understand trend lines are simply just visual guides. They're going to give you a different view of support resistance, and they can be added to support resistance levels for added confluence, but they cannot replace support resistance as levels to enter off of. They help you see structure, but they do not give you buy or sell signals like traditional support resistance. And same with trend. They can add confluence to an idea, but they are not required like momentum and breakouts are required to enter a trade with this system. Trend lines only matter when structure is clean. That means they have multiple clear touches and it's not forcing a line to fit price. And if you have to constantly adjust the line to make it work, it probably just doesn't matter. Remember, the market is man-made and it's driven by real buyers and sellers. If a level isn't easy to identify, other participants are not going to be seeing it either. And if participants can't see it, participation at that level is going to be very limited. If it's not clear, it's probably just not a meaningful confluence. Trend lines also lose relevance in choppy or low volume environments. They're called trend lines for a reason. They work best in clean directional markets. And this is why time and volume always come first. Trend lines never override participation. Most traders draw way too many trend lines and base their support resistance based off of them and ignore momentum at certain levels. And just like trend, traders give them way too much power. You guys have to remember, trend lines cannot replace horizontal support resistance. They're simply optional. Now that we're on the charts, I want you guys to understand the reason why the last video is trend identification is because you have to understand what structure points are before you can ever actually draw out what a trend line is. One thing you have to understand when drawing a trend line is these are based off of participation. The reason why we're getting rejections at these levels that we're about to draw is because a lot of participators, volume users are seeing these same exact lines drawn, areas of interest, and they're executing based off of those areas. Same exact thing that we're doing, but we're not basing our trades off of these areas. We're just adding an additional confluence because it's going to be another level of reaction. But it can only be a confluence. The only way we're going to actually enter trade is based off of a breakout of horizontal support resistance. I just got to be very clear about that for like the third time in this call to make sure you guys aren't messing up your charts. And so how you draw them is you're simply going from one structure point to the next structure point and then continuing it on to the future. So we'll do a couple selling, downtrend trend lines and a couple uptrend trend lines as well. So let's go ahead and start right here. You cannot skip price when you're marking out a trend line. So you see we have a higher low sitting right here, a higher low sitting right here, higher low sitting right here. You cannot skip this higher low to go to the next higher low just because it looks better for where price is currently at. That is not how trend lines work. You have to go from one higher low to the next. Once it gets invalidated, which just simply means it gets broken beyond and structure's not holding at anymore, that's fine. That's an invalidated trend line that we can't use for confluence anymore. You move on to the next structure point. Now from this point, we're going from this structure point to this next structure point, dragging it to the future. And let's say price was sitting right here. We're anticipating getting a reaction from this level once we tap it the third time. The likelihood of obviously somebody seeing a trend line before the third time is not really possible. I mean, the reason why we're marking it out in the first place because it's made up of two structure points. But now the third time, there's going to be a ton of participants who have already marked up this trend line and are anticipating that third tap. And so that's why we're going to use it as confluence. Once we come down to that level, let's say we have some type of valid level of support here, sitting down here. We come down to that level and it's holding and we start to break below that trend line. So you know that buyers that only buy based off a trend line are getting invalidated and we're breaking below support. Well, that's double the confluence. The price is probably going to continue lower. And so you can execute based off of that. Okay. And so moving on, once that gets invalidated, let me put that back up. Once this trend line gets invalidated, that's fine. We're simply just moving on to the next trend line if there's one that's available to do so. Okay, so that's in a buying uptrend. And we'll do a couple more examples here. You cannot fit price to where it seems best to you. You simply go from one structure point to the next structure point, and then you're anticipating that third tap. We have a first tap here, we have a second tap here, so now we get to draw it out. And the third tap here, just that holding right here and getting a break above resistance is probably a good indication price is going to continue higher. If you can get volume within that aspect, this market just during session open, which just happens to be 9:30, so that's New York Stock Exchange open, this is a really powerful trade that's probably going to play out. You have three confluences here now showing you that price is probably going to continue higher. All right, moving on to a bearish trend line here. We'll just locate from one lower high down to the next lower high and extend it out to the future. We have a first tap here, our second tap here. Now, once we get that second high formed, now we can extend it out to the future. And then look, we have that third anticipation. There's a lot of investors who are waiting for price to tap into this area and base their trades off. But just getting a break above this trend line is not good enough to take a buy. And getting a rejection from this trend line alone is not a good reason to take a sell. But once you see the reaction, that third reaction from this trend line, and you get a break below support sitting right here, and it's during a period of high volume, which again, this is the 9:30 candle of the next day. This is the previous day we just went over. This is 9:30 candle of the next day. Well, this is probably a really good indication price is going to continue lower. And we had a huge expansion to the downside, and it would have been a qualified trade, another three confluence trade to go ahead and take. Let's do this last example. So as we talk about, you cannot form these trend lines to where you see fit during that current time period. There's a simple rule behind it. You're simply going from one structure point to the next structure point. Once that gets invalidated or you get that third hold like you get here, you can continue to move onwards, especially once it gets broken. So here you actually got to break a trend line. It continues lower. This is obviously now an invalidated trend line because it's not holding. It's already been broken. You can move on to your next structure point from here to here and extend it to the future, which now we got that third participation, or you can continue on If you're seeing another higher low be formed to kind of come close to where price is currently at, you can go from one low to the next low, extend it to the future, and we can now use this as a valid level of rejection. Again, merge that with the resistance sitting up here. And if you have it during a period of volume, this is 4 o'clock, so it's about midway through London session, is 4 a.m. Then you can anticipate price potentially pushing higher because you're in a high volume session, which is London. You're getting a break above resistance and you're getting the fourth tap to this trend line as well. So understand this last thing. More often than not, we always treat these areas like a brick wall. Same exact thing as support resistance. I treat trend lines like a brick wall as well. The brick wall is extremely strong when it is first formed, but then every single time price comes to it, it's like taking a hammer and tapping onto it. It's making it weaker and weaker and weaker. And the likelihood of a trend line holding beyond its third tap is a lot lower than it was the first and second tap. And so once you start getting into some pretty crazy trend lines, like even this one right here, that's holding now for the first, second, third, fourth, fifth time, the likelihood of price coming down here and holding again is the chances of that are just getting lower and lower and lower. So you can use that as probability. You know, if we have a support sitting all the way down here and we're waiting for a bit more confirmation, getting that push back to this trend line again and breaking low and then breaking below the support, the likelihood of it continuing on, because all of the orders from this trend line are probably used up, this trend line is probably not going to hold anymore. It's just giving you additional confluence that price is probably going to send it lower. So that's exactly how to draw a trend line and how it could be confluence for you. So to recap, trend lines do not make trades work, execution does, and trend lines can only be used as a confluence. They cannot be the reason why we enter a trade. Moving averages are probably one of the most used indicators in trading, but probably one of the most misunderstood. I'm not going to teach you how to trade off of a moving average. I'm going to show you what a moving average actually represents and show you how to use them correctly. A moving average is simply the average price over a set period of time. And I'm going to show you exactly what that looks like on the chart here soon. A moving average does not predict price and it doesn't cause price to move. It just gives us a visual reference of where price has been trading. Most traders use moving averages as signals, like buying when two averages cross or selling when two averages cross back. And the problem is that by the time a moving average gives some type of signal, the move has usually already happened. It's like driving while only looking in the rearview mirror. That mirror isn't useless, it shows where you've been, but it's not how you decide when to turn or accelerate. And that's exactly how we use moving averages in the system, as context and not really commands. They are a dynamic reference that can add confluence when aligned with momentum, timing, and structure. So visually, think of moving average as the median of price over a specific period of time. If price is above the moving average and we're looking for buys, we're trading in alignment with where price has been spending the most of its time. But if price is below the moving average and we're looking for buys, we're trading against that median of price, which doesn't make the trade invalid, but it removes a layer of confluence and lowers probability. Another way moving averages can be very useful, which you will see during all live sessions on this channel, is as a reference for trade management, not really entries. In the system, we use really tight parameters like lower time frame support resistance, momentum-based breakouts, and average to range-based stop losses. So because everything is structured around the current market environment, there will be moments where price briefly taps a mechanical stop loss but continues moving with momentum. And over time, and only after building data and confidence, discretionary traders may choose to hold positions slightly longer when price is reacting around the moving average, which represents the median of price during that time period. And sometimes that moving average is sitting right at our stop loss since we're so close to those medians every single day. Now, this is not something beginners need to do, and it's not required for profitability. And I'm showing you this now so you understand how tightly connected the system is and why execution becomes cleaner as experience grows. Now, we're going to revisit this later on in the course, and you'll see it live during all my sessions, but for now, focus on using moving averages as context and not control. So now that we're on the chart, I have this gray line here, which is a 13 period moving average. The reason why I have a 13 period is so it's very close to relative price as we are scalp/day traders. And what that indicates is over the last 13 candles that were printed, this is the median of price during that set period of time on the 15-minute time frame. If I were to go down the 5-minute time frame, that would simply mean that over the last 13 5-minute candles, this line right here shows the median of price during that set period of time. And so as you saw from the slides, if we're trading below that moving average, the likelihood of it continuing lower is a lot higher. And if we start trading above that moving average, the likelihood of price continuing higher is a lot higher. Okay, so sitting here, that's when you can start to add confluence. Okay, if we have resistance sitting up here and we have support sitting down here, and price starts to push above these highs, well, we wouldn't have confluence that price is going to continue higher with the set period of time because our moving average is sitting above it at that current point. And so, as I was telling you in the slides, a lot of people use a cross of a moving average as an entry tactic, but then they're going against where that current market is moving during that set period of time. Now, this isn't an end all be all. We can definitely take a trade if it's going against the moving average if we have other confluences, but just understand it just lowers probability a bit if we don't have that direction on our side. But once you start to break below support here, and it is also trading below the moving average, it's a probably good indication because we're with the average of price during that set period of time, the price is going to continue lower. All right, now let's get into another example here. So let's say we have a resistance sitting up here. We have a support sitting down here. And from this point, as you see, the moving average is sitting directly in the middle of price. It's not sitting above price. It's not sitting below price. We can still take a trade, just like trend lines. This is simply just another confluence. And so if we don't have it on our side, if we have two or three other confluences, we can still take the trade. It's just a little bit lower probability because we don't have everything stacked up with us. Okay, but as soon as price breaks above this moving average, and we're also breaking above resistance, and we also have volume on our side, well, it's potentially a good indication that price is going to continue in that direction, and that's exactly what it does. And now, once we leave that indecision and price starts trading above that moving average again, look what happens. It starts to even kind of treat it like a psychological level of support resistance. Price is continuously bouncing off of it and pushing higher. Now, this is where people get chopped up. Price is clearly trading above this moving average. You get a slight break below lows. As just a confirmation, you finally get a cross below the moving average. You start to take a trade and price just continues higher because you're trading against momentum during that set period of time. So I just want to confirm this is definitely just another confluence. It's not an end all be all, but it's very powerful when you have trend on your side, you have a moving average on your side. And obviously volume as well, that price is going to play out in your favor because more often than not, price is traveling in the direction of trend. You now understand moving averages don't make trades work or even give signals. They just help you understand the environment that we're in and add even more confluence to a directional bias. Most traders don't lose because their entry is bad. They lose because their stop loss is not based off of market volatility. If you don't know, a stop loss is a price you put in place. So once you get into a trade, if your trade idea is incorrect, it pulls you out of that trade. And so today I'm going to show you how to use a mechanical average true range based stop loss. So no matter what the volatility is during that set period of time, you can make sure that your protection is up to speed with that. Just ensuring that your stop loss is not too tight if you have a lot of volatility in the market, but also that your stop loss is not too loose if there's very low volatility during that set period of time. So as I'm sure you can imagine, the placement of a stop loss is one of the most important parts of a trade and managing that trade. So today I'm going to show you exactly how to use a mechanical stop loss regardless of market volatility. Using the same stop loss size every day does not make you disciplined. It makes you disconnected from the market because volatility changes from day to day. Your risk needs to adapt with it, or you could be sacrificing good risk to reward, or worse, a failed trade that was actually a correct idea. ATR, or average true range, measures how much price has been moving recently. It's not direction, it's movement. Like when volatility increases, the ATR expands, and when volatility drops, the ATR contracts. ATR gives us an objective way to place stops that respect current volume conditions. It removes all emotion and guesswork from one of the most important decisions you'll make in trade management. Although the risk tends to stay within the same parameters on a day-to-day basis, sometimes it is far above or below what is usual, and that does not mean that we don't trade, it just means we need to adapt to current conditions. Now that we've discussed every last aspect of what this indicator involves, it is time to release it to you guys. So I'm going to pop it up on the chart here. It is called ZenLab All-in-One. You go down to the description of this video and you can gain free access to it. There's no subscription, no strings attached. You simply tie it onto your TradingView chart and it's going to make your trading day easier while trading the ZenLab system. So what it involves is session highs and lows. It also involves our 13 period moving average. It also has news, which will be spoken about in the bonus video of why we don't trade high impact news. So it is letting you know with a vertical line exactly when that news is going to be released. And it also has what we're speaking about today, which is the average true range indicator. What we use is a 20 period average true range. And this is what that actually means. So if we were to calculate the volume of these last 20 candles, because it's a 20 period. So if we were to grab our measuring tool here and measured out the last 20 candles, like this one's 13 and so on and so forth, the average between all of those numbers is going to be 11 as of right now, which is very credible to what we're trying to do here. We're trying to have a stop loss based upon the current market volatility instead of just having a set stop loss. And now we don't have to have any type of guesswork or calculation. It simply just shows it right here for us. So we're waiting till we get to session open. I've went ahead and already put in these blue lines. That's not a part of the indicator, just showing you when session opens. Obviously, you have session highs and lows here and when it opens, but it doesn't start that gray box until it gets there. So I put this up so we can visually see. But we mark out charts, about 10, 15 minutes before session open. And now that we're 5 minutes before session open, we have a 12 ATR. Okay, so over the last 20 candles, each individual candle on average is printing about 12 points. And so our stop loss is never going to be below 25 points. So if we're reading below a 30 ATR, we're going to use a 25-point stop loss, even if it's reading a 10 or a 12 like it is right now. And then if we're reading from a 30 to 40 ATR, we're going to use a 30-point stop loss. If we're reading from a 40 to 50 ATR, we're going to use a 40-point stop loss. If we're reading from a 50 to 60, we're going to use a 50-point stop loss and so on. Now, once we get up to like 100 ATR is when I'll usually walk away from the day. That means there's some type of economical news release that is creating insane volume that is extremely rare. And so that would be a good time to potentially reassess and walk on the next day. But anything below that, it is a good day to trade. We just got to make sure that our stop loss is in alignment with current market volatility. Okay, so let's give, for instance, this day, we're 5 minutes before session. Let's say we have a resistance sitting up here. We have a support sitting down here. So this is the range that we're currently looking to trade in. We start breaking above previous session highs here, and then we're re-breaking back above with volume and also breaking above resistance. This is what's called a bread and butter setup, which we'll have a bonus video with later on as well. All day long, we're going to take this trade. And as we see here, we have a 12 ATR, so we're going to be using a 25-point stop loss and chasing higher RR. Regardless of what's going on, this is high probability trade, and we're definitely going to take the trade. And then moving on to the next day here, let me fast forward. And just so you know, on this indicator, you do not need to have this box up. You can go into settings and remove that box if you only want to see the red lines instead of actually all these different news releases, which is what I like to do so myself. I like to have it as clear as it possibly can. Okay, let's go back down. Now that we're close to it, we're going to come about 5 minutes before session open here and do the same exact thing. We have a resistance sitting up here. We've already broke above session high, so it's another little bread and butter setup. We have a support sitting right down here. And if we break below that before session open, let's see here with another few candles, we also have a support sitting all the way down here. Okay, so this is the range that we're going to be trading within. So now that price is already broken below these lows, we can go ahead and hop in. Now this is 5 minutes before session, so we're obviously waiting for session to open. And myself, I'd probably wait to see what type of reaction we get down from this low, but that's in another video when we put confluences together. We're simply just showing you that if ATR is reading 15 right now, which is still less than 30, we want to use a 25-point stop loss here and chase for high RR to some degree. Okay, market opens up. If we get some type of reaction, we'll go ahead and take that trade. Now, something I want to show here is a very good example. When we were speaking about in the previous lesson about moving averages and ATR and how everything is with that current volume, this is where discretionary trading may potentially come into play. You see here, we have our median of price sitting here. We also have our stop loss, which is right at that ATR. A lot of the times, because we are so close with our parameters, price is going to come up close to our stop loss. Our moving average is going to be sitting right there. Our stop loss obviously sitting right there. And within a few seconds, it may tap it and then continue lower. And that's just simply because our stop is so tight as far as what the actual volume is during that set period of time. Over the course of time, when you acquire experience and data and discretionary trading comes in, you start to acquire intuition, which can only come from experience. These are a lot of times you'll see me in live trading sessions. I may potentially hold this trade a couple seconds longer just to see what will happen because we just came right back up to this rejection area and we may potentially continue lower. We also have that moving average that's sitting right there and obviously our mechanical stop loss. And let's go back to this trade real quick just to see. Look at that same exact thing here. We ended up getting in somewhere around here. We use a 25-point stop loss. You'll see so many of your trades will come very close to that stop loss area, but moving average is still holding. And I want you to understand the reason why that is we're trading during the exact range of that set period of time. And so if price were to reverse beyond, at the last 20 candles are telling us we were printing like a 12 to 15 point stop loss, and we start to retrace away from that more than 25 points. It's probably a good indication that price is breaking out of that current range and our idea is incorrect. Same thing if our idea is correct. So it's a good indication to get out. But again, reading reactions during live markets, you'll start to see a lot of times our moving average is sitting directly right at our stop loss. And sometimes we give our trade a bit more room, a bit longer of a chance to play out before continuing on. And without having that intuition, you potentially are opening yourself up to emotional trading, which a lot of traders do. And that's why I don't teach this tactic until way later on when you acquire data and allowing for data to speak for itself by holding that trade. Now you're emotionally trying to marry that trade, hoping that it's going the opposite direction, which is definitely a no-go and an account destroyer for people who don't have experience. No matter how volatility changes from day to day, your stop loss is now going to be aligned with the current market environment. So you will be giving your trades room to work without exposing you to unnecessary risk. And this is how we maximize risk to reward while dramatically reducing the chances of getting stopped out simply for being too tight with our stop loss. Up until now, everything we spoke about is about building a trade idea, like liquidity, sessions, support resistance, trend, and risk management. But none of that actually confirms the actual trade idea. And that's what a breakout is for. We're going to speak about how to actually execute a trade based upon multiple confluences. And the only way we can get into a trade is if a breakout is involved. And most people think they're trading breakouts, but what they're really doing is anticipating them, chasing them, or forcing them. And that is the reason why breakouts usually don't work for most traders. In the system, a breakout is not impulsive or rush, it is a confirmation. This is the point where the setup actually turns to execution, and it is the literal backbone of the entire Zen Lab system. A breakout isn't just price moving, it's price expanding past a decision area, which you now know is support resistance with participation behind it. That expansion is what tells us the market has chosen a direction, and if all of our confluences point towards that direction before it happens, we have a strong incentive to take it, and we also gain a higher probability it will play out in our favor. A breakout is not guessing, it's not entering before confirmation, and it's definitely not price simply touching a decision level. If you're early, you're wrong in the system, and although a breakout is the final non-negotiable confirmation, it can never be the only confirmation. Breakouts remove execution because they force patience. Instead of guessing or anticipating, you're waiting for the market to confirm your idea with momentum. And that confirmation gives you three things before you ever risk capital, which is direction, participation, and a clear point of invalidation. It's like waiting for a green light instead of inching into the intersection. You're not being slower, you're just being safer and more consistent. That breakout tells you the market is ready, and until then, there is just no trade. Breakouts are where all confluences finally meet. Timing, structure, momentum, and risk management align into a single executable decision. And in the next lesson, we're going to fully break down how to stack the confluences you learned correctly so you know exactly how many you need, which ones matter the most, and how to avoid overcomplicating entries. This rule keeps you at a low probability chop and random movement because as momentum breakout traders, you should now understand breakouts confirm momentum. You have to understand a breakout without volume or context is just noise. And that's why this rule never stands alone. It's validated by Confluence. Now, there are two ways to approach breakouts, which is mechanically or with discretion. Discretionary breakouts are not required to be profitable, and for most beginners, they actually cause way more harm than good because they lead to hesitation or late entries or not even entering at all on a valid trade. And that's why the system always starts mechanically. As a beginner, a breakout is very simple. You get Confluence, you get a clean break of a level, and that means take the trade. This removes any type of decision making in the moment and allows you to build consistency, confidence, and of course, data. Over time, as you gain experience watching live markets, those decision levels begin to turn into areas of interest rather than exact trigger points. So instead of instantly entering on the first break, experienced traders may wait to observe the initial reaction because this is a decision level, looking for strong continuation with volume versus maybe hesitation or choppiness, which can lead to a signal of a liquidity grab. As scalpers and day traders, this reaction happens really quick, often within seconds to like a minute of the mechanical breakout, but learning to read it can save you from a ton of false breaks. This level of discretion is very powerful, but it only works after you've built a mechanical foundation. Mechanical breakouts are like learning proper shooting form. You're not going to improvise your shot on day one. You're going to repeat the fundamentals until they're automatic. Discretion simply comes later after you've taken hundreds of shots to understand why adjustments work. But for now, we're going to focus strictly on mechanical breakouts, and you guys are going to watch my discretionary breakouts by watching me trade live every single day as you acquire your own data. And I'll show you exactly what that looks like on the charts. So we're back on the charts. I have already marked up the last couple days of support and resistance during New York Stock Exchange Open, the same time, 9:30 a.m. Eastern Standard Time. So let's go ahead and go back and we will start from there. Okay, now you guys understand the area that we're going to wait to break out from is decision areas, which is support and resistance. We're waiting for price to break above a level of resistance, which is your ceiling, or break below a level of support, which is your floor. So we wait for 5-10 minutes before session open. We're marking out our most recent resistance, which is the area that price came up to and for some reason or another had a tough time breaking beyond. So it created a high, a valid level of rejection, which is a resistance. And we're marking out our most recent support. For some reason or another, price came down to that level. It rejected away from it, creating a valid level of reaction there. There's something sitting there that's not allowing for price to continue lower. That is a valid level of support. Now, as a breakout goes, we're waiting for confluences to add into this breakout, but if we had multiple confluences and price were to break above these highs here, the top of that resistance, which is going to be the top of this wick here, this entire range, we would mechanically be entering into the trade. Or on the opposite side, if price were to open up and start to push below these lows, we're going to mechanically get into that trade as long as we have other confluences lining up with this trade, okay? And that this system will still be profitable for you executing that way until you acquire data, until you acquire experience in the live markets, until you transition into having intuition and start a bit of discretionary trading. And that's what this looks like here. When you start to have discretionary trading, you have an understanding of reactions to these decision levels once they come up to it. Your job is no longer to take a break above these highs just because we have confluence when we break above that high. You're viewing this as a decision level. So price comes up to this point, and within 5 seconds to about a minute, you're gonna see, are we gonna have an opposite end reaction and continue lower? If we come down to these lows, are we gonna have an opposite end reaction and continue higher, or is it actually going to break out and continue lower? I want you guys to understand the mechanics behind this. The reason why we drew a resistance in the first place is because the last time the market decided to come up to this level, it reacted away from it, giving us a high, which is a valid decision level. Same thing with lows. The last time the market decided to come down to this point, it rejected away from it, and that's why this is an area of interest to us in the first place. And so who's to say next time it comes and visits this level that it's not going to do the same exact thing as it did the first time, and the reason why we located in the first part, and that's where discretion comes in. But again, with mechanical trading, as long as you have multiple confluences, you will absolutely be profitable by taking those mechanical breaks. You just need to have confluence on your side, okay? So here, if we're mechanical, we have a high sitting up here. You can mark with a horizontal line instead of the area, a low sitting down here. Let's say we didn't have too much confluences for shorts here, but buys, we have confluences. Maybe we're breaking above previous session highs. We also have a moving average on our side. And obviously, we're always going to have volume on our side because you're only trading during periods of high volume. Then if we were to break above that level, we can go ahead and take a trade. Okay, so we broke below lows. We only had the confluence of the breakout, so we didn't take the trade. Price starts to break above these highs, and then so we'll go ahead and take the trade because you have confluence on your side as well. So boom, you enter this trade, you're going to see what your ATR is, and you're going to expect price to continue on in your favor. Okay? Moving on to the next day, I want to do two more of these examples here. Waiting for about 5 minutes before session, You're going to mark out your support and resistance. We have a resistance sitting all the way up here. You have a support sitting all the way down here. So let's say we only have Confluence for buy. So if we start to break above these highs mechanically, we'll go ahead and get into the trade because we have multiple Confluences. But if we start to break below lows, unless we get other Confluences, probably just not going to take the trade, okay? Because we're very bullish right now, whatever the case may be. So market opens up, very next candle. We start to push. Okay, we ended up not getting into these sells because we didn't have enough Confluence to get into the sells. Kind of hovered around that area and then price pushes lower. So we probably just would have stayed out for that day or waited for some type of new structure to form and then taken that trade. Okay, very simple. So the thing is understanding this over and over again. While you're learning to acquire discretion, you're simply taking mechanical breaks above the high or above the low based upon confluence of the trade idea before you get to that point. Once you acquire discretion, not everything, things change a bit. You're viewing these levels as decision levels. Confluences are still the same, but we're waiting for price to come down to this level. If we get some type of opposite reaction, even though we broke below lows, we're going to stay in. But if you push with heavy conviction, we get heavy volume behind that move, we're going to go ahead and enter in the trade. May get a bit more of a rougher entry than a mechanical breakout trader because we're simply waiting for reaction. We may get a entry sitting down here, but the probability is going to be heightened a bit because we're waiting for that momentum to follow behind the breakout. And for our last, let's do one last example here. Whoops. All right, so one last example here. We have highs sitting right here. We have a resistance sitting up here. We have a support sitting down here. Let's say we only have Confluence for buy. So if we were to buy, we're going to buy sitting above this, the top part of this range, which is all the way up here. But as discretionary traders, we know that our resistance is sitting in this entire area here where price continuously rejects, even though it broke a bit above here. So once price gets to this level here, if we continue to react and we get volume beyond it, now we may actually be getting a better entry than mechanical traders. Mechanical breakout traders are always getting it at the top of the range or the bottom of the range, nowhere in between, until you start viewing these as decision levels. Okay, market opens up in the next 5 minutes. Obviously, we can't tell discretion, so we don't really know what's going on here. We didn't take these shorts because we didn't get enough confluence to take the trade. Price starts to push up. Okay, so mechanical's getting in up here. Maybe discretion's getting in down here. Obviously, we can't tell. It's not live market. And you're expecting price to continue higher for both ways based off of the same thing. Confluences leading up to this execution of this trade idea. Up to this point, we've spoken about all individual tools, but not any single tool makes a trade work. Trade works when multiple things agree. So today we're going to be talking about confluences and how to stack them together to make a higher probability trade setup. Confluence simply means you have more than one independent reason for a trade idea. It's not lagging indicators agreeing or no lines overlapping. It's just multiple independent factors of price action pointing the same way. Now, most traders think more confluence means more safety, but in reality, more confluence often means more hesitation. You second guess, you're probably waiting, and by the time you act, the move is already gone. In the ZenLab system, every trade is built on a minimum of 3 confluences, but 2 of those are non-negotiable because we already trade during high volume periods and we only enter on a breakout of support resistance. So because of that, those first 2 confluences are always present by design. And then from there, we layer in at least one more confluence like session highs, lows, trend lines, or trend or a moving average being in our favor to strengthen that trade idea before we execute. This gives us enough conviction without overloading the decision-making process. The ZenLab system is built around fast, clear decisions because we're scalp/day traders. And these confluences are simple to identify, but they are really powerful when they align with each other. Now, confluence doesn't mean a trade will work. It just simply means the trade makes sense. Everything in the system is built around probability, what happens more often than not, but losses will still happen. The difference is now they happen inside of a plan. A structured plan you can document, review, and refine over the course of time. And that's how edges are built, is through real market data. In fact, that is exactly how I gained the edge I am teaching you in this blueprint. Trade based upon confluence, document outcomes, and refine one thing at a time over the course of time. We will dive deep into how to make your edge stronger over the course of time in this course using the journal template that you guys are all getting for completing this course. Up until now, we've been stacking pieces together: time, volume, structure, psychology, risk. This is where all of that turns into one repeatable decision. This is not a strategy you memorize, but a process you execute consistently. You should now understand the system is not about waiting for a single signal or setup. It's about allowing for multiple confluences to come together to give you a higher probability setup. This is how we build and execute a trade idea step by step. You're going to analyze high volume periods of price action. You're going to mark up your confluences. You're going to find your ATR based stop loss, and you're going to execute a breakout using at least 3 or more confluences. And the biggest step, just allowing for probabilities of that idea to play out. There's nothing less and nothing more. This model works because you're removing discretion at the moment of risk. You're not trying to decide what to do when emotions are active. You already have a plan set in place before we even get there. This is how execution stays clean. Think about a pilot for a second. They're not trying to figure out what to do while they're taking off. They have a plan set in place, so when they hit the throttle, it's just execution, no hesitation. The system works the same way. Once price reaches your level, there's no debate. It's just simply valid or it's not valid. There's no improvising midair. And this is why the system is mechanical by design. You gain confluences, you see a breakout, and you simply execute the system over and over again. You don't need discretion to be profitable, you need consistency. And mechanical rules protect you while you're still learning. They help you with hesitation and second guessing and changing plans right up at the point of risk. Now, discretionary trading does exist within the system, but way later on in your career once you acquire data and real live market experience. Discretion comes after mastery and not before. It's not guessing or feeling or reacting in the moment. It is something that you understand to be true because you've seen it so many times before. As a beginner, discretion usually leads to late entries or no entry at all, and that's why we start mechanical. Over time, mechanical breakouts turn to areas of interest. You start reading reactions instead of forcing entries mechanically. You start to recognize false breaks and you let volume confirm participation. That comes from experience and not trying to get too advanced too early. Mechanical execution leads to data, data leads to confidence, and confidence leads to discretion. Most traders get that backwards, and that is the reason why they fail. Every trade you take after tomorrow's lesson should be explainable, and if it's not, then you simply should not be getting into that trade. So without further explanation, we're going to take all of this information you learned into the charts. You're going to see real chart examples of how the system plays out. And as always, if you want to watch me trade the system live every single day, make sure you subscribe and turn on notifications, and don't miss any lessons moving forward to live sessions. Section 4 has been all about understanding the ZenLab blueprint system, exactly how to trade. You guys understand why we can invest in the markets, what Forex actually is, the psychology behind everything. This whole section was just about how to actually trade the system, confluence by confluence, going through all of the rules, and why it's so important to stick to one system. So now we're taking everything to the charts. And I want you guys to understand, even though you're going to have a lot of aha moments within this video as we run through a back testing session, you have to understand nothing is going to 100% click just because you watch a long video or a multitude of videos within a short period of time. It is the consistent action every single day of trading the same exact system over and over and over again, where you're actually going to acquire confidence, which is going to turn to good execution so you can become a profitable trader. So just keep that in mind as we go through this, collecting data of everything you do moving forward from after this video. One, you should understand exactly why you're getting into a trade. And if you don't get into the trade. But two, just acquiring data by journaling everything. And I can guarantee you, over the course of time, you're going to understand exactly how to execute a profitable system, and your edge is going to strengthen over the course of time because you can answer one question, which is more often than not, what can this system do for me over the course of time? So let's get right into it. So now that we're on the charts, we want to map out all of our higher time frame zones for one, and then we're going to mark vertical lines for every single trading day that we're going to trade. For the most of you, you're going to pick one session. So you're either going to trade during Asian, London, or New York session, or maybe even PM New York session. And so there's no need to back test or acquire data based on other time periods, at least yet. You need to focus up on when you're actually going to be in the markets and obviously acquiring data for that time period. So very first things first, we're going to go up to 4 hour and 1 hour time frame, and we're going to mark out where current rejections are at. This is where current market price is at. So we'll go back, let's just say like 2 weeks. Today is 114. So we'll go back to like 12.15 or so. All right, so we'll do about 2 weeks of price action. And so here, before we even go down to marking our vertical line, so we understand exactly when to trade, we're going to mark out higher time frame areas of rejection. This should be pretty simple for most if you've done this a couple times. If not, it could be a bit tough first starting out, but just please understand this one thing. When we're talking about marking out support resistance, it's simply where price has visited multiple times on higher time frames and has had a tough time breaking beyond that level. We don't care to go too much to the left. We simply just want to mark out where price is currently at. And so once price gets out, like if we're marking out an area that's thousands of points away, that's fine for later on in potential price action, in a couple months and such. But we really want to mark out where price is currently at and be very concurrent with where we want to trade our levels, because it's starting to mark out and have levels sitting all the way down here, and then we have another level sitting up here, and we're just constantly pricing out more and more areas. Your chart just starts to get cluttered, and there's just simply no reason to have such an overload of information when, as you know, we're very current scalp traders. So we're going to mark out three areas. We're going to have a resistance sitting up there. We're potentially going to have a support where price is revisited multiple times. And then if we're sitting in the middle of price, which we're not, at least for this session, we would mark that out. But until we break below this low or break above this high, there is no need to go any further than where these current reactions are at. Okay. And before we move forward, why did I mark out this area? Because a multitude of time, one time, second time, third time, fourth time revisiting this area, we're having a very tough time breaking beyond that level. And so once price pushes up to that area, if we can go down to lower time frames and add volume with it, potentially add a trend line with it, when price starts to break below low and we're already reacting off of that resistance, it's probably a good indication price is going to continue lower. But once we get to that reaction area and start to break above it, let's say we get some lower time frame resistance forming, we're breaking above previous session highs, we have a trend line that's holding on the bottom side, and we're during a period of heavy volume. Well, it's probably a good indication that price is going to continue higher to this next level of resistance. And that's all we're playing off of. We have our bumpers here, which are higher time frame support resistance, and then we're going to lower time frames and trying to acquire a picture as to why price is probably going to go in that direction. Now, before we go down to any lower time frames, I want to make this extremely clear. All these 4 hour and 1 hour 4 hour, 1 hour areas of rejection, which are pretty much, but I just marked them out in blue so that they can be differentiated. All they simply are is a confluence to strengthen our trade idea. That is all that they are. When we go to lower time frames and we have a volume and a breakout entry, those are the guarantees what need to happen with every single trade. And obviously time aspect, trading during that time, that is the only two things that guaranteed need to be a part of every single trade. We can still take a trade if price is pushing into a 4 hour support, but understand then we don't have that confluence on our side. But if we have a trend line holding, if we have a previous session highs or lows holding, we also have volume on our side and get that breakout entry, I will still take that trade because we are confluence traders first. And nothing can stop us from taking a trade except not having a breakout entry, and two, not trading during periods of high volume. So just want to make that very, very clear. So these are going to be our areas of rejection. Now, secondly, let's mark out when we're going to trade, which is going to, for this session, is just going to be New York Stock Exchange open. So let me do that real quick where I mark out um, pretty much 9:25 or 9:15 every single day, or 9:30 every single day, so we know exactly when we're going to trade. And then we'll mark out our sessions 15 minutes before then and then get to it. So I'll fast forward this part. All right, and that's as far as it'll let me go. So now we have the first two things lined out. We have our actual bumpers, or where higher time frame price has been reacting in the past. And now we have our time aspect. We're only trading during New York Stock Exchange open. So we want to wait 15 minutes before we come to this vertical line. We'll make our markups. Once that market opens up, then we'll go ahead and take trades from that point. Now, as I go to lower time frames, you guys have to understand one thing. During this back testing session, we're going to be very mechanical. If we have confluences lined up, we're going to take a trade. But how you're going to acquire experience to become a discretionary trader is by watching these reactions at areas of reactions in live markets over and over and over and over again. The system is pretty simple. We're waiting 15 minutes before session open. We're marking out a resistance. We're marking out a support as close to prices we possibly can. And then once we come up to those areas, we're simply taking a trade based off the confluence we have there, plus the reaction we're getting. But you can't see a reaction while you're back testing. You simply have to take the break or you don't take the break, which is fine as a starting trader. As long as you have confluences lined up, you can be very mechanical with it. If price is sitting at a high here and you have a trend line holding of some sort, so you understand that price is continuing higher, potentially at previous session highs and lows that are holding as well. Okay, we can mechanically take the trade. But how you're going to up your edge and become a more experienced trader who's potentially taking trades that mechanical traders won't take is not going to come from being in the live markets for a couple weeks. It is documenting every single trade, watching the live markets form at these levels of reaction, and then making intuitional based decisions over the course of time because you've seen that reaction at these same areas over and over and over and over again. Okay, so first things first, we're on a 15-minute time frame. We are 15 minutes before session open. We want to mark out our most recent support and our most recent resistance. As of right now, we have no resistance form. We have a support sitting down here where prices came down to, and let me mark this out in gray. We have a support sitting down here. We have no resistance. We have resistance all the way back here. The last time that prices revisited an area and had a tough time pushing past until we did. But that is way far away. That's an entire 100 points away. And so we don't chase price. We're not looking too far to the left. As I told you guys, we want to be concurrent with where price is currently at. And so there's simply no buy setup for us right now. If the market opened up and it just continued higher, well, then there would simply be no trade for us. So that's 15-minute time frame so far. All I see is the support sitting down here. And previous session highs and lows, we are well beyond that area. We'll go down to 5-minute time frame, see if there's any other levels of rejection that we can play off of. There is. We have our area of rejection sitting up here. Okay, so this was the previous range. Price was breaking in between this area over and over again. Every time we came up to these points, we're reacting till we pushed higher. And then we had that resistance level sitting up here, but we just broke above it. So we're kind of breaking out of yet another range. And now in 5-minute time frame, we even have a support that's even closer to price. So at this point, there's only one thing that can happen. When price opens up with that very next candle, we start to get a reaction from this area. We'll potentially take a trade if we have confluence on our side. If we don't have confluence, we won't take the trade. We'll expect price to create some type of new resistance take or come down to this level. And if we have a confluence, as far as one more, we already got our volume aspect because we're trading during high volume. We'll already have the breakout because those are guaranteed rules for every last one of our trades. We just need a potential trend line to hold. We need to be sitting below a moving average to hold. And then that's the third confluence. We can go ahead and take the trade. So let's see what happens with this next candle. Okay, so price sent it to the floor. So this is a tough area here. When price broke below this low here, this very first one to take a short. Well, what confluences do we have to go ahead and take this short sitting right here? Let me mark this up. As you see, ATR over here is reading 16. As long as it is below the 25 or below 30, we're using a 25-point SL. So this would be the stop loss. And then we'll just do like a 1 to 2 for every last one of these trades. And we'll talk about why here in a bit. There would be no third confluence for us to really take a trade. The moving average was still holding at that point. We're extremely bullish. We've already broken above previous session highs. So there's nothing telling us to short the market damn near in the middle of nowhere. Okay? And so there's nothing to do at that area of reaction. So once price started to break below those lows, all right, there's nothing we can do. Moving on to the next area of rejection. Okay, we get down to this area of rejection. Now do we have confluence? Well, one, we have volume on our side because the market's now open. And two, we have a breakout because we're breaking below an area of rejection. Last time we came up to this point, we're having a reaction. We're coming back down to it again and see what's happened. Three, do we have any trend line that we're breaking below? Well, we have a two-tap trend line sitting right here. So that was kind of the third hold, so it's a bit risky. Are we trading below a moving average? Yes, we're now sitting below that median of price. So over the last couple candles, price has been bullish. As long as we sit above it, we're now sitting well below that as well. So we have 3 confluences to go ahead and take this trade. All right, so let's say we hop in right here. ATR is still reading below 30 on the 5-minute time frame, so we still use that 25-point stop loss. Where are we going to take price to before we do anything moving forward as far as management goes? All right, so right here, as soon as we get in, we got in because of an area reaction. Well, we could potentially look to get out for the same exact manner. Once price comes down to this low, let's say first, before we get into that, let's say that we hop into a trade and there's no rejection area coming up. There's no support coming up. There's no area of reaction coming up. We just have clean traffic all the way until we come down here to this level. Okay? Then there's really not much for us to do. We're not trying to take partials out. We're trying to hold for higher targets. This would be sitting at about a 1 to 3. But if you have a reaction area in your lane, which is sitting right here, the reason why we marked this out in the first place is because last time price visited this area, we've had a reaction. So who's to say the next time price comes down to this level, we're not going to have some type of reaction again? And so when I have these trades where I don't have clean traffic, I like to take out partials at a 1 to 1, usually anywhere between like 30 to 50%. Again, you have to acquire your own data. I'm just letting you know what I do. And then from that point, if we don't get a reaction and we continue lower, great. I'm really just expecting price to come down to that next level of rejection, which is sitting all the way down here. But for the most part, with my data, not too many of my trades run beyond like a 1 to 3, 1 to 4. So I usually always have my full target be a 1 to 3, which is this trade so happens to be sitting at that 1 to 3. So at this point, we've already parceled out most of our position, 30 to 50%, and we're expecting price to continue lower. Now we do have that trend line in the way, so discretionary wise, we'll still try to add into this back testing session. If we start to come down and start to bounce off of this trend line, this is the third tap to this trend line. So now you know that all traders are a trader's not going to see a trend line during its first tap because it hasn't formed yet. Once you hit that second tap, that's when all traders are connecting the dots. And then the third tap, that's when everybody's seeing it. So there's going to be a lot of buyers sitting there. And so a lot of times you're potentially going to get a reaction from that point. May have to sacrifice a bit R to R, but if it starts bouncing without just hitting my 1 to 3 or coming to this area of rejection, which is support, probably just going to take out my position. But that's when discretionary comes in. As far as mechanical traders, same exact thing. Price comes down to an area of rejection, take out a percentage of your profits, and then wait for price to hit a 1 to 3 or that next level of rejection before deciding to remove yourself. That is all we're doing every single day. All right, so next candle opens up. Let's see what happens. Okay, this would have been taken out break even. We would have got our partials out of the system and taken out break even. Every single time you come down to a level of rejection and you remove your partials, anytime you're removing partials, period, you're putting your stops to break even. Okay, so as soon as you pull out, putting stops to break even. If price were to come all the way back up, fine, it takes us out. At least we got our profits for the day, and we move on at least to the next setup. If you're not moving on to the next trading day, okay. Something like here, yeah, is it frustrating? We came all the way back up. We tapped us out by a bit, and now it looks like it's about to send it at least to this next rejection level. That's trading, bro. Understanding psychology, over trading, greed, whatever the case may be. You're not going to try to enter right back into this trade. The setup has already happened. You've already followed your risk management plan. You're simply waiting for the next trade to play out. Okay, and we'll see kind of what happens with the rest of this trade. Okay, looks like it came back up to that rejection area. If you see, let me kind of zoom in here a bit. Price looks like it came right back up to kind of reject off of this level one last time. As you guys know, they're like magnets. More often than not, when we come up to these areas, you're going to have a reaction. That's why we drew them in the first place. And then it started to continue lower. And now look what's going on right here. Well, price came down not only to the area of rejection in the form of a trend line, but a level of rejection in the form of support. So there's a lot of buyers sitting in this area, and it looks like we're continuing higher. So if let's say we weren't to get taken out of this trade, I'm definitely going to be pulling full TP here at TP3 for a multitude of reasons. One, I don't really hold beyond 1 to 3 as a scalper. Two, we have that trend line sitting right there, and then three, we have that level of support sitting right there. So we'll go ahead and move on to our next day. Whether this tanks or continues higher, we don't care. We would just be moving on to our next setup or moving on with the next day because we've already profited for the day. And price ended up sending it for sure. All right, so I'm gonna fast forward to the next day. Okay, so here we are now, the very next day. Okay, we're now trading below a 4 hour support. We were trading above it before. And so we simply expect price to continue lower. So before we now, let me back up a bit so we don't cheat. Before we go to that next level, we want to go to 4 hour time frame and now mark out our next level of rejection because we're out of that 4 hour range. So now we want to calculate our next 4 hour range. And that's just sitting down here. We have a level of support sitting down here. We don't have more than one reaction here. So I guess it's not the strongest of level, but this is our next range that we're playing in, okay? In between this area and in between this area, all the way until we break back above or break back below. This is the area we're going to play in. And then once we go to lower time frames, we're simply going to try to build confluence to trade based off of what's going on. Right now, we've reacted off of the support and ended up instead of bouncing higher to go to the next, we just continue lower beyond it. So now we simply expect price to continue down to this next support before making its decision from that point. Are we going to hover and then continue higher, or are we going to break back down to our next level of support? That is just simply a confluence. We have to go to lower time frames and use volume to decide what we're going to do. All right, so going down to 15-minute now that we have our new range, we got a couple things going on here. So one, our resistance area. We have a resistance sitting right here. Oh, let me go to my bad. Let's go right before session open here. Remember those red lines are just news. We don't like to trade right at that news release, so we'll try to position ourselves beforehand. If not, we'll just simply wait till afterwards. And now we're 15 minutes before session open. So we have a resistance sitting up here. We have a support sitting pretty much right where we're at. And then we have another support sitting all the way down here because it looks like we're already breaking through it. I can extend it to left. I really only care about where price is currently at, but when you push the right to left, I mean, this is a nice level of reaction that is continuously holding every time we come to that point. So next time we come to this area, we can expect price to react away from it, which it's doing right now at the current support we're at. Now that we're breaking through, we simply just expect it to come down to this next level of rejection, which is support. So we'll try to see if we can position ourselves. Same exact thing every single day. Go down to 15-minute time frame. Okay, we have 5 minutes before session open up. So if session opens up here, we start to get some type of top wick before continuing lower, we may take a trade at this point. If it's a bit too risky or if price just opens up right away and sends it down without giving us any confluence, well, we're just going to have to wait for the next setup. One thing that new people have to understand, which I know a lot of you more experienced traders have to understand, is this very simple thing. When we look to the left at all these previous candles, more often than not, every candle has a top and a bottom wick. And so the likelihood of this next candle opening, if it just opens up and starts to send it, the likelihood of it coming back up to create some type of top wick, some type of high before continuing lower, as you see to the left that all these candles form, is probably about 90+% that that's going to happen. And so that's why I don't like to, if price is sitting right at a level of rejection, the market opens up and it starts to send it lower right away. I really try to wait for a top wick before I get into the shorts or a bottom wick before I get into those buys, just because the likelihood that that's going to form is going to be really, really high. Okay. So let's see what we got going on here. Open up, candle open here. We don't really have any trend lines to form off of right now. We've already broken out of previous session highs, but we came right back within the range. So maybe we're chasing previous session lows sitting all the way down here. But we don't have much of a setup as of right now. We got to let a candle develop. Okay, price pushed up. This very first candle price came right back up into this 15-minute level of rejection, which we'll go back to show you that again. Okay, right back in this 15-minute level of rejection. So once we come back up above that point, well, what type of confluence do we have to go ahead and take the trade? Okay, let's say we were waiting for a break above these highs. What confluence do we have for that trade? Well, we have a volume break above high, so that's one confluence. Two, do we have any type of trend line break? No. Are we sitting above the moving average? Yes. And obviously we have volume. So this is a three confluence trade. As a mechanical trader, as soon as you start to break above the highs, it's honestly, I mean, these highs have already been violated, so really should probably wait for above an actual high sitting up here. But you can mechanically get in as soon as we break above these highs, okay? Because we already have confluences on our side. Now, as far as a discretionary trader goes, we may get a lower entry because even though this isn't the actual high, the high is sitting all the way up here. We're waiting for the reaction at this area, which has happened from the past. If we get heavy volume pushed and pass through it, which again just takes time to understand, we'll take the trade right away. But if not, we start to react the opposite way. Okay, cool. Looks like buyers are not in control. We'll wait for price to come back down here and decide to do it at this point. Okay, so let's see what happens the next candle. Okay, price breaks above, starts to react from this area yet again. This is 5-minute resistance sitting up here. Mechanical traders may have gotten in. discretionary traders, we simply just don't know. And we're continuing on from this candle. So let's say we didn't get in yet. We're still now waiting for price to either break back above this newfound high. Let me put this back up there. Or if we start to react from this area, we're not taking a reversal trade. So if we start to push lower with this next candle, we're not going to sell off right here. Every trade needs to have a breakout. So we'd be waiting for us to come down to support and then making a decision from that point. Very next candle opens up. Okay, we start to push lower, and now look what's happening right here. Same exact thing. We come to a level of rejection. The reason why we drew it in the first place is because we're reacting from it every time we come lower. Price starts to push away from it. So now from this point, if we come back down to that level after having that opposite end of reaction, that's giving you an indication that sellers are more in control. And so you can go ahead and take that trade shorter. ATR is reading a 45. You know, from 40 to 50, we're using a 40-point stop loss. So it'll be sitting, pretty much around here. And we would just be expecting price to come to that next level of rejection before deciding what to do from that point. Now, we'll take this trade if it continues lower, but in real market conditions, you see this red line sitting right here. That means we have news coming up. I don't trade news releases because we have such tight stop losses, and so we would simply be waiting for the next move. But let's go ahead and see what happens, just because from a mechanical view of what's we got going on here. Okay. What it ended up holding at this level of support again. And so we would either got taken out here as a discretionary trader. We would have watched it hover around this area and said, okay, we're going to wait for after news. Let's say it's after news. We're sitting right at this rejection level again. It's like same thing. Mechanical traders are waiting for a break above these highs. They're getting in. We have no news in the way. There's no way we can avoid this trade now. We have all of our confluence on our side, moving averages on our side. So trend for that time period is on our side. We got to break out above an actual high here. And we have volume on our side. Not really any trend line yet. This is probably going to be a hitter if we push above. Let's go ahead and take the trade if we break here. Okay, we broke. ATR is reading 54. I don't know what it was before. Let me see what it was before this candle. 52. Okay, so that's a pretty big stop loss. I honestly probably won't use that big of a stop loss, but we're expecting price to come up to that next level of rejection, which is sitting up here. Okay, and if we got killed, that would be our second loss of the day. We would simply be moving on, not chasing targets, not figuring out what's going on next. It would just not be our day within the markets. Okay, price pushes up. Price ends up pushing lower after coming up, 60, 50 points here. Okay, so same exact thing. If we don't have any type of rejection in our way before coming up to highs at a 1-to-1, we're going to be taking out like 20 to 30% of the position, expecting price to continue higher. But for the most part, every time you hit a 1-to-1, you're putting your stops to break even, protecting your position, and then if it comes back, it is what it is. Remove yourself from the trade. We're scalpers. We're not trying to hold on to our positions long term. We want to see the fulfillment of that idea within like 5 minutes to an hour very max. Okay, so we end up breaking even with the rest of this position here. Moving on to the next day. Doesn't matter what happens from this point. We would just be moving on. But as you see, before I go on to the next day, these areas of reaction, price is constantly doing the same. Once you start to understand areas of reaction, price is simply just bouncing off of them all day long. That's all it does. Over and over again, break through it and then bounce between the new range over and over and over again. Okay. So now moving on to the next day. Whoa, look at that price act. That's a tough day to operate in. Very, very, very tough day. Okay, moving on to the next day. We're having a really tough time breaking past this 4 hour resistance. Okay, looks like price is holding over and over again. We've had this hold here all the way until we finally broke through, and now coming back up to a holding for the first time, second time, and damn near third time sitting right here. So that's just a confluence. Not saying we won't take buys just because we're reacting off of it, but if we start to trade below this and we get a confluence of a breakout and we get a confluence of a trend line break, probably a good indication price is going to start pushing down to that next level of 4 hour support. Okay, go down to 15-minute time frame. We're 15 minutes or so before session open. And let's mark out what we got going on. We have a trend line that's starting to form here. That's only 2 taps. We don't have the third tap yet, but as you guys know, that third time revisiting this area, all traders now see that. And so you might get an opposite end reaction sitting here. If we want to take buys, we just wouldn't have that confluence on our side. Okay. As far as support resistance goes, we have a resistance sitting up here. This is the resistance. I just moved it to the left because I saw that reaction too. And then sitting above that is obviously sitting at these highs. And then support is sitting all the way down here. This entire area, pretty much here. Let's see if we can tighten that up on 5 minute time frame. This whole area, where price is currently at. We tried our hardest not to go too far back to the left. When price last revisited this entire area, we had a heavy, strong push away from that point. Last time we revisited, we had the same exact thing. Now price is simply just bouncing in between this range sitting right here. Okay. We got 5 minutes until session open. Now we start to break below these lows here. Let's run through this real quick before I open up the what we're going to do. Let's say we start to break below these lows here. So what confluence do we have? We have moving average on our side, we have a support break on our side, and we have volume on our side. We do have that trend line holding, but when I say holding with us, I really like to see that third reaction. We're actually seeing those sell orders there, and then that would kind of be a confluence. So not much of a confluence here, but what we don't have on our side is previous session lows here, okay? This is a heavy area of rejection. All buyers from London session, more often than not, they have their stop loss at very obvious places, as you guys know about liquidity, which is sitting at very obvious highs and lows. And so a lot of times when price comes down to these very obvious highs and lows, you get an opposite end reaction because as you know now, the market is being fulfilled. That liquidity pool is being fulfilled. And two things could happen. If more liquidity is sitting up at the next pool, sitting up here, market is going to fly to that point. But if there's more liquidity sitting all the way down here at the next level of rejection or whatever reason it is, market is going to send it down to that point. And that's why usually when you get that pull of previous session highs and lows, and the reason why it's such a big influence to us, you usually get pretty big reactions once we come up to this point. So does that mean that we can't take the trade sitting down here? No, that just means we can't have that as a confluence. So this is not going to be a 4 or 5 confluence trade. It's just going to be the bare minimum 3 confluence trade. And something like this, I really allow for discretion to play out. I never ever just take a trade just because it simply breaks below low, even if we had all the confluences in the world. I wait to see if there's a lot of buy orders sitting down here and we get an opposite end reaction. But if we don't, or we get a minor push up and the continuation, I hop in right away and expect price to come down to that next support. Okay. So let's see what happens with this next candle as soon as market opens up. Okay, so we're sitting here. We still haven't broke below previous session lows yet. We're coming to this level of rejection, which is pretty much like this whole area. We can mark up this whole area now. This whole entire area. Not just going to take it just because we broke below this low. It is this whole area of reaction. We want to see what happens because we know we got previous session lows sitting down there too. Very next candle. Okay, price sends it. Discretionary traders may have got in. Maybe we started to react off this point, get a sharp push up, and then continue lower. Volumes on its side will potentially sacrifice a worse entry and get in somewhere down here. Just simply expecting price to come down to that next level of support, which is all the way down here. But as mechanical traders, there's probably just no entry here yet. You know, we're simply waiting for some type of support to form to go ahead and get into the trade. And then from this point, probably sends it. Now coming down to this next level of support. And we're just simply doing the same exact thing over and over again. What's going to happen from this area? Now that we came down to this level of support, is price going to react off of it and start to push back up? And we'll potentially take a buy as soon as we push back up? Or is price going to continue lower? Maybe we're getting that reaction now, but then it continues on and we end up taking that push. We simply don't know because this is a back testing session. So as mechanical traders, this is kind of pushing at the end of the move, so it's kind of a tough thing here. But mechanical traders, you start to break below this low, you probably get in. Discretionary, you'd have to wait to see. Very next candle opens up, end up pushing lower. Would you potentially get in? Not sure. I mean, but as mechanical traders, you push below this low, so we end up getting in. Let me move it back one candle so I can see the ATR. ATR is reading 31. So as you guys know, anywhere between 30 to 40, we're using a 30-point stop loss. Anything below 30 is that 25. So we end up doing 30 here. Okay, as soon as a one-to-one gets hit, if there's no traffic in our way, we're going to be taking out like 20, 30% of it, letting the rest ride. If there is traffic in our way, we remove, more like 50, 60% of our position and then expect price to continue on and expect price to reject. But if it doesn't, great, we still have a runner sitting in. Next candle opens up. We come close. Oh, we did. We did hit a one-to-one. Remove yourself. Here is only going to be 20, 30%. Ended up coming back up to break even. We expected that, and price is still holding at this level of support. You can either move on with your day or try to wait for price to come up to this next level of rejection. This market's that's a heavy move. We probably just move on for the day, or wait for the next area of support, which there's none. We don't want to look all the way to the left, so we'd be waiting for some type of new support to form and then taking the break of that level. Same exact thing over and over again. So a lot of besides our first trade, which is full TP, a lot of partials so far in this market. Okay, moving on to the next day. So now same exact thing here. We weren't able to execute what we thought, but this market just moves like magnets. Look what happened. Rejection, 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 rejection. Once we started to trade back below that 4-hour resistance, we just expect price to go to the next level of 4-hour support, which is exactly what it did. Then once we get down to that level, price halted and started going the opposite direction. So where do we expect price to go? We simply expect price to go to that next level of rejection sitting up here. Okay, these areas work like magic. So let's go down to lower time frame, see what we can do. We'll go 15 minutes before session open, which I think is one more trade, one more level. Okay. So what do we got going on here now in 15-minute time frame? Well, we have a low sitting down here. We have no resistance yet because price just broke above it, and then we have a support sitting all the way down here as well. Okay, sitting all the way down here, which is really, really far away. Hopefully, we can get some new structure. So as far as buys go, even though we expect price to continue higher, there's no area for us to buy yet. We're waiting for some type of level reaction. Go ahead and take a buy off of. So we're kind of just stuck here waiting for something to form. Go down to 5-minute time frame, see if there's anything closer to kind of take. Still, we have that little minor level reaction that we just broke out of, but we're really just waiting for new price action to form. This is telling us nothing yet. So let's say market were to open up and we were to push below these lows here. Well, are we getting into the trade? I mean, price is pretty much going to be sitting below that moving average, I believe. We also have volume on our side. We also have a breakout of lows. So even though price is holding at that 4-hour support, we still have our four or at least three confluences to get inside of this trade. As long as that moving average isn't holding and we actually start breaking below that median of price. So very next candle opens up. This is going to be session open. Okay. It looks like we're starting to create some type of rejection point here, but still nothing has happened. Very next candle. Okay. Price starts to push lower. Two different ways of trading. Our first mechanical traders probably going to be hopping into this trade here. Okay, using a 30-point stop loss, we broke below those lows. We have our confluence set up to go ahead and take the trade. So it's going to be 30 points. Looking for a 1-to-1. If 1-to-1 hits, great. Do we have anything in our way before coming down to new targets? No. All the way for a 1-to-3, there's literally nothing in our way. Discretionary traders, they may not be in the market yet. You're giving it that 1-2 minutes to hover around this area of rejection because obviously it rejected in the past, and you want to see, are we going to continue on with heavy volume, or are we just going to react away from this area and continue higher? Again, it just comes with a lot of discretion that takes a lot of experience to go ahead and take the trade. Okay. Price push lower. Looks like we already hit the 1-to-1, if not very close. Let me make sure. Let me see here. Okay, now we've hit our 1-to-1. So what are we doing here? Moving 20, 30% of our position and expecting price to come down to 1-to-3. If it doesn't, takes us out break even, whatever. We've already partial for today. We're good to go. You can either take a next trade once we come down to lows, okay? Or if we move a bit away from this area of rejection that we just took the trade on and you start to push, whoops, and you start to push back up to it and you get a reaction from this area, okay, maybe we can take a buy and expect price to come up to this new level of rejection. But until then, the setup has already played out. We're simply waiting for new structure to form so you can take a trade. Okay, let's see what happens with the rest of this trade. Ended up getting taken out break even there. So then from this point here, let's say, okay, we partialed out from this trade. Very next trade here now. We come up to this level of rejection. The high is sitting all the way up here for mechanical traders. Now we have a new high that's just formed sitting right here. And so now mechanical traders are taking a break above highs. Discretionary traders view this as an area of interest, so we're waiting to see a couple minutes. Okay, are we reacting away from this, or is volume taking over control and pushing higher? So far, it doesn't look like mechanical or discretionary traders are getting into the market. And also, what time is this? Oh, this is 10 o'clock. Okay, so we're still 30 minutes in the session. Still a valid time to trade here. Okay, price starts to hold at that level of rejection. That's the reason why we mapped it out in the first place, because last time it held. So what is the likelihood of it holding next time we come up? Pretty high. And that's why we have to use Confluence in order to get into a trade once it revisits that area. So now we're waiting for price to come down to lows. This is a bit of a choppy area now, obviously. A better low is sitting down here. We really want to be as current to price as we possibly can. Okay. Our low, this is our new range. We expect price to just bounce away from these areas. But if we get a breakout with Confluence, we'll go ahead and take the trade. Next candle opens up. Okay. Now look what we got going on here. We have a mechanical low sitting here. And we have that discretionary area of interest sitting right here, this whole area. So discretionary traders waiting to see what happens when we come up to this point. Mechanical traders simply waiting for a break of these lows and expecting price at least to come down to this next level of rejection. Neither one of them have gotten to this trade yet. So discretionary traders, now that we got that reaction, we start to push lower. They may potentially get in, but we can only do mechanical here, so we'll just wait for a break. Still holding, still holding, and we come right back up. And so now from this point, it's like, all right, man. Price is rejecting away from highs, rejecting away from lows, rejecting away from highs again, reject away from lows again. Coming back up to highs. You may give this another chance. I just call this a rangy market. We're already damn near an hour into session. I really percentage wise 99, I don't know, 80% of all my trades come in the first like 15 20 minutes of session. I'd probably walk away and just say, hey, this is a ranging market. It's not my deal here. But this is a heavy volume candle. So let's say you were trading. We'll just do it one last time here, even though I'd probably walk away. We're back up to this level of rejection. Okay. Mechanical traders are waiting for us to break above a high. Discretionary traders waiting to see the reaction from the zone. Very next candle comes up at heavy volume, everybody's getting in. Maybe discretionary traders got in a little bit earlier because you got that first reaction, you got that bottom wick forms we spoke about. We don't just expect this candle to close and the very next candle to just send it up without creating a bottom wick. You kind of want to see that little bit of retracement and then potentially take the continuation. So discretionary traders hopping in right there, other traders hopping in right here. I don't know what 48. Okay, so we're going to be using a 40-point stop loss. Anything from 40 to 50 is using a 40-point stop loss, which would be sitting right here. Okay, as soon as 1-to-1 gets hit, which we're not there yet. Oh, we did. Okay, 1-to-1 did get hit. So what is in our way? We have nothing in our way. We have 4-hour resistance sitting all the way up here. And so because of that, we're trying to hold for that 1-to-3. Discretionary trades based upon what's going on. Once we come up to resistance, we may pull ourselves out, but everybody is out right now, probably like 20, 30% and expecting price to continue higher. Yet another profitable day by just waiting for areas of reaction, whether you're discretionary or mechanical. Price pushes up, now stops at a break even. Very next candle pushes even higher. Okay, so now you could potentially be partialing out depending on reaction. This is looking like some pretty bullish momentum. We haven't hit that 4-hour resistance yet, so kind of see what we got going on from this point. Okay, pushes all the way up. A little bit lower. You're starting to get that hold here. So this is where discretionary plays. You're mechanical. Maybe just let it come all the way up to 1-to-3. Discretionary traders, we treat 4-hour just like 5-minute support resistance or levels of rejection. Price is having a tough time breaking beyond this point. The reason why we marked out this area in the first place is because to the left, we've had a heavy reaction from that area, and that is why it was a resistance in the first place. Maybe remove your entire position here. If you're mechanical, maybe hold for a 1-to-3. So let's see what happens. Mechanical traders end up winning here. I honestly probably would have pulled out one of these reaction candles. I'm down to sacrifice 1 RR. Mechanical traders hit that full 1-to-3, and then moving on to the next day here. And so look how these higher time frame areas play out for us. Okay, price coming all the way up here. Look at that hold we got from that point. We simply expect price once we reject away from this area to go down to the next support, or we'll redecide if we come back up to reject again. Maybe from this point it's going to continue higher if we have Confluence behind it. But yet again, this powerful area holds yet again, where we just expect price to continue lower. So That's just giving us confluence. If we start to break below lows here, already holding off a 4 hour resistance, maybe we break below a trend line, moving average below us, then we have a really high confluence trade. Now moving average is on our side. Now higher time frame resistance is on our side. Volume is on our side. We have a breakout on our side. Potentially trend line. That's a 5 confluence trade. It doesn't get any better than that point. Okay. So let's go down to 15-minute time frame. Same exact thing. Mark out our support resistance. We have previous session highs sitting all the way up here. And so, as you guys know, there's a lot of liquidity sitting up at these very prevalent highs and lows. And so, we don't just take a trade simply because it breaks above highs, even as a mechanical trader, because that is a heavy area of reaction. We want to kind of wait for some type of rejection formed and then just take that re-break back above highs. These are really tough trades to take if you want to buy the first time we break above a previous session high or low, or break above a previous session high, break below a previous session low. So we have resistance sitting up here on 15-minute time frame, and then support all the way down here. Okay, very far away. So this is kind of tough price action. But going to 5-minute time frame, looks like we kind of have that area of reaction sitting right here, which we'll go down and see. We have a nice little resistance we just broke out of right here as well. Okay, remember we don't really want to go far beyond previous session highs and lows. We really want to stay current with where price is currently at. So what are we going to do in this point? Well, if we start to break above highs, do we have enough confluence? I mean, we do. Moving average is holding. We have volume on our side. We also have that breakout. We'll be breaking above highs, but what do we have working against us here? That probably tell me I'd rather just miss that trade even if it pushed higher. Well, we have previous session highs working against us. We have 4 hour resistance working against us, and we have this level of rejection opposite, which we have a lot working against us, even potentially a trend line too. Trend line's broken well beyond it. Okay, so we have some tough things working against us to go ahead and take this trade, but let's go ahead and see what unfolds once we get to that point. And then we have a trend line sitting down here. First tap, nobody sees it. Second tap, people are finally drawing it, and then that third tap is where we're probably going to have a lot of buy orders because that's when every trader is taking it. Okay, and then anything beyond that, the fourth time, the fifth time, the sixth time hitting it. Remember this, we view this as like a brick wall. Every single time price hits this brick wall, it gets weaker and weaker. And over the third time, the likelihood of it holding is a lot lower, obviously, than the first 2 to 3 taps of it actually being drawn out. Okay? All right, so let's see what happens from this point. Next candle is market open. Okay, price sent it. Something like this. Probably just me not getting into this trade. Okay. Yeah, we got to break above highs. Like I said, doesn't mean it is a 3+ confluence trade. We got to break above moving average. We got to break above resistance. We're trading during volume, but because so many things were in the way of me taking this trade, this would probably just be a not trading NAS today, going over to US 30 and see what happens kind of thing. No way I would be taking this trade, especially in the first minute of session with all of that working against me. Okay, so let's see what happens the next couple candles, waiting for some type of resistance to form so we can take. And then something like that, when she gone, it's a 200-point move in like 10 minutes. Time to walk away. That was the move of the day. And more often than not, we potentially will get a fizzle out from that point. I'm not the person to see an expansion to give you guys point wise and indices. An expansion of over 200 points or right at 200 points. Once that happens in the first like 5 to 15 minutes, as you guys know, 90% of my trades happen within the first like 30 minutes of session open. I would just walk on from that day and go trade US 30 or just have a no trade day. I mean, that is a huge expansion. I want to wait for new structure to form. And I'm just not going to take the buys above a crazy move like that. Okay, so moving on to the next day. And here we are too. Look at the just nasty rejection we're getting from a lot of people lose trades by trying to take that as soon as we've expanded so much, trying to take that next push up, and then you get that rejection because price doesn't move linear. It doesn't just move in one fashion. You guys know we have the impulsive phase and retracement phase. Impulsive phase, retracement phase, impulsive until we have a new impulsive that breaks structure. And then same thing, impulsive, retracement, impulsive, retracement, impulsive. Okay, so let's moving on to the next day. Regardless of what happens, we don't have FOMO. We're not tracing the next trade. We're just simply going to the next day. And that's why it's nice to have two different pairs that you trade as well. Okay, 15 minutes before session open, we have no highs. We'll go down to 15-minute time frame. We have no highs formed here at all. So there's no level for us to take a buy right now. I'm sure all of you guys see this clear as day. We have a nice trend line that's formed. First tap, second tap, third tap, everybody's already seen it. Now, fourth time coming down, that could be a good confluence that price is going to start to continue lower. We have the support sitting down here on 15-minute time frame and no resistance yet. So very tough to take these trades because you have support sitting here and this forward trend line tap. So we want to kind of see that reaction as mechanical or discretionary traders, and then just go ahead and take the break below a newfound low, um, and then go ahead and take the trade from that point. Okay, going down to 5-minute time frame. See if we can tighten this up just a bit. This is our support sitting down here. We still have no resistance left, and let's see what we got going on. Through the floor here. Okay. So let's mark out this trade right here if we were going to take it. All about Confluence. Would I take this trade? Potentially not. I mean, we have that third trend line tap sitting right there, but Confluence wise, how would this trade play out? We have a 15 ATR, so we're going to be using a 25 point SL, which is right here. Are we breaking below moving average? Yes. Do we have volume on our side? Yes. Do we have a breakout present? Yes. Do we have higher time frame support resistance on our side? Not really. I mean, we our last area that we reacted off on higher time frames is support, so that is not on our side. And then do we have previous session highs and lows on our side? No, we've already broken above previous session highs, and we just came right back within the range. And so it is a three confluence trade, but I would like to more so see the reaction from this trend line. Discretionary, if we got a bounce pushing off of this level and then a continuation, sure. I just can't tell because we can't go any lower, else it'll mess up the bass texting session. But if not, we're just waiting for a newfound level rejection to form, which is sitting down here. And then based off of that reaction is when we'll decide to take a trade. A new low starting to form here. We're starting to get that reaction. If we get a continuation instead of price just holding every time we visit this area, discretionary traders are getting in. And then as far as mechanical traders, now that we got that new low formed, if we start to break back below again, potentially mechanical traders will get into. But again, this is a huge. Remember we were talking about that 200 point? This is only 100 points. We still got some room to trade. So let's see what we got going on here. That trade is null and void. Okay, so price pushed up, created that top wick, pushed lower for mechanical traders. They may potentially get in here. Still 17, so 25 point SL. Discretionary traders potentially would get in. It's something you can't tell unless you're in live markets. But as of right now, just looking from what we can see from a closed candle, price is still holding this level of support. So it kind of looks like it's going to come back up to this area and then decide what to do from that point. But let's go ahead and see what happens. Okay, mechanical traders are holding on barely. Discretionary traders from that point, if they didn't get in from this first trade, watching price come up to create that resistance again, kind of in this area here. I mean, it's kind of a clean level rejection, and then push lower again all day. All traders are probably getting into this trade. Did they hit a one-to-one? Not quite. Very, very tough situation here. And the reason why it's so tough before I move on is why do you think price is reacting so heavy right here? I'm gonna have you guys answer real quick before I move forward. If you guessed it right, then cool. It's because we just grabbed previous session lows. As you guys know, it's a very tough area to play off of because there's a lot of buy orders sitting right there. Once the market's full-time job is to grab as much, go to the highest pool of liquidity so it can grab as much orders as it possibly can. Once it does, it's simply going to that next level of liquidity, whether that's sitting below, somewhere sitting down here, sitting all the way, sitting up here. That's a full-time job of it, okay? So we expect that heavy opposite end reaction. Discretionary wise, we're definitely putting our stops to break even and probably breaking even from this trade. Mechanical wise, you're just allowing for probabilities to play out. Hopefully it goes down to a one-to-one, and then we can chase for that next level rejection, which is nowhere to be seen. I mean, it's gone, or end up losing that trade here. Okay, look at that. Heavy liquid grab here, pushed all the way back up to this next level rejection. Stop loss gets hit from mechanical traders, and then you're moving on to the next trade. Either you take the L for the day, because it's pretty choppy price action, or you can kind of base your trade. Now we have Confluence. We have Confluence of previous session lows. We have volume on our side. If we start to break above this high here, we also have a breakout on our side, but we don't have moving average on our side. And then we also have higher time frames on our side. We're currently reacting off of support, so we do expect price to continue higher if you're still trying to take a trade. You know, we're only 15 minutes in the session here. Next candle opens up. Okay, price starts to push above highs. Let's read what our ATR is before this. I mean, it's probably still going to be low. 21, yeah. So we're using a 25 point SL. What do we got going on before a 1 to 3? And we have this resistance sitting up here, but at least until we get a 1 to 2, we don't have much. So probably pull more parcels out here to 1 to 2. But as far as the 1 to 1 goes, we're only pulling small. So you're only pulling like that 20, 30% out and then waiting for price to continue higher. That's all we're doing every single day. If we even end up getting this level in the first place. Discretionary traders, same thing. You're starting to see this bounce off from this point. So you may get in a bit earlier than the mechanical traders, but both of them are probably going to enter this trade as long as you push above highs. It's not the highest confluence trade, but we have enough confluences to go ahead and execute this idea. Okay, price starts to push above. As soon as a 1 to 1 hits, if 1 to 1 hits here, we'll go ahead and pull out, put stops to break even. If not, that'll be SL. Very close. Oof, SL hit. Would you? When it comes to the 1 to 1s, I'm pretty mechanical, bro. As soon as it taps, we'll pull out. But if things like this is trading, sometimes this happens where it comes very close up. You're trying to pull partials. We are not people who are dying to pull the trigger. We're simply allowing for probabilities to play out. And this would have been SL hit, you know, kind of moving on. Really tough day of price action. Price is kind of not making any decision. Any down movement is followed by a huge strike back above, and any pushback above is coming right back within the range. This is called whipsaw movement. More often than not, price is going to fizzle out and continue sideways because there's no direction right now in the market, and so we just move on. We don't care what happens. We'll move on to the next day. And you see that price just for hours. Just as soon as you get that indecision, not just us, a lot of traders are understanding the lack of direction, and that's why you just see sideways movement because you guys know that the market cannot move unless it has orders. And the lack of participation here after you get those first two aggressive moves just ends up killing a lot of traders, a lot of investors just stop trading until the next day. And that's why we're kind of seeing that sideways movement. All right, moving on to next day. This is 15 minutes before session open. We have a trend line formed here. Okay, first tap, nobody sees it. Second tap, that's when everybody draws it out. Third time coming up to this area, that's when everybody's going to see it. And that's why you're going to get those sharp reactions coming from that point if we end up coming up there. Anything beyond that third point, the likelihood of it holding is a bit lower. All right, so 15-minute support resistance. We have a resistance sitting up here, right here. I drew it to the left because we're having reaction there too. We also have a little support sitting right here, which will probably be a bit cleaner on 5-minute time frame. And then our range is formed, or our resistance, sorry. And then our range, that's the kind of break and retest area. And then we have support sitting all the way down here. So this is our range that we're trading in. We just expect price to continue on back and forth from this area all the way until it breaks out, and then you kind of reassess over and over and over again. Okay. Go down to 5-minute time frame. Okay, can we clean this area up? Most definitely, bro. We have a support sitting down here, kind of sitting at a resistance right now. We're start looking like we're starting to break above it, so I'm not going to clutter our charts too much, but kind of sitting at an area of rejection right now. So what are we going to do? Wait for price to come up to this resistance. We can take a buy if we have confluences on our side. Just understand this is the third tap here. We've tapped once, we've tapped twice. This is going to be the third tap, so likelihood of it holding is pretty clean. But then the fourth and fifth tap is when it's the likelihood goes down a lot. So discretionary traders, we're basing it off a heavy volume. We get a lot of volume coming to this point. Maybe we want to risk that. But as far as mechanical traders, we're still waiting for some type of high. We have no high to take this trade off of yet. So we're kind of just waiting, sitting around. Market opens up, boom, through the roof. Okay, so do we take the trade at this point? Let's just say no. We had that third tap sitting right there. We're kind of waiting to see what happens with price. Then come up to this next high sitting up here. Everybody's getting into this trade. As far as us go, discretionary and mechanical. We're getting heavy volume pushing through this point. We have a high that we just broke out of. Moving average is definitely on our side. This is a full, we have trend line on our side as well. I think higher time frame support is on our side as well. I mean, heavy confluence trade that this is going to play out. Okay, so mechanical traders are getting in at the high right here. We're using a we're using a 25 point stop loss, and we're expecting price to come up to a 1 to 3. Do we have any reactionary in our way? Not really. I mean, it's very far back. So yeah, maybe we'll get a reaction once we go back to previous session highs. We expect a reaction sitting up here, and then maybe another reaction here as well. But we have some pretty clean traffic as far as where price is currently at. So once we hit that 1 to 1, we'll take out, 20, 30% and hope for price to continue higher with the rest of that bigger position. All right, so you get in. Maybe 1 to 1 hit here. Let me remove this line real quick. I'll just put it to the left. Okay, so first of all, I think price hit close to a 1 to 2, damn near at a 1 to 2. We remove parcels at a 1 to 1, 20, 30%. Once you come up to that very heavy rejection level, you have to make an educated decision as a discretionary trader. Well, more often than not, when we come up to these very prevalent highs and lows, you're going to get opposite reaction. Do I want to remove more partials, which is what I'll do, or do I want to remove my entire position? These are just simply things you guys have to document. Mechanical traders, they've already parceled out their 1 to 1, probably just holding for a full 1 to 3, which is right here. All right, stops at a break even regardless of where you took partials out. Everyone should be 1 to 1. 1 to 2 is discretionary, so I'm not going to get too deep into that, but everybody's position is protected. So if it comes back down to entry, doesn't matter. We're just continuing on with the day there. Okay, pushing back up and yet again having a rejection from this level. It would have been, I highly doubt I would be holding any longer. The second time coming up to this area and reacting, I probably would have pulled myself out in full. Obviously, we can't tell that. We're just trying to be mechanical with the system, but mechanical traders are continuing on to higher profits if it happens. Okay, we push up, push lower. Okay, they end up breaking even with the rest of the position. Lots of liquidity sitting at this pool. So once the market was fulfilled, there must be more liquidity sitting down here, and that's why it goes the opposite direction. Just as simple as that. Not any fake outs or what people want to state. The reason why the market reversed here is it was fulfilled, and there's more liquidity sitting down here than was sitting up here. Okay, moving on to the next day. I want to make sure I don't make this video too long, so I'm going to make sure that you guys we'll do like one, maybe two, three more examples. And you guys, just to reiterate it one last time, making sure you're hopping onto these live calls is not enough though. Once you understand the system, now you're going to start being prepared on these live calls. Show up, mark out your support resistance, have a bias where you believe price is going to go 5, 10 minutes before session open, and hop on to simply watch me react based off of that. If your markets don't line up with mine, make sure you guys are asking questions, go in the free community, start to discuss, and most importantly, journal all of this data. Not necessarily emotions. I'm not the biggest fan of people journaling emotions in their journal. That you need usable data, and how you were feeling that day has nothing to do with increasing your edge. What has to do with it is more often than not with your system what happened. So journaling these ideas, going back on Friday and seeing if there's something you could do better. But if it was a high confluence trade with just 3 or more confluences, okay, you followed your system and understand more often than not at the end of the month you are going to be a profitable trader. Nothing is guaranteed, but more often than not. Okay. So we're still holding at 4 hour support. We got 15 minutes until session open. We got a couple of things going on here. Oh, let's go down to 15 minutes. We got a trend line holding here. Okay. We got our first tap here. Nobody sees it. We got our second tap here. Now everybody's drawing it. Third time coming to this area, we're probably always going to see some type of reaction, and we end up seeing it there. The likelihood of it holding the fourth, fifth, sixth time is a lot lower than obviously the first taps. Okay, 15-minute time frame. We have resistance sitting all the way up here. We can move it all the way to the left too. Pretty much this entire area. We have another resistance, pretty much break and retest area that's sitting right here, which is more current to where price is at. And then we obviously have lows sitting down here. It's like this entire area here. Every time we come down to this point, we reject. First time, second time, almost third time, fourth time. What's the likelihood of us rejecting next time we come here? I mean, pretty high. That's why we marked it out in the first place. And so as discretionary traders, we want to wait to see what happens from that point before we get in. Mechanical traders, would we just take a break below these lows here? answer it before I move forward. Are we going to take a break? Because we do have a low formed here. We're going to take that mechanical break. We're sitting below a moving average. We have volume on our side, and we have that breakout area. Are we taking that trade? Well, no, we're not taking that trade because we have a heavy area of rejection, which is previous session lows right here. And so you want to wait for a new candle low to form. Discretionary traders are wait, they may hop in before even that new candle closes, but we want to at least see the grab of lows and then the continuation and not just take it right away because you will get chopped up. It's a heavy level of liquidity. Okay, next candle opens up. Okay, gross. That's a huge, let me move this out of the way. Okay, so price came all the way up here. We don't know what happened from this point. We had no high to take that trade based off of for mechanical traders. Definitely not getting into that trade. Mechanical traders may have got in. They may have seen that heavy volume push here and decided to hop into trade and expect price to come up to those highs. Maybe would have hit a one-to-one. No, 17 point wouldn't have hit a one-to-one and then came all the way back down to reject. And then same thing here. For mechanical traders for that next area of rejection, we don't have a high that the high is sitting up here. We came all the way up to that level of rejection. We ended up pushing away and never actually got that mechanical break entry. Okay, so now what are we doing from this point? Well, we haven't grabbed lows yet. So once we start to break below these lows, we can make a heavy, this is now the fourth time of this trend line holding. And so the likelihood of if we break below this wick right here that we're going to continue, that was pretty heavy. I probably take this trade even though we haven't grabbed actual London lows yet. But mechanical wise, we're still waiting for a break lows before we get it, before we decide anything. Again, I would honestly probably get into this trade to be honest with you, but we'll go ahead and mechanically wait for the break of those lows and then decide from that point. Very next candle, we open back up, so nobody gets in. Even if I was going to get in discretionary, we never came back down to this area to even make a decision. We're coming right back up to this level of rejection here. For mechanical traders, there's no high. These break and retest areas are really for discretionary traders because your new high is still sitting all the way up here, one of these two areas. So still don't really have any trade at this break and retest area. Discretionary traders may take it, but we'll just try to stay mechanical here. We're waiting either for price to come up to this next level or come all the way down here. And if not, bro, this is just kind of a tough area of price action that's forming so far. Okay, price starts to push above highs here. ATR is reading 14, so use a 25-point stop loss. Discretionary traders, now that we come up to this area of rejection, you start to get the heavy volume, potentially get in, potentially not. Obviously, we don't know, but if not, coming very close to getting into this trade. We're starting to see some heavy volume behind this trade. Mechanical traders are already hopping in. Do we have anything to the left? No. So we'll pull out, 20, 30% of our position and expect price to continue higher up here for a 1 to 3. And this, honestly, is a pretty big SL. All right, let me zoom in. This is the full 1 to 3, almost. Next candle. Okay, price is rejecting this area yet again. Even seeing this reaction, like this heavy volume, and then price continuing to push up, discretionary traders are getting into this trade too. Was heavy volume, but now we're coming right back within the range. Hopefully, this level of rejection holds here, and if not, we're definitely getting taken out of this trade. Next candle opens up. We start to push back up to this area, back above. Okay, price pushes a bit higher. Looks like a 1-to-1 was hit. Maybe not. Yep, 1-to-1 was hit here. We removed 20, 30% of our position, and we're simply expecting price to continue higher up to a 1 to 3. We can move a bit faster here. And boom, 1 to 3 gets hit. Everybody's hitting. No, nothing telling us to get out of this trade. There's nothing in the way of price continuing higher. Discretionary traders and mechanical traders got to hit the rest of their heavy runner all the way up to target 3. Moving on to our last example here. Very last trade now, we're going back down to 15-minute time frame, doing the same exact thing we always do. We have a level of resistance sitting up here. We have a level of support sitting down here. We'll try to tighten that up on 5-minute time frame, and then we have a trend line that's formed. Okay, first tap, nobody sees it. Second tap is when we draw it. Third tap is when everybody sees it. So the likelihood of us holding here once we get to this point is pretty heavy. And then as far as buys come sitting up here, we start to break above these highs. Higher time frame support is on our side. We have the mechanical high sitting up here for mechanical traders. And then discretionary traders see this as an area of interest. So we're just simply waiting. What is price going to do once we get up to this point? Okay, next candle. And then as far as shorts go, again, kind of want to see what happens at this area. If you get some heavy, if you get a little reaction, then a heavy continuation, great. Discretionary traders are coming in. But as far as mechanical traders taking the break below this low, you do have confluence, but we'll barely be sitting below moving average. So you don't really have those three confluences to take the trade. So you might want to be waiting for that next area of rejection, which is sitting all the way down here. Okay, this is a level here. I just do it to the left because we're getting reaction over here too. Market opens up. Okay, price starts to push below these lows. Discretionary traders or mechanical traders probably getting in here and getting oh, did it? Did it even break below? Okay, not yet. I mean, we pretty much created equal lows there. Maybe they would have gotten in, doubt it. Discretionary traders definitely not getting into that trade because as soon as you came down to that level reaction, we sent it right back up. And this now this third trend line tap is holding. But as far as these buys here, mechanical traders are definitely getting in. Can't say no to that one for sure. We've got a clean break above highs. Mechanical traders, discretionary traders, if we continue on with this momentum, probably going to sacrifice a little bit worse of an entry, but this is looking like a really good trade to go ahead and take buys. ATR is reading 16. So as you guys know, we're using a 25 points SL. Wherever that's at, pretty much right here. What was that? Yeah, 25.11. Going for a one-to-one, which is sitting right here. Do we have anything to weigh this trade? No. So we can hold for higher targets if you don't want to partial out. As you guys know, as soon as we hit a one-to-one, I'm probably going to be partialing out 20 to 30%. Unless you have heavy, there's many days where when we come up to these one-to-one, I mean, price is flying and we want to monitor it close and obviously take our partials. We're scalpers, so we want to win as much as we possibly can. But if price is giving you no reason to go ahead and take partials and it is sending. And when we're talking sending, it's within a couple of seconds. These areas are just continuing to push with massive volume. There's many days you'll be holding for one to twos, one to threes without parceling out at all. But as a mechanical mindset, which is we got going on here, you guys understand the difference. If there's something in the way, right at that one to one, we want to pull out 50, 60% of our position. If there's nothing sitting in the way, take out 20, 30% and expect price to come up to a one to three, which is sitting up here. Okay, very next candle opens up, rejection. Okay, stop loss gets hit here. From this point, you can see what happens. Is this level of support? This one is already broken. Is this level of support going to hold, or is it going to continue lower? And then so on and so forth. Let's try to see what happens with the rest of this day, and act like we're just going to continue on to trade. Now at this level of support, discretionary traders, if we start to continue to break below, we'll potentially take a trade, but you want to really see what that reaction is going to be. As far as mechanical traders, we have that low sitting here. Okay, what are we going to have on our side for confluence? We have a break. We're sitting below the moving average. We have a breakout below support sitting here, obviously trading during a high period of volume. And this is the fourth time revisiting this trend line, and it looks like we're starting to break below. It looks like sellers are really in control from this point. We don't have previous session highs and lows on our side. I mean, we're sitting below it, but or we're sitting right above it back in the range. But this is a higher confluence trade to go ahead and take, whether it plays out or not. Next candle opens up, end up pushing lower here. Discretionary traders are in. Maybe they would have taken the higher entry, maybe not. Maybe they're waiting. Well, as soon as that top wick formed and then start to push with heavy volume, maybe they get in here. Maybe they get in the same time as mechanical. But one thing's for certain, both style traders are sitting in this trade now. Okay. ATR is still reading 20, so we're using a 25 point SL. What do we have sitting in our way here? We definitely have a heavy level of rejection, which is previous session low sitting in our way. So we take out most of our position. Still not going to cover this loss here, but we're not trading for the last trade. We're just simply trading probabilities. And over the course of the month, we're more often than not going to be in profit. And then just expecting price to come down, hopefully to a one to three here, which will be sitting like here. Okay. Stops get put to break even, and then breaking even on this trade, taking partials out, we'll be leaving with a small, half loss for the day. But definitely no more than break even or half loss, this would just be a day to move on. I wouldn't personally, now that we got heavy momentum to the top side push, heavy momentum to this bottom side push, and then continue back within the range, anything could happen. If I knew everything, obviously we'd be a lot richer than we already are. But more often than not, this is when price is just going to range sideways because there's no decision. And when there's no decision, that means there's going to be less and less participants. Lack of participants is a lack of volume. Lack in volume means a lack of direction, and usually price trades sideways more often than not. Okay. And then we would just be moving on for the day. And then look at that, just absolute chop, disgusting price action. So that is everything in its entirety. That is all Confluence is lined up, trading back to back to back, showing you what a high Confluence trade is, what the minimum Confluence trade is. I don't grade my trade. There's no A plus setup, B setup, C setup, D setup. It's simply if there's three or more Confluences, I'm going to take the trade. And as you guys see here, I try my best to add discretionary trading within this. It's going to take time to understand the reactions from that area, but doing the same thing over and over again, just like anything else in life, that consistency is going to breed a better edge. It's going to breed confidence, and confidence in return is going to help you exit with execution. Once you get to solid execution based off of data, all of the jeering of the hands and frustration with emotions that a lot of people experience as a beginner trader are going to be alleviated further and further. Now, do emotions completely go away? Well, no, this is one of the only industries in the entire world where you can give yourself a raise at any given point based upon when you let. You can risk $200 today and then give yourself a raise to risk $400 the next day. So with new levels comes new emotions, but we're not trading based off of our emotions. We're trading based off of our plan. The more data you acquire, the stronger that edge is, the stronger and more resilient you are with your emotions to make sure you don't act off of them. And the happy trail of this journey of profitable trading is ahead of you. So I hope this was an aha moment for a lot of you guys. You now understand the entire system, not just how to trade, but also when to trade, how psychology plays a part, and the basic fundamentals of Forex that many people and indices that many people negate in the first place and don't understand the mechanics of why price is moving before they ever even come up with an edge on how to execute for themselves. So that's everything. Make sure you guys are showing up to every last one of these streams every single day so you can build your own discretionary plan. And next session is going to be section 5, where I show you how to actually execute a trade, how to open up a broker account, how to open up a prop firm account, how to calculate risk size so you know exactly what you're doing on each individual trade. And from that point, not that you're off on your own, you still can watch these live streams, but then you're going to start acquiring your own data and removing those trading wheels to start doing this for yourself. Up until now, everything you've learned is about how to trade. In this whole section, I'm going to show you how to get set up. So once you're ready to start, there is no type of confusion. Now, this is not a recommendation. It is simply the broker that I've used and taught you on throughout these entire lessons. So you don't have to open an account today. You don't even have to sign up. It's just simply so you understand when it comes to that point what these different accounts mean and how you can start to invest yourself. As part of going through this course, the broker we'll speak about today has offered a higher deposit bonus to you guys. It is not required, it is optional, and you guys will have access to it by clicking the link down in the description. And if you need a refresher on how brokers operate, I will put the link above from the previous session. You do not need to start trading today. You do not need a deposit today. You do not need to sign up today. But when you get to that point, I want to make sure you understand exactly how to do so. So first things first, let's show you how to set up an account. Scroll down on this exact video that you're watching right now. Go ahead and go down into the description and click that very first link that says sign up and get 100% deposit bonus. From that point, it's going to bring you to this front page. Go up to the top right and click start trading. Fill out the form and then go ahead and click continue. Now, once you signed up, you're going to have full access to an entire dashboard, which will run through here pretty quickly. If you want to open up a demo account, you're not ready to start trading live capital yet, you go up to open demo account. If you're ready for that live account, you can either click up here, come to accounts and click open live account, which will run through pretty quick. And as always, if there's any further help that you need, you can always go down to this information center. They have support articles and how-to videos for every last thing as far as this dashboard goes, as far as different account types go and such. So I just want to make that clear. There's full tutorial videos. All right, coming back to here. If you are outside the United States, you will have an MT5, a MetaTrader 5 platform or TradeLocker choice to make. If you're in the United States, like myself, we are all using TradeLocker for your actual account platform. Click next from that point. You're going to have multiple different types of accounts. As you guys were told earlier in this video, as per you going through this entire course, this broker has allowed you guys to have a 100% deposit bonus. So whatever money you put in, you put $100 in, you get 100% on top of that. If you want to go with the other options, we can run through those pretty quick. The difference between raw and standard. Standard is still 1 to 500 leverage, which raw has as well. Raw also has a 1 to 1,000, but there is no minimum deposit. The reason why there's a minimum deposit on raw ECN accounts versus these other two types of accounts is because there is higher leverage. You can get the 1 to 1,000 leverage for one, but two, there's raw spread. So as a scalper slash day trader, I highly, highly recommend, as you guys know what spreads are now, that you get a raw spread trading account. And number two, you're going to have better fees with these raw accounts versus the standard STP account. Okay, so once you run through that, I myself have the 1 to 1,000, and just because you have higher leverage does not need to mean you guys need to use it all. You have to be very, very responsible with your risk. Okay, click continue. Click continue again, and then this is where it's going to pop up with your actual login. So there's going to be a login. There's going to be a server. There's going to be a password that is also going to be sent over to your email. So you have records of that, which you can also always look on here. And you can also go down to the bottom left where it says download trading terminal. And it is going to help you download Trade Locker itself. Once it brings you here, you can decide which platform you're on, whether you're on Windows or iOS. Click download. And then it is going to bring you to the platform where you guys can type in your login, your password, and the server that it is on. That's where your capital is going to be at, and you can begin trading from that point. Once you open up a live account, obviously you have to fund that account, which is sitting down here in the section. So that's when you click deposit funds. You can either deposit one of two ways, either with crypto or using a debit credit card payment. Either ones are offered here. And then from that point, you are going to deposit funds into the wallet of this dashboard, not your trading account yet that you created up here. It is the wall of your dashboard. So from that point, you need to go to transfer funds and actually transfer funds from your wallet all the way to your trading account. To give you guys context, I use this broker for a couple reasons. They do possess regulation, they have tight spreads and low fees, they have very fast execution and offer the highest leverage, which is 1 to 1,000. They have all of the markets that we trade within here. They have commodities, they have indices, they have Forex, they also have crypto. They have reliable same-day withdrawals, and the most important part, they have 24/7 support. So if there's any type of questions you have, whether it's regarding your account or the broker in its entirety, you can reach out to somebody right away and get that response. Okay, so when you guys are ready to invest and you want to trade personal capital, you now understand how to open up a broker account. Today's video is not to encourage you to trade with a prop firm, but just to help you understand the different types of accounts. So when you are ready, if you don't want to go the personal capital route and have somebody give you funding, you know exactly how to do so without confusion. Personal capital is simply another way to trade if you don't want to put a lot of personal capital up front when you first get started. And as promised, by the end of this video for you guys going through this entire course, this prop firm is giving each individual one of you guys a free 25K account. So make sure you stick around for that. So first step, scroll down on the video you're at right now, go into the description and click that very first link to bring you to the prop firm front page. All right, now once you get to this page, go ahead up here and click on plans, and then you have all these different types of accounts. If you want to understand individual rules for every one of these accounts, all you have to do is go up to rules. It'll bring you to general rules or the fact based upon specific challenges, and it'll give you every last detail you need to understand exactly what each and every one of these accounts entails. Back to the pricing page now, you can either pick a one-step challenge where it's one step before you get funded with these different profit targets, a two-step challenge where it's 2 steps till you get funded, 3 steps where it's 3 steps until you get funded. FastPass, you can get an instantly funded account through FastPass Hero if you have an affiliate, which you guys do have me. For that option, you do have to DM me directly on Instagram and I'll get you taken care of. Or you can go directly into the instant funded account, which is a bit more if you don't have an affiliate, but you also get an instantly funded account. And then 1-step, 2-step, and 3-step villain. These are also different step challenges, which have a bit lower cost. And so they have higher profit targets to go ahead and get funded. From that point, you're going to decide which size account do you want. Once you have read all of the rules on the account type that you would like, and you decided which size account you want from that account type, you're going to go ahead and click buy challenge. And always, every single time you go ahead and get an account, make sure you go up to have a coupon and click Zen as you're a part of the Zen Lab community. And at bare minimum, you will always get 50% off of your accounts moving forward. From that point, it's simple. You're going to get an email. It's going to give you the credentials and the exact platform link right below the credentials that you'll click. You'll sign into that platform, and then you can go ahead and trade as you guys already understand how to do. Once you acquire your account, you're also going to have an entire dashboard that's going to show you your progress once you start taking trades, what your max permitted daily drawdown levels, your initial balance, all type of stats so you can keep up with exactly what you got going on with this account, especially on the challenge level and funded level, so you know what you need to hit next before either you get that funded account or if you have the funded account, what it's going to take to get that actual withdrawal. Then once you're eligible, you go down to withdraw and then you can withdraw profits from that account as long as you're following all rules. Now, as a broker has, and any prop firm or broker should have, make sure you go to their 24/7 support if you have any type of issues, and they will get you taken care of. Again, this is simply a recommendation. You can choose whatever prop firm you would like. Just make sure you do your research. Make sure you're going on websites like Trustpilot and hear what people have to say about that prop firm before you go ahead and sign up, as your money is obviously valuable. Before we give you that free 25K account that we spoke about earlier, I cannot stress this enough. Rules are just as important as your strategy when you are trading with prop firms. So making sure you guys are running through that entire rules section so you understand exactly what you're risking, what type of account you have, and what the parameters are before you go ahead and start investing and start trading that account. Right underneath this video, I'm now going to have you click on the free Discord community link sitting right here, which is going to bring you to the Zen Lab community so I can show you exactly how to apply for the $25,000 account. Once you get into the group, first, make sure you go to this welcome page and read exactly how this entire community works so you understand what each individual channel is. And then once you're done with that, go down to course completion bonus, which will be sitting in the Zen Lab free section. From that point, run through every step. There's obviously a very minor verification process because this is only valid for people who run through the entire course. So we want to make sure you guys are signing up, which you understand how to do. Step 2 is course completion. Just sending me a screenshot so I know that you've ran through every last video of this course and you're an educated investor now. And then step 3 is DMing me your information, which is obviously going to be your first, last name you want on the account and the email address. And my team will get you set up with that 25K account from Funded Hero. They will send you an email and then you can go ahead and start trading all of the knowledge you've received from this course. To be clear, you do not need to do anything today. This is just here so the option is available when you're actually ready. The goal on both sides is very simple. It is to connect the firm with traders who understand risk, structure, and execution. So do not rush into a challenge. Continue to finish the entire course, watch all the live sessions, and then make a decision afterwards as to if you want to be a personal capital trader or a prop firm capital trader. This is going to be about the unit of measurement that Forex and Indices uses. Obviously, before we get into execution or how much money to risk per trade, you have to understand how to do the calculation in the first place. And you can't understand how to do the calculation if you don't understand the unit of measurements in different markets. So today we're going to be talking about points and pips. So in Forex, the price movement is measured in pips, which stands for point in percentage. It is simply the smallest price movement in Forex, and it is the standardized unit used to describe how far a price has moved. So for most Forex pairs, 1 pip is a 4th decimal point over. So let's break this down simple. Let's say that this price point was for Euro USD, a currency pair. The orange number before we get into any decimals would indicate that's 12,251 pips. Now going after the decimal point, this is going to indicate 2,251 pips. Red is going to indicate 251. Blue is going to indicate 51. And then yellow is the actual pip placement, which is this is sitting at 1 pip. Anything beyond that, which you won't ever see more than 5 numbers. If it's a 0.5, that's half of a pip. 0.6, that's a 1/6 of a pip, and so on and so forth. So I'm going to show you in the next example how this all plays together as far as calculating where price is moving during that set period of time. Okay, so for instance, if Euro USD is currently priced at 1.1000, and over the course of time it moved from 1.1000 to 1.1004, that is a 4 pip movement higher. Now let's say GU moved from 1.3440 to 1.3460, since we know it's the 4th decimal point over, going from 40 to 60 is a 20 pip movement higher. And then last example here, from 0.6678 to 0.6665. That is a 13 pip movement lower going from that 678 to 665. Okay, pretty simple. Now to throw a bit of a wrench into here, when we go to JPY pairs, it is not the fourth decimal point over, just like every other currency pair is. It is the third decimal point over that signifies a pip. So to break that down to calculation, let's say GBP JPY was right now currently priced at 212.940, and in the near future, within a couple minutes, whatever, it ends up going to 212.980. That would mean that that pair moved 4 pips higher during that period of time. AJ, if it started at 105.830 to 105.840, that would mean that's a 1 pip movement higher from 830 to 840. And then lastly with USD JPY, going from 149.270 to 149.170, that means it is decreased 10 pips in movement during that set period of time. Price has moved lower. It's been bearish movement. Now that you understand how Forex moves, which is in pips, you need to understand how Indices moves, which is in points. A point simply represents a whole number price move versus, as you know, in pips, it's behind the decimal. So if NASDAQ moves from 17,000 to 17,010, that is a 10-point movement upwards in price. This is where people tend to get confused. So you need to understand 1 point equals 10 pips. So if it's a 5-point movement, it's a 50 pip movement. And if it's a 10-point movement, that translates to a 100 pip movement. So back to our example, if NASDAQ moves from 17,000 to 17,010, that is going to be a 10-point movement and also going to be a 100 pip movement. A 10 pip stop in Forex is definitely not the same as a 10-point stop on an index. The distance does sound familiar, but the risk can be completely different. So when you're doing that calculation, it could be completely wrong if you don't understand the correct unit of measurement when you're making that calculation. So that's why it's important to understand unit of measurement first. I'm going to show you guys exactly how to calculate risk in Forex and indices. I want to get right to the point, show you the exact formulas, so there's no confusion and you know exactly what to do going into your first trade. For some reason, so many people complicate this calculation, and so when it goes into risk, they end up risking way more than they wanted to or way less than they wanted to. So let's go ahead and remove all of that confusion right now. Okay, so when we're putting in a Forex trade, you're going to be putting in a lot size, which is a standardized position size in Forex. So you're going to be trading 2 lots, 1 lots, 10 lots, all depending on what your calculation is, depending on how big your stop loss is. Okay, let's not complicate this and make this confusing. The formula for position size is simply how much money you're risking on that trade divided by your stop loss in pips, and then times the pip value, which we're going to dive into real quick. So if you were trading with 1 lot, okay, let's say on your position, your stop loss was 10 pips big. Well, trading 1 lot, each pip movement, as you know, is the fourth decimal point over. Every time, like let's say price went from 1.1000 to 1.1001, that's a 1 pip movement. Well, if you had 1 standard lot in the market with that movement, you would be making $10. It's as simple as that. So let's say that you had a 10 pip stop loss. You understand that with a 10 pip stop loss using 1 standard lot, if price were to move 10 pips in your favor or out of your favor, how much money would you be making or losing on that position? Well, $100. 10 pips times the pip value, which is $10, is going to be $100. Or let's say you had that same 10 pip stop loss, but you only put in a mini lot, which is a tenth of a standard lot. And so instead of making that $100, you would be making $10, because if it moves 10 pips, it's $1 per pip. That would simply be $10. Okay, that is simply it when it comes to USD pairs. Now the calculation gets a bit odd when you're going to other pairs. But for the most part, we're only trading USD-based pairs, so that's going to be the calculation. And I am going to show you guys a tool at the end of this that you can simply just plug in numbers if you don't want to do this calculation, so you can get right into the exact lot size you're trading with and obviously move on with your trade. But for the last time, do not complicate how to simply to calculate this. If you're trying to put 5 lots in, well, if 5 lots instead of $10 per pip, that's going to be $50 per pip. And so if price moves up 10 pips in your direction, that would mean that you'd be making $500, because it's 50 times the 10 pips, which is $500. Okay, so that is for USD-based pairs in Forex. Now moving on to indices. Indices operates just a bit different, but it's still an extremely easy calculation. So let's not overcomplicate this one either. For the formula for the position size of indices, it's simply the amount of money you're trying to risk per trade divided by your stop loss in pips, or the exact calculation is stop loss in points times the dollar amount per point. So let me break that down for you. When whatever broker you use, they're going to operate out of one of three contract sizes. Some of them operate out of contract size 1, some of them operate out of contract size 10, and some of them operate out of contract size 100. How you're able to find that is you simply go to the instrument, whether you need to hold it down, you need to right click it, and then go to the details of that instrument. And it is either going to say contract size 1, contract size 10, contract size 100, or it's going to say lot size 1, lot size 10, lot size 100. Okay, so from that point, you know what your dollar per point is. Either it's $1 per point, it's going to be $10 per point, or it's going to be $100 per point. And then from there, the calculation is very simple. To make it even easier on you guys, I'm going to give you a baseline calculation, which is how much money you're trying to risk per trade divided by your stop loss in pips. And depending on your contract size, will either divide or multiply from that point. So this calculation always starts with contract size 10. Okay, so let's go to the calculator here. If you're trying to risk 100 or $1,000 per trade, that is your risk. We're going to divide it by your stop loss in pips. Just to bring it to our system, usually we're risking about 30 points on a position. As you know, 1 point equals 10 pips. So we're going to be dividing by, if it's a 30-point position, it's going to be 300 pips. That is going to bring us to 3.33. So if our broker operates out of contract size 10, and we're trying to risk $1,000 using a 30-point stop loss, this is the lot size we're going to put in the broker to initiate that trade. Now, if your broker operates out of contract size 100, it's still very simple from this point. You're going to take that 3.33 and you're going to divide it by 10. And that is going to be your calculation. It's going to be 0.33. So if you're trying to risk $1,000 using a 30-point stop loss with contract size 100, you're going to be putting 0.33 as your lot size. Now to go right back to foundation, because remember everything starts with contract size 10. Let's say we're just trying to risk that same $1,000. We're going to divide it by our stop loss in pips, which is going to be 30 points, so 300 pips. And then this time, if your broker operates out of contract size 1, you're going to be multiplying this base calculation by 10 instead of dividing. So you're going to times that by 10. And if you're trying to risk $1,000 using a 30-point stop loss, you're going to be putting in 33.33 lots to go ahead and initiate that trade. Okay, so one more example here for contract size 10. We're trying to risk $5,300 using a 30-point stop loss, which is 300 pips. So we're going to put 300. You're simply going to be using 17.66 lots in order to initiate that trade. But if it was contract size 100, you would be dividing that by 10, and you would be risking 1.76 lots in order to do the $5,600 at a 30-point stop loss. Okay, so very, very simple. Now, this calculation, once you understand what contract size you guys operate out of, this is going to be pretty much brainless activity for one. But two, like I said, we usually are using a 30-point stop loss. So unless you're changing your risk between trades, which you should not be doing unless it's on a monthly or quarterly basis, once you get this calculation, this is going to be the same lot size you use for the entirety of that point until you decide you want to give yourself a raise or potentially decrease the risk and then have to do this calculation again. For those who are trading non-USD pairs, you simply just want some type of tool still to do the calculation for you. If you're nervous about doing the calculation at first, that's fine. Just go to Google, type in position size calculator MyFX book, and it's going to bring you to this page, probably the first one that pops up on the list. All you have to do is put in your account size. Let's say you have 10K. You can either risk money or you can risk percentage. We'll go ahead and put money up here. Make sure you see which one it is. Let's say we want to risk $1,000 on this 10K position, so that'll be 10%, and your stop loss is going to be 20 pips. So you just put 20 pips here. Always going to keep this one the same, and then you're going to calculate. And it tells you right there, well, if we're trying to risk 10% of this account using a 20 pip stop loss, we're going to be putting in 7.9 lots, okay? You want to use a 10 pip stop loss, risking $1,500 or whatever the case may be. you always keep this number one, calculate, and then it's going to tell you. If you want to risk $1,500 of this 10K account using a 10 pip stop loss, you're going to be putting in 23.71 loss. So that should be the most simplified breakdown of how you guys can calculate risk. Now you understand how to do the formula for yourself for one, but two, you have a tool if you're not too comfortable doing it on your own yet to make sure that you are risking the correct amount per trade. Leverage is one of the most misunderstood in tradings, and a lot of people think leverage is the reason why people blow accounts, but that is not true. Poor risk management is. By the end of this video, you're going to learn exactly what margin is, exactly what leverage does, and how to use both without ever putting your account in danger. So you guys need to understand leverage is just simply permission. Like, it's allowing you to control a larger position with a smaller amount of capital. It doesn't force you to take on more risk like most people do. It's just giving you access if you're able to do so. And how much you risk is still definitely your choice. Now, margin is the amount of money your broker temporarily locks up to open a trade. It's not a fee and it's not money you lose. It's pretty much just collateral while taking a trade. Think of it like a security deposit. Like, the broker locks up a small portion of your account while the trade is open to make sure the position can be supported. But once that trade is closed, that margin is released back into your account. Now, one thing I definitely need to teach here is margin calls. And this course does not teach non-sustainable high risk trading and flipping accounts quickly, but it's still important to understand what happens when you do. So a margin call is when your account no longer has enough available funds to support your open positions. So your broker steps in and does one of two things. A, which is the most common, they're going to automatically start closing your positions. And then B, which is not so common, they're going to ask you to deposit funds. Now, again, in ZenLab, margin calls are damn near impossible, and that's because we use a fixed risk percentage per trade. So we set stop losses before entering, and we calculate position size before ever clicking buy or sell. When you see leverage written as 1 to 100 or 1 to 1,000, here's exactly what that means. Leverage is simply a ratio. 1 to 100 means for every dollar you have, you can control $100. 1 to 1,000 means for every $1 you have, you can control $1,000. That's it. There's nothing more and there's nothing hidden. So let's say you have a $1,000 account. With 1 to 1,000 leverage, you can control up to a $100,000 position. And with 1 to 1,000 leverage, you can control up to $1,000,000 position. That does not mean you're risking that amount. Your risk is only the distance between your entry and your stop loss multiplied by your position size. Leverage just determines how big of a position you're allowed to open. All right, now in ZenLab, risk is calculated this way. First, you're going to decide how much you're willing to lose, which is usually a fixed percentage of your account. And then second, you're going to define your stop loss on that trade based upon where asset you're trading. And then third, you'll calculate your position size to match that risk. Now, leverage does not decide risk. Your stop loss is what decides risk. In the United States, retail traders are limited to 1 to 50 leverage by regulation. That was designed to protect inexperienced traders from opening oversized positions, but obviously the downside is simple. It's going to limit flexibility, especially for smaller accounts, which most of you guys are starting out with. Now, this is why many traders choose offshore brokers. It's not to take on more risk, but it's to gain more flexibility in position sizing. Higher leverage allows you to trade efficiently with smaller accounts if you manage risk properly. Higher leverage doesn't force reckless trading, it just removes artificial limits that US regulation does with that 1 to 50. Leverage simply increases access, and risk is still intentional, and discipline decides the outcomes. You know, two traders can use the same leverage, one survives and one blows the account, but the difference is simply risk control. You should now understand margin is just collateral, leverage is permission, and risk is a choice. Once you start understanding that, leverage stops becoming so scary or so exciting for people who want to flip accounts within a couple days. I want to show you exactly how to set up your charts correctly. So this is going to be a full TradingView 101 crash course where you're going to understand exactly how I use different tools and different shortcuts to make my trading seamless on a day-to-day basis. And by the end of this video, I am going to release the ZenLab all-in-one free indicator to you guys. So the little things that can be automated to make your trading easier, I went ahead and done so with an indicator. So make sure you stay to the end of the video for that. All right, so let's dive right into it. I'm going to show you guys exactly what I use every single day on a day-to-day on live. Everything else that we don't use, we're not going to discuss. This is going to only be in relevance to what we use for the system. So we'll start top left up here at the time frame. When you guys click this down, I want you to have a favorite bar of every last time frame that we use on a day-to-day basis. So when you come up to 5 minutes, as you know we use, go ahead and click a star. Come up to 15 minutes, go ahead and click a star. go up to hourly, click a star, go up to 4 hour, click a star. You can use 30 minutes, but we really, as you know, 5, 15, 1 hour, and 4 hour. Now, once you have these favorited, now when you look up here, these are actually all in unison. You can just directly click back and forth between them. If you like to type on your keyboard, if you just click a 5, it's going to bring you to 5 minute. If you click 15, it's going to bring you to 15 minute. If you click 1 and then H, it's going to bring you to 1 hour, 4, H, 4 hour, just as a kind of quick hotkey there. Okay. From that point, I'm going to show you guys how to create this favorite bar. So this is a bar of everything we use. While I'm teaching, you'll watch me use this path, which I'll show you how to put that on. This also has a horizontal line if you want to mark out your areas of support resistance using that. I personally use a box, which will run through here in a second. You also have a horizontal line that's a ray, so it doesn't go to the left, it just goes to the right. We have a trend line draw right here. We have a position size, so we have a bearish position. Here's your stop loss up here, and then your TP sitting down here. And then we also have a bullish one as well. So if you click that, that one is going to be for buys. I usually have it blue and green, but for demonstration, I'm going to make sure I just keep it here red for you guys. And then we have, this is where I'm marking out my areas of rejection, is using the rectangle. And then we also have a box if you want to mark out your own little notes and such here, you have that. Don't really need an eclipse unless you want to point out some certain level, which I do on live sometimes. We have our fib, which is going to be our levels of TP. So when you put up your position and we're risking 1 to make 3 sitting up here, you have your first TP level, second TP level, and third TP level. So just so you can track what that R to R is on a trade to trade basis. And then we also have text, and that's pretty much it. Okay, so first things first, way down here on the bottom left, if you ever lose this because you accidentally click a button, it is this star sitting down here that toggles it on and off. That is how you can push it on and off of your screen. 2 is this is your sidebar where it has all of your tools. They're not going to pop up here unless you favorite them, the same exact thing we did with time frame. So we'll run through these one by one. Here, you're going to want a trend line, so go ahead and star that. You're going to want the horizontal ray, so go ahead and star that. And then that's it from this entire section. Go down to the next one. You're going to want your fib retracement because that's where we're going to put our TP levels. Go ahead and start that one. Going down to the next, I don't think there's any. Going down to next, you need your long position so we know what our buy is looking like. You need your short position so you know what our short's looking like. Move on from there. You don't need brush. Definitely need rectangle because that's where we're marking out our areas of rejection. And then path, if you like to just kind of locate trend for you. This is more of a teaching tool, so I'm not too sure if you guys need this, but how you use it is you click, you keep clicking until you get to where you want, and then you double click to stop the entire path. Okay, so make sure you star that as well. Moving on. Text, so you can put, you have it 2 ways. You can either do the text or the call out if you want a bubble. You guys should be putting this on your chart because just in case you have any notes that you want to put in your journal when you take a screenshot of this chart, you obviously have them up there so you can kind of recollect what's going on later on. And then that's pretty much it. Now, when you're trying to mark out how many points or pips something is, okay, follow along here. So let's say that we have a buy here. Okay, let's say we're buying whatever it's going to be. We're just gonna, oh, we're on 4 hour time frame. Let me go down a bit here. 1 second. Okay, so let's say you're buying here. We're using a 40-point stop loss, whatever. We're going for 1 to 3. Okay. This measuring tool, just whoever, if you ever want to locate how big a candle is from high to low or whatever, if you want to see how big a swing is, you simply can click shift and then your mouse click, and that's going to bring up this measuring tool here. If you don't want to do the hotkey, which is what I just did, that is this measuring, it's just called measure, is this tool here. You can click down here and this is what it's going to do. So this is what it's doing. Okay. Let me bring you to these actual bars here. So let's go from here all the way down to this green candle. So from this top red candle down to this green candle, this is what it's telling me here. From the high of this box to the low of this box, we've moved a negative 155 points, which is 15,592 ticks, which we don't operate in ticks. So all you have to do is stick to this number. And it says 5 bars. So from this bar to this bar is 5 bars. 1, 2, 3, 4, 5. Okay, that's what this is indicating, and that is also 25 minutes of price action. As you see up here, we're on 5 minute time frame, and so going from here to here is 25 minutes of price action. So that's what that's indicating to you. Now, if you went the opposite way and you went upwards and you see down it's red, and when you go up it's blue, well, that's showing you from the bottom of this box to the top of this box you drew it. That is a positive 80-point move, 8,087 ticks. That is 7 bars of price action from the start all the way to the end here, and then 35 minutes of price action. Okay, you will be using this tool a ton, so I really wanted to break down what that has to do. Now, as far as this magnet sitting down here, when you guys are marking out an area of rejection, which is, let's say we're marking out this, I just have this sitting here. When you grab this, I'm holding down my mouse button right now, and then you click control while you're still holding it down. This is going to turn on that magnet. If you look over there to the left, you see how it's highlighting, not highlighting, highlighting, not highlighting. This is going to magnetize you either to the nearest wick or the nearest body. So when you start to push up, you can have exact drawings of exactly where you want this at. You see it's at body now. I move up just a little bit, and it automatically springs up to that next body of this green candle. Or if I go a bit higher, it's automatically going to scream to the exact top. So if you want exact levels, I don't use it myself. These are areas of rejection, so I'm just marking up a whole area. It doesn't need to be exact to me, but if you do, that's how you're going to use it. You're simply going to click and then click shift, and then it's going to sticky to wherever you want it to be, which a lot of people kind of enjoy doing that. Here, if you're trying to just look at raw price action without seeing any drawings up here, you see this eyeball sitting here, you simply just click that, and it's going to remove everything so you can just see charts, and then when you click it again, it's going to bring everything back. So that's everything sitting up here. Now um, let's dive into the actual settings of these, and then we'll go to watch list and stuff. So settings of path, there's nothing that you need. You can mark it out any color that you want. Remember, you just click, 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 and then once you're done with the double click, you can decide how thick you want it. You can decide what color that you want it, and you can decide if you want it dotted, dashed, or whatever the case may be. Okay, all of that is available to you just with those simple settings. And then if you want to delete, you can click delete on your keyboard. You can click delete sitting up here, or you can right click this and you can click remove sitting down here. However you want to do it. And before I move forward, there's a hotkey. So if you guys want, if you have a million markings up here, let's say we have there, say we have a resistance sitting up here, you have a trend line here, whatever the case may be. If you want to delete all of your markings off, you're in the next trading day, you don't want it to have flood your chart, you simply right click the chart, you come down here to remove 3 drawings. Never click remove indicator, which you might on accident, but that ZenLab all-in-one, which we'll talk about later on, that's going to remove all indicators sitting up here, and then you'll simply have to push them back up there. So just remove drawings. Okay. Horizontal line, same thing. Thickness, color, you can mess with all of those. Same thing with the ray. Trend line, same exact thing. Thickness, color, type that you want it. And then going into these settings. This is up to you guys. Wherever you put, this is how I have mine. I have it as blue, and then I have it as green, and then I put opacity to 20% instead of having it extremely thick because then I can't see the candlesticks behind it. You can do whatever colors you want. Just understand. Let me put this back. You could have it whatever colors you want. Just make sure that both of them are set the exact same. So for sales, we have red up here, and then our profit target is sitting down here. And then for buys, make sure you guys have the same thing. Red sitting down here, and then profit target sitting up here. So everything is in unison with each other. So for the rectangle, it usually comes out default with the strong border, which is I think this here. Yeah. So if you use a strong border, it usually comes out like this. I don't like to see the border around it, so I put the opacity really low, and then I just use the same exact color that I'm using um, with the background as well, which is that just really light gray. I try to have it as least clutter as I possibly can between here and the background itself. Both of them, their opacity is 15, and then I think the gray is like fourth or fifth one over, just so you know. All right, moving on. This is same thing. You can just mess with what color you want the text, and obviously what color you want the background, what size you want the text. Very simplified. You don't need the eclipse. And then fib retracement. This is a big one for you guys because this is going to be TP levels. Very simple settings. It's going to be 0, which is going to be obviously sitting right here. From 0 to 1 is going to be your stop loss, which I'll show you in a second. From 1 to 2 is going to be TP1, 2 to 3 TP2, and then 3 to 4 is TP4. Okay, so 0, 1, 2, 3, 4. That's all that it is. You can have them all the same color if you want. I like to have the stop loss the same color as my position is going to be, and then obviously TPs are all green. And then so when I put this up here, and I'm going to put mine back to how I have it. Obviously, everything is in unison with each other. Now, there's two different ways. Whoops. There's two different ways you guys can do this. You can have these price targets coming all the way to the right. If you don't want to extend that, just unclick it, and then it's going to go to wherever you draw it at. I like them extended all the way to the right, so I have them sitting up there. And then lastly, there's two ways that you can draw it. This fib is going to come like this with reverse unchecked. If you have reverse unchecked, you simply go from entry down to SL and it's going to bring it higher. I don't like doing that. I think that's odd that you're going from here lower and it pushes higher. So what I did is I put it in reverse. Once you click reverse here, now this is what happens. I just draw it all in unison. I go from stop loss all the way up to TP, and then it's going to mark out my perfect levels for me, and it has my price point sitting over here. Okay, that is the only difference between the two. So that pretty much marks out all the tools you guys will need. Now moving over into watch list as to what assets you're actually going to be trading. So you click up here. This is going to be your watch list where you're going to have all of your different assets that you're going to trade. And the way you're able to add one to there, you're not going to click up here in this box, because if you click up here and put in something like, let's put Euro USD and just click it up here, that's not going to bring it into your watch list. If you want to add something to your watch list, you need to click this plus button here, actually put it up, whatever it is, and then you'll see, look at the bottom right, it'll pop it into there and give you that new asset. Okay, the way to delete them is just to push down here. I don't like all the additional things up here. I don't really care for when you come to these. I don't really care for change percentage, the volume, extended hours. I care about the last price, the current price point that it's currently sitting at, and then obviously the ticker. It's the only information that we need. Now, as you see, I trade in multiple sessions with students. So I have NYSE open. I have the two that I trade. Asian, I have the session that I trade. London, I have the pairs that I trade. And then I have indices and Forex. This is just for teaching purposes, but this is what I use if I'm going to back test with students. So I'm not messing with my charts that I actually use during live session. Okay. If you want to put sections like I have here, you just right click sitting down here, or maybe it's up here. All you have to do is, thought it was right click. Yeah, add section. All you do is push in add section, then you can make it whatever thing you want, and then that's that. Okay. I have different sections for all of these, so that's the whole watch list. Now, they do have alarms. So let's say you're the person who doesn't like to watch your trades play out in its entirety. When you have a position sitting up, stop loss sitting down here, TP sitting up here, for one reason or another, you want price to come all the way up to these TPs, you're not managing your position. Well, right click the chart where you want that TP to be at. You're going to click add alert to Euro USD, create, and then you're going to come over here to this bottom one sitting down here, which is the actual alert section. This is going to show you exactly what all your alerts are. Once it gets up to that point, you can double click it here. You can have it actually send messages to your phone, which is what I did. And so once it crosses here, I'm not too sure. Notify in app. Yeah, so when you go to your app, you can actually set it up in the mobile app to have it under your number. And then once it crosses whatever it is, it's going to alert you on your computer, bottom left. It's going to have a message. And then also it'll send you an email and a text message letting you know, hey, it's crossing whatever. Make sure you hop on the charts and get it taken care of. So that can be very beneficial to you guys. Now, as a scalper, I'm watching my trades play out 9.9 times out of 10. I'm not walking away from them. So I don't really use alerts anymore, but just wanted to show you guys exactly how to use that. Object tree, this is just showing you how many objects you have up here if you want to delete them manually. But as you guys know, you can just come down here, remove 10 drawings, then it's going to have that up there. They have TradingView has like a discussion channel where you can talk with others. Don't really, or this is just them sending you warnings about if TradingView needs to talk to you about something. I coded obviously this indicator, so they're talking about something there. But that's all it is. The rest of this, you guys can run through yourself. I don't really know much about it. I don't use it, so it's of no concern to me. But here's the whole community if you want to look at forums. But can't stress this enough. Try not to look into too much different communities and such. You guys have everything you need to be a profitable trader. And the further you try to complicate that, as you know now, the rougher things are. You really have to stick down to one simple foundation and strengthen that over the course of time. Okay, so here's your y-axis where you see the exact price point. Sitting down here, you'll see exactly what day it is. You see this is 118, 1755. Down here, you can change your actual time frame. And then last thing I wanted to talk about on this TradingView video is the back testing button. So if you come up here and click replay, yes, you have to buy a subscription in order to use this, which I think is 10 or 15 bucks a month. You click that, you can go back to a certain period of time, and then you can back test from that point this system so you don't have to wait for live markets to actually execute. Now, obviously, live market execution is when emotions come into play and watching those live reactions, which is a very heavy part of the system, especially when you're adding discretionary trading in. Back testing can still help with the mechanical side, so you can simply test more data instead of waiting on a day-to-day basis. So this is how it works. Sitting over here, you click select bar from the left to right. You click select bar if you want to go a bit further back in price. That's all that that button does. The play button is obviously going to play candles here, and the speed at which those candles play is right here at the 10x. So if you wanted to go really, really slow, you can come all the way down here, which I'm not going to go that slow, but when you click play, it's these candles are developing a bit slower, so you can actively mark things up while it's running through this and kind of have a more of an accurate session playing out. Okay, so it's just a bit more live feed for you. This front button here, the one right next to it, that's going to push you forward one candle. Okay, so if I click it once, one candle. If I click it again, second candle, and so on and so forth. Now that's on 5 minutes. So you see we're on 5 minute time frame, and this says 5M here. That's going, when I click forward, that's going to click me forward one candle. But if I go up here and do a different, I guess they only have 1 minute, 1 second now. If I do different intervals, let's say I do 1 minute, now look what happens when I click forward once. Nothing happens at all, or it does for that first. Nothing happens at all. I click it again. It's going to show me that price movement during that set period of time until I click it 5 times. So there's one, here's two, here's three, here's four, and then here's five. And then now it's going to go to the next 5 minute candle because it just went through five 1 minute candles of price action on the 5 minute time frame, which is pretty clean. If you want to watch, price action play out like that, you can really go minute by minute and make sure you're within alignment. Okay, so that is a back testing session. While you're going through a back testing session, do not click this button, because if you do click this button while you're going through it, this is what it's going to happen. It's going to push you back to where price is currently at that exact at real time in life, and then you'll have to go all the way back, which is kind of cheating because then you can see where price was at before you go back again and restart. So really try to hold yourself from not clicking this button until you're done with the entire back testing section. And then lastly here, after this is this button sitting up here. You can save your layouts if you guys want, but this sitting up here is a split screen. So if you want to do, chart up and bottom, which is kind of odd, or what I do during a session open, I have NAS on left-hand side, US 30 on right-hand side, and I have them both sitting up parallel to each other so I don't have to fluctuate in between. I just have everything sitting here in front of my face. So this is a full breakdown of TradingView. Once we get into the trading journal itself and I tell you guys to take a screenshot, which will probably go through that video as well, but what I'm speaking about is, let's say you wanted to have this trade sitting up here, you would simply come up to this camera, click either download image onto your computer or copy link, and then I'll show you guys how to put that into the trading journal later on. But now that we've gotten to the end of this video, it is time to reveal the indicator, which is ZenLab all-in-one. So first things first, come up here to indicators, type in ZenLab all-in-1. It's going to be by Emmitt FX5280, and then that is going to automatically populate it on your chart once you click it. I'm going to run through every last setting on this free indicator, but I want to show you guys what it entails before we go there. So first things first, we have the average to range, which is set to a 20 length. As you guys know, is what we use in the system, so you understand exactly what that range is during the set period of time. It has previous session highs and lows for New York session, London session, and Asian session. This is already pre-programmed for Eastern Standard Time. There's definitely a way you can change it, and I'll show you that. But when it first pops on your chart, this is going to be for Eastern Standard Time. We also have a 13-period moving average, which is exactly what we use in this course. And then we have a checklist, so you guys can check off and make sure you at least have 3 or more confluences. Volume is always going to be a confluence, so it's not sitting up here. Obviously, the breakout is as well, but we did end up adding that in there. So as long as you have 2 out of all of this in this checklist, it is a validated trade to take. And then lastly, you have the news filter sitting down here, so you understand what is happening during that set period of time. And not only is there a table, if you don't want that table up on your screen, which will show you how to remove that and remove checklist, you have it right here on your chart with the big red line. So you understand if price is near that current point, probably should not be taking a trade right at that release. Okay, so to go to settings, come up here, click the settings tool, or you can double click on checklist, double click on ATR, double click on the news release, the double click on the moving average, anything that involves the indicator. When you double click, it's going to bring you to the settings. Just click your UTC. If you don't know what that is, you can go to the bottom right of the screen. That's the time zone that you currently have is set to, and you can click that, which is what I do, or you can use chart time zone, which will automatically populate to that. Now, understand when you do click this, for some reason, like when I have it as chart time zone and I go to something like Jury 30 outside of US markets, it's a bit odd with timing. So I highly recommend just doing your UTC, coming down here, seeing what that is, and then correlating that up here. Like I said, this is already pre-programmed to EST. So if that's where you're at, you're good to go. First thing is checklist. If you don't want the checklist up there, click that off. It removes it. This is a system that is interacting with this checklist. So if you want to actually have everything checked off every single day and you want to go down the list before you take a trade, okay, we do have 5 minute trend line on our side. We do have breakout on our side. It's over here. It's going to populate which one of those are true. And as I said, as long as it's two or more confluences, because volume is always going to be a confluence. Also breakouts, you might as well always have that checked. Then you can go ahead and take the trade. You guys can customize this the way you want it. Background color, obviously going to be this white. Text color, whatever you like. Green color is going to be the header sitting up here. And then footer, no need for that. It's pretty much a blank setting at this point. And then font size, you can do normal, you can do large, huge, whatever you want if you can't see. And then positioning, if you want it here, you want it top right, top left, whatever the case may be. You have a ton of options to customize this the way that you want it. You do not need to mess with these if you already have a UTC. If you'd rather prefer to do it this way, obviously that's an option, but you do not need to mess with them, just so you understand. If you want to mess with the coloring as far as your sessions, which I'll put this up here, you see now that it's yellow, you can deal with the opacity. All up to you what you want to do, but it's preset the way that I like it, which is just straight gray. So it's there, but it's not in the way, so we don't have to visibly see it. And then background transparency. So if you want it, way less transparent, whatever the case may be, you can put that up there and it can get really dark. I have it preset to where you can barely see it. Okay, some people like a session outline. You can click that, watch this outline come up here. Okay, so it's a bit thicker of lines, so you don't need to have that on there. And then session label. When you're trading, sometimes this label gets in the way. So I myself actually like to have that session label off so you won't see them. But if you want those on so you can differentiate what different zones are, if you're back testing or something, you can definitely have those session labels up. Market type, we're trading indices, so we put that up. That's simply for the ATR setting, so it correlates correctly. If you're trading Forex or if you're trading metals, make sure you check off which one you're trading so the ATR correlates correctly. If you guys want to mess around with length, you can. I highly suggest you don't, because everything is correlated to this exact program. But I didn't leave it open for those people who are collecting data, acquiring their own edge over the course of time, and they have freedom to do that. Okay, use customizable colors, so you can do different than green background and white text color. The size as well if you need it bigger. And going down to EMA. So obviously the moving average is this line here. If you don't like it gray, if you want it a bit thicker, you can put it up to 5, whatever, and it can get pretty thick. And then going to impact news on the chart. So impact news on chart. This is the chart itself. You can either have it for this week or just the exact day. So there's no news for today. So if I put it today, that disappears. But if I want to see news that is in the future for that entire week, which is what we got sitting down here in the chart, you can have it for that, which is what I like. Different options as far as solid, dotted, dashed. I like dotted, so that's what I usually have up here. You can make it heavy, you can make it medium, light, just a whole bunch of features to customize this to yourself as much as you possibly can. And then impact news table settings. So this is going to be all of the news for the week. It is only red folder news and only bank holidays when the markets are closed. That is all we are concerned of. Don't care for lower impact news, so I didn't implement that onto here. And if you want the news table, you can have it. If you don't want the news table, you just uncheck that mark. It completely removes it from your screen, which is what I personally like. But it comes default with the table up here, so you guys can see it. Border color you can change. Table header color you can change. All of the customizable settings for that. And you can also decide where you want it. If you don't like it bottom right, you want it bottom left. you have the option to do that. So once you customize everything the way you want it, make sure you come down here to defaults and then save as default. So every time you load it onto your screen, which I'll show you here in a second, it'll always be the same exact settings every single time. Okay, coming over here to style. You don't really need to mess with these. Again, you already understand thicker with the other with the other settings. Graphics objects don't really need to mess with these either. So make sure you guys keep these all the same. And then visibility, if you don't want any of these showing up on higher time frames, which I'll show you. So we'll have minutes, seconds checked, but not hours. And so when we come up to hourly time frame, look what happens. We don't have anything. So you can just specifically look at trend if that's what you want. But if you go back into settings and click hours, it'll be there for hours or days or weeks, whatever you want to. Okay, so that's fully customizable as well. Make sure when you guys put this up, so when you type it in, we'll just type it in here right here quick. Make sure you're starring it, okay? And so if it ever got removed off of your chart, let's remove this on accident or whatever. You've already saved it as default. You go right back up to indicators. You click it down here. Your default's simply going to be saved right away. Everything's going to load up and you don't have to redo all of your settings every single time. So that is everything involved with this free indicator for you guys. As promised, you now have a major tool to help you guide through this entire system and alleviate some of those steps as far as having confidence because you have a checklist, making sure you're not trading during high impact news and having the ATR up there so you don't have to correlate it or anything. And obviously previous session highs and lows. So enjoy. If you guys want to watch me trade the system live every single day, make sure you turn on notifications and subscribe to this channel. I'm going to show you exactly how much money you should be risking based upon your account size. And I'm also going to show you 3 different ways you can remove yourself from winning positions based upon what type of trader you are. Now, you guys probably figured out from this point, I have not talked about take profit levels at all. When to actually remove yourself when you're in a winning trade. Always spoken about exactly how to trade, how the markets operate, and when to remove yourself if the trade idea goes against you. And that's because that is proper risk management in order. But now that you understand how to trade and what to do if your idea was incorrect, now we can finally speak about what to do when your trade actually plays out and how you can compound over time. So let's get right into how I actually exit my trades and also how much money I'm risking per trade based upon the same exact formula. So I use a simple rule to decide how much I'm going to risk per trade. And over time, as you collect data and gain skill, you may choose to challenge yourself with higher or maybe lower risk if you're not doing so well, but that's a decision earned through performance. But as a baseline, this is the standard I use, and it's called the 20 trade minimum rule. All you do is take your account balance and divide it by 20. That means your account can withstand 20 full losses before the entire account is gone, which is obviously 5% risk per trade. This level of risk isn't so small that it feels meaningless, but it's also not so large that a short losing streak pushes you into emotional decisions and obviously blowing your account. Now, you can always risk less, but risking more is what I would consider over leveraging an account. All right, now first, if you're to lose 20 trades in a row, something is definitely wrong with your execution. It's not the variance of risk. Now, that gives you a large enough buffer risking 5% per trade to identify problems before the account is actually destroyed. And second, many traders are taught to risk 1% per trade, but honestly, unless you're starting with significant capital, which most of you guys are probably not, that number often feels insignificant and is going to lead you to do things like over leveraging just to feel some type of progress. So this approach sits right in the middle of all of that. It balances protection, emotional control, and meaningful progress, which is exactly what most developing traders need. As I was saying, most of you guys know how to get out of a trade when it's incorrect, but now we're talking about when to get out of a trade that goes in your favor. And there's going to be multiple ways to approach this based upon your skill level. But as with everything else in this course, we always start mechanical and then transition to discretionary as skill progresses. As we dig into 2 ways to approach targets, remember one thing from our risk to reward video, which if you don't remember, please make sure you go back and watch that. The higher risk to reward you trade, the less correct you need to be profitable. Now, the first target system is a fully mechanical exit. It's simply full in and full out. There's no taking partial out. There's no active trade management. It is the simplest approach because once the trade is placed, there's nothing to manage. That means there's going to be less chart time and more importantly, less emotion. With this system, you're simply risking 1 to make 2 or risking 1 to make 3 and so on and so forth. These exits are based purely on probability, not any type of price action, which is why I strongly encourage beginner traders to start here because it allows you to build data in your journal and see where trades tend to run before adding discretion. More often than not, are your trades going for 1 to 2s? More often than not, are your trades going to 1 to 5s? And you'll also notice in all of these examples, once price reaches a 1-to-1 to 1.15 risk to reward max, we are protecting the position. What that means is that you're moving your stop loss to its entry. So if price comes back to entry, no capital will be lost. Capital preservation will always come first, and that rule applies to every target and management approach that we're going to cover in this video. The second target system is still mechanical, but now it incorporates some price action. The entries are the same, your risk stays the same. What changes is how you choose your exits. Instead of using a fixed multiple, you're now targeting the next area of decision, exiting trades the same way you enter them, simply put. So for example, if you enter a buy after a resistance breakout, you would look to exit near the next resistance level ahead. That said, we are higher risk to reward traders. So once you enter a trade, you must still be targeting at least a 1 to 2. And if the area of next decision sits inside of a 1 to 2, well, then you have two choices. You can accept the trade knowing that the risk to reward isn't there, or you can pass on that trade and wait for a cleaner range with less traffic and a higher risk to reward multiple. This system is going to introduce more trade management and decision making, which is why it can be more challenging for newer traders, but it is still mechanical. The rules are defined, it's consistent, and it's repeatable. You're simply exiting the same way that you enter the market. The third target system is a combination of the first two, and this is where discretionary trading is introduced. And because of that, it is the most difficult way to manage trades and requires a significant amount of data and market experience to do it correctly. Now, your entries are going to be the same. Your risk is going to be the same, and it's the same criteria to protect your position once you're in profit. Once you hit a 1-to-1 to 1.5, go ahead and put your stops to break even. What changes is how you exit. As price reaches areas of decision, you now have a couple options. You can partial out of the position to reduce risk while keeping some on the table, still having some of that position in. You can fully exit the trade, or you can hold the entire position if conditions support continuation and then go through the same list of options once you get to that next level of decision. These decisions are not made simply because price reaches an area of decision. They are made based on how price reacts once it gets there, the same way discretionary entries are made. And this approach I personally use, but it took years of screen time and experience to earn. And it's also the hardest system to journal and analyze because no two trades are managed exactly the same. So if and when you begin exploring this approach, remember this principle. The higher risk to reward you trade, the less often you need to be correct. And that's what allows discretion to work without destroying consistency. Now, you may have noticed I did not give you one single way to remove yourself from the markets, and that is obviously intentional. Trading is simply not one size fits all. And trading progression is real. That's why we went from easy difficulty all the way up to hard difficulty. Now, I also want to say I have used all three of these approaches to remove myself, and I've also used all three of them profitably. That's why I'm bringing them up to you and showing you how to use each individual one. But as experience progresses, as you start to understand price action further and you start to add in discretionary trading, I want you to see what that looks like as well. But before you get to that point of higher difficulty, you need to collect data. And the easiest way to collect data is by being as mechanical as you possibly can. Holding for 1 to make 2 or holding for 1 to make 3. So you understand more often than not what your system does before you go into that higher difficulty of playing with price action during an active trade. Most traders don't fail because of strategy. They fail because they don't learn from their trades. I'm going to show you guys how to use a journal template and turn it into usable data. Exactly what's actually making you money, what's potentially holding you back, and how you can use this to strengthen your edge over the course of time. Now, this template I'm showing you in this video is free of access to you, so let's dive right into how you can get that and how you can actually use the platform. So first thing is access. Scroll down in the video that you're watching right now, go into the description and click on that very first link that says free journal template. That's going to bring you to this page where you're going to have to duplicate it for yourself so you can edit it on your own. So come all the way up here to the top right where it says duplicate, click that button, create yourself a Notion account, and then I'll show you exactly how to use it. Once you duplicate the page, that is going to make it your own where you're going to have these 3 separate tabs. So one is going to be start here, how to use a journal. You guys are already watching the journaling video right now, so you don't need to go to that step. You can go directly into your trade data dashboard. So here, I've put in a couple examples so you guys see exactly where to put that at, and let's just go ahead and dive through that now. So how you're going to use this is not by putting in your emotions and how you were feeling during that trade, which there is a section for that, which I'll talk about in a second, but you need to create usable data that over the course of time you can answer the following question, which is more often than not, this is what's happening with this section of the strategy. Okay, so this is all of the possible data you could potentially need. We're going to first start out with time, which is the exact area, the date that you're going to take that trade. If you want to add actual time, you can come down here and toggle this and put the exact time you're putting into the trade. I understand I'm only trading during high volatility times, which is going to be during New York Stock Exchange open, Asian session open, London session open, and potentially PM session during New York. So of that, I've already went through that data. I'm not going to trade any other type of period, so I don't put time in myself, but you can do so if you would like. Here is going to be the asset that you're going to use. I've already pre-put in USD Forex pairs, GBP, JPY, and then a couple indices as well. But if you want to put in something for yourself, you just simply type it out. Like you can put DAX here, and as soon as you click enter, it'll create an option for you where you can use it for yourself. Okay, but most of you guys are only going to be trading the assets I use anyways. Next is going to be session. So I have London, New York, and Asian session in here. Whatever one you populate and click, it is going to remove the other one from that point. You can only have one up at a time, obviously, and I'll show you guys down below why that is. And then buy or sell. Is it a buy or is it a sell? Click. It'll either be buy or sell. Result. If it's a win, click win. If it's a break even, click break even. If it's a loss, obviously click a loss. And then moving forward, scroll all the way to the right here to go to the rest of ours. P&L, how much money did you make or lose during that? If it was a negative, you just put a negative right before, and that's going to show that. And then risk to reward before stop loss hit. This is extremely important. This is not where you removed yourself from the position. This is where did price go before it came all the way back down and hit stop loss. Not where you put your stops to break even, which is usually a 1 to 1 to 1.5, but where did price go before coming all the way back down to stop loss? Because over the course of time, if you're trading for a 1 to 2, but you understand 80%, 70% of your trades are also going for a 1 to 5 or also going to a 1 to 4, that is where you're going to acquire confidence to start holding your trades a bit longer than you're usually doing, because that is the whole purpose of this journal, is to strengthen your edge over the course of time. Okay, you don't have to worry about winning percentage, just coding for the bottom part that I'm going to show you, and then trading screenshot here. This is very important. So once you're done with that trade, and let me go to trading view here. Whatever trade you would have taken, let's say you went ahead and took these shorts here, wherever stop loss was at, and you want to put this in your journal, you're going to come up to the top right, click this camera on TradingView, which is a charting software we use. Click copy link, go back over here to your journal, and then that's when you're going to input it. You simply click on, I already have one in here, but I want to show you guys how to do it too. So add file or image. You're not going to upload, you're going to mlink. You're going to copy that or paste that mlink into there, link it, and then you're going to have that as part of your of what trade that actually was. Okay? And then lastly, here's notes. Like I was saying, if you want some type of psychology in there, I was feeling sick today, or whatever the case, you could put notes in here. I'm not the biggest fan of putting emotions into your journal because I don't think that's usable data you can use down the road. Any type of emotional trading you have is just simply due to lack of confidence of your mechanical system. And so all of these issues of psychology cannot be alleviated by writing them down. They can be alleviated by understanding over the course of time, more often than not, what is your system doing? So that's why I really want you guys to remain as mechanical as you possibly can be with this system. Okay. Now coming down here, this is the part where you can choose whether you want more analytics for your trading journal or if you want to stay a bit more I guess manual and mechanical sitting up here. They do need you guys to pay $10 a month in order to get all these analytics that I've created. If you don't, that is completely fine. There was no way I can have around it, but you will only get one of these, and unfortunately, it'll not be of your choice. So when you go duplicate that journal, one of these will pop up and let you use as far as their free template. But if you want to have all these analytics I'm about to go through, you do have to pay $10 a month to go ahead and get that. So I just wanted to get that out of the way here. Okay, so here are the beneficial analytics that you can use. It's asset breakdown. So what is your most used asset? As you see here, I only have NAS US 30 and JER 40 as my, let me roll up here real quick, as the examples I had up here. And so those are the only ones that are showing. Two JER 40 trades, 2 US 30 trades, 1 NAS 100 trade. And if you hover over it, not only will it tell you what it is, if you click on it, it'll tell you exactly what that trade is as well. So you can go directly into a screenshot and potentially do some analyzing. Now over here is most profitable asset. If you understand over the course of time, okay, NAS 100 is negative 40K, but JER 40 is or plus 70K, US 30 is plus 150K, and over the course of a year, and you realize, wow, these two assets are making me way more money than this other asset that's kind of slowing me down. Maybe my system doesn't work too well with it. Whatever the case may be, that's when you can start making these minor tweaks and potentially tighten things up to only trading what is more beneficial to you. Now, this does take a long period of time. Make sure you guys are collecting data for the bare minimum 6 months before you start coming to any type of conclusions. But it's just nice to see all the analytics up here so you understand what you got going on. And as always, if you click like JER 40 here and pop it, it is going to show you all the trades that you've taken for that current asset. Okay, session breakdown down here, most traded session. For here, it is 3 during New York, 2 during London. Again, if you click it, it'll show you those trades. Your win rate percentage, so far, my win rate is 100%. I guess I didn't put any losses in here, but if you were, which let me show you here, if I were to put a loss here instead of a win, or let's just put 2 losses here instead of all wins, now we come back down here. Our win percentage is 60%. Our lose percentage is 40. 40% of the time we're losing, 60% of the time we're winning. Okay? Now, this is that prevalent area that I was speaking about. More often than not, where are your trades going to? Now, they are all sitting at a 1 to 5. But if we scroll up here and put one out of 1 to 2, let's put another one out of 1 to 1, and let's put another one out of 1 to 3 here. When we go down back to those analytics, it is automatically going to update what your trades are doing. So this is very beneficial. Over the course of 6 months, a year, you can see more often than not trading the system that you currently have. Where are these trades running to give you better confidence to hold your trades if you potentially have emotional issues of pulling out too early and things of that case. And then win rate per month. A lot of people I see don't trade certain months because their win rate lacks. Well, here you're going to be able to see over the course of years. This is only January examples, but over the course of a year, 2 years, if you see that continuously, August is always your slowest month by far. Not, everything else is 60 to 80%, and August is 30%, or in August is 50%. I'm saying a heavy discrepancy and something that is costing you money versus everything else. Well, over the course of time, you may potentially be able to remove that, but simply by not journaling, these are not things you're going to fully be able to remember. You need to put numbers behind them so you have real valuable, usable data to strengthen your edge over time. And then last here is win rate per asset. So JER 40, 50% win rate, NAS 100 is 100% win rate, US 30 is 50% win rate. Same thing. If for some reason GJ or US 30 has a 20% win rate over the course of a year, but everything else is sitting at 50% or above, well, it may be a good indication that you need to remove those and focus up on what's actually making you the most money. So this is a journaling template in its entirety. So now you guys should understand, journaling is only going to work if you apply it with structure, but also the only way you're going to strengthen your edge is by acquiring real usable data. And now by the end of this video, you should understand exactly what that means by using this journaling template. Now I want to hear from you guys. If you have anything further you would like to be added to this journal, for one, definitely comment down below. But also, if you're really starting to understand how to become a profitable trader, all the way from how the mechanics of the market work, all the way down to strategy, and now how to create or to collect data so over the course of time you can gather confidence and become a profitable trader, I want to hear from you guys. This is now my 3rd time creating a course, and every single time I've been able to optimize further and further to help new traders out, expedite that learning curve, thanks to you guys and getting feedback from you guys as to things that I may potentially have forgotten or things that you have struggled with, so I can put it in the next series to help traders out a bit quicker. So as always, if you guys want to watch this system play out live every single day, I go live on this channel. So make sure you subscribe and turn on notifications. Up until this point, you guys have learned a lot, and now it is time to apply. You don't just have information anymore, you have an entire trading system. Proper psychology, entries, risks, targets, management, and journaling. This video is going to show you exactly what to do with it all. If you follow this 30-day roadmap, you're going to transition from just brainstorming theory to actually using usable data and creating an edge that is going to make you a profitable trader. This is how everything comes together so you can take actionable steps to really start doing this for yourself. And as you go through all this, as you guys know now, you can watch me trade this entire system live every single day while you start to gather your bearings, gather your own data, gather your own confidence so you can ultimately get off of those lives and again, start doing this for yourself. This is not random education. This is a structured trading system that was meant to be mastered. And now from this point, all you have to do is apply these tactics over and over again until you acquire consistency, which is going to give you usable data that is going to transfer into confidence, which is going to transfer you from wherever you're at now, whether it's a struggling trader or a new trader, to a profitable trader. This was designed for all skill levels to transition from being unprofitable or to transition from being new to actually understanding what you're doing with the markets and not only investing smart, but investing with an edge that is going to allow you to extract money from the markets more often than not. So here's exactly how your first 30 days are going to go. We're mapping this out week by week so you have zero uncertainty and a clear path to trading live capital or prop firm challenge as fast as possible, but safely. So let's start with week one. You know how on your first day at a new job or a new school, there's always a little anxiety? Well, that's exactly why the first day is usually orientation and not full responsibility. You're not expected to perform yet, you're expected to observe. And your first week with this system is not going to be any different. Before you ever apply it yourself, you need to see what this system looks like in real market conditions. And that's why week one is focused entirely on just watching me execute the system live on this channel, getting familiar with the platform, and seeing how decisions are made in real time. Before you ever apply it yourself, you need to see what the system looks like in real market conditions. And that's why week one is focused entirely on watching me execute the system live on this channel, getting familiar with the platform, and seeing how decisions are made in real time. Your job this week is very simple. Just watch live sessions, ask questions, and take notes. The goal is to remove confusion before it ever turns into mistakes. No one's going to hire someone and throw them directly into the fire on day one. You set them up for success first, and that's exactly what week one is designed to do. Now, week two is where you begin executing, but still without real risk. This is where you open a demo account and start trading the system exactly as it's designed. The goal this week is not to make money. The goal is to prove to yourself that you can follow the plan. You'll begin taking trades using the same rules you've already applied, the same sessions, the same entries, and the same risk framework. Nothing changes except now you're the one clicking the buttons. Now, I still want you watching the live streams during the week. Remember, you're here to learn how to do this for yourself. I'm your trainer, but not your trading partner. The goal is to become self-sufficient and not dependent. Pay attention to where you hesitate, where you rush, and where emotions start to creep in, even in a demo environment. I promise you they are going to arise. And most importantly, you need to journal everything. If you're unsure how to do that properly, go back to the journaling video where I break it down step by step. This week is about building confidence through repetition and not results. And if you can execute the system cleanly in simulation, transitioning later becomes a lot more simple. By week three, you should be familiar with the system. That doesn't mean you can execute perfectly on your own. It doesn't mean you have no questions. And it definitely doesn't mean you're ready for real capital yet. But what it does mean is you should be able to mark a chart on your own. You should be able to identify levels you believe are valid. And that's exactly what you'll start doing this week. You'll continue watching the live streams, but now you should be showing up prepared to these streams. Mark up your charts before the session, preferably trade the same assets I trade, then compare your analysis to mine and see where they align and also where they don't align. And of course, continue to journal everything. This is obviously where the real confidence starts to form. And remember, we're scalp and day traders. So by the end of week three, you'll have watched and reviewed probably 15 to 30 trades using this system. And that's definitely meaningful repetition. So use it. Go back through your journal screenshots and make sure you understand why each trade was taken. And if something doesn't make sense, we'll break it down. You already know the confluences, so validate them. This review process is a massive skill builder and one of the fastest ways to build real confidence. Now, week four is where you make a decision. It's not going to be an emotional one. It shouldn't be a rushed one. It's a data-backed one. Up to this point, you've observed the system, executed in simulation, journaled your trades, and reviewed your data. So now it's time to decide how you're going to trade moving forward. And this is where you have to choose. Are you going to be trading a personal broker account, or are you going to be pursuing a prop firm challenge? If your execution has been consistent and you may want to begin going for higher capital than you can probably put into a personal account, a prop firm may make sense for you. And if your execution has been consistent and you prefer more flexibility and full control, maybe a personal account may be the right move for you. Now, if you have any questions about either path, make sure you refer back to the videos where we broke both options down in detail. There's not a better option here, only what fits your situation, your goals, and your data. And outside of making that decision, nothing changes. You still need to continue to show up to live streams prepared, continue to journal every one of your trades, and trade the same system using the same risk on your simulated account. The only thing that changes after this week, if you choose, is the account structure. If things feel like they're moving too fast, we'll slow down. There's no deadline. Continue watching live execution, continue trading simulation, and continue journaling the process. Everyone progresses at a different pace. And if you follow the blueprint and this roadmap from start to finish, this decision should feel calm and not stressful. You don't graduate into live trading, you transition into it once you are ready. Step 5 isn't an ending, it is just the beginning. Because at this point, you've done something most traders never do, which is followed a structured process from start to finish. And moving forward, the goal should be very simple, which is consistency. You continue trading the same system, you continue managing risks the same way, you continue journaling and reviewing your data. Progress from this point on comes from repetition, not acquiring more information. This is where real growth happens. There's no rush to scale, no pressure to trade, no need to reinvent anything. You have everything you need to be a profitable trader. You now have the full framework that has allowed me to trade full time without constantly questioning, was this a good month? Did I get lucky? Am I missing something? The system is built on years of experience and thousands of trades worth of data. Are there other ways to make money in the markets? Well, definitely. Are there systems that may outperform this one? Possibly, for sure. But can you become a full-time trader with everything you've learned here? I am living proof that you can, and so are many others. Now, the biggest mistake I made early on was spending years jumping between systems, always searching for something new, and never giving myself the time to actually progress. It's like constantly changing workout programs and wondering why you never get strong. It's because consistency is what compounds results. And whether you stay on demo longer, move to a personal account, or pursue a prop firm, the rules stay the same. Your edge strengthens over time by doing the same thing well, not by constantly doing new things. This is how trading turns from something you guys try into something you actually do for a living. If you now view the markets differently or have gained structure that you have not previously had, I do want to hear about it. Make sure you guys put a comment down below. And if you want to progress forward with a community of like-minded individuals who are trading the same exact system, go down and click the link down in this description to join my free community. That's where I post updates, share resources, and keep everything connected as one network. And remember, you guys do not need to do this alone. Every single day, I am trading live with you guys directly on this channel. So if you haven't done so already, make sure you subscribe and turn on notifications, and I will see you for the next live session. And last thing, congratulations on completing the Zen Lab Blueprint.